Very warm welcome to each and every one of you, and a good morning to each and every one of you. I'm your host, Ridhimavali, and extend a warm welcome to every one of you to this stage, the platform, the convergence, where we actually get the most celebrated thought leaders, visionaries, luminaries from financial landscape, NBFC, mutual funds, insurance company, under one roof of country's largest exhibition and convention center to actually discuss, deliberate, and delineate the future, the facets, the length and breadth of BFSI. Ladies and gentlemen, welcome to India's biggest BFSI event called the Business Standard BFSI Insight Summit 2023. As India is touted to become the third largest economy in few more years, I think it's very important for all the thought leaders, not only from financial services, but actually India's eminent regulators to come under one roof and really discuss the pragmatic insights and actionable that have the promise to impact the future. With over 63 speakers, 10,000 plus registration, 20 sessions, and 40 plus exhibitors, 30,000 square feet of exhibition area that was exhibited last year, this year, the BFSI Insight Summit has gotten better and bolder. To really set the context and render the keynote and welcome our dignitaries, I'd like to invite Mr. Shailesh Dobhal, who is editor, Business Standard, to render his welcome address and opening remark. And at this juncture, I would also like to take the privilege of welcoming Mr. K.V. Kamath, Chairman of NAFID and Non-Executive Chairman of Jio Financial Services, and Mr. Tamal Bandyopadhyay, Consulting Editor at Business Standard, to please make their way on stage so that we can get started with the proceedings of a very riveting fireside chat. Over to you, Mr. Dobhal.
Thank you, Ridhima. Good morning, everybody. On behalf of Business Standard, let me extend a very warm welcome to Mr. K.V. Kamath, Chairman, National Bank for Financing, Infrastructure and Development, and Non-Executive Chairman, Jio Financial Services, on this opening day of Business Standard's BFSI Insight Summit 2013. Mr. Kamath doesn't need any introduction, especially to this audience, but allow me to do it nonetheless for form. Mr. Kamath is a mechanical engineer. He completed his post-graduation in business administration from the Indian Institute of Management, Ahmedabad. He started his career in finance in 1971 in ICICI, that was a development institution then. In 1988, he moved on to the Asian Development Bank and spent several years in Southeast Asia before returning to ICICI as its managing director and CEO in 1996. And post its merger with ICICI Bank, was managing director and CEO of ICICI. Under his leadership, ICICI transformed itself into a diversified, technology-driven financial services group across banking, insurance, and asset management in India and with a global presence. He retired as managing director and CEO in 2009 and continued to be the chairman of ICICI Bank till 2015. In 2015, he was appointed as the first president of the new development bank set up by the BRICS countries, from where he retired in 2020. He also served as the chairman of Infosys. Mr. Kamath was awarded the Padma Bhushan, one of India's highest civilian order, in 2008. Many thanks, Mr. Kamath, for agreeing to be with us today. May I now invite and request my colleague Tamal Bandyopadhyay, Consulting Editor of Business Standard, to please start the fireside chat with Mr. Kamath. Over to you, Tamal. Thank you very much.
Thank you, Shailesh. Very good morning and welcome to the biggest BFSI summit in India, and welcome, Mr. Kamath. Give him a big hand, please, Mr. Kamath. The moment I said, sir, you have to come, and he said, yes, that's it. I said, you come at 9:55. He said, no, I'll come at 9:45. And on the dot, he was there. So that's K.V. Kamath. I was groping for an opening line. How do I start? And he gave it unwittingly, of course, I mean, without knowing it, he stepped in and he is talking about a BS lunch. Yes, business standard lunch, that's a column. So I invited him to have a lunch and at a five-star hotel because BS would pick up the bill, so I didn't have to bother. But he insisted that no, it has to be in my room. Why? Because of time. Because he is absolutely time pressed, and every minute mattered to him at that point of time. Trust you me, I had my hair jet black at that time. So many moons back, no glasses. So lunch was well laid out. Mutton, chicken, everything, and for Bengalis, rasgulla, etc., mishti doi. But one thing I found it very puzzling, there's a plate full of green chilies. I tried it once, I gave up, and Mr. Kamath probably eaten 3 or 4 green chilies. It was so hot. And he continued to have the green chilies with every bite. So it's so hot, and Mr. Kamath, banking sector is now at this so hot now. It's very, very hot. Look at the investors, look at everybody else, look at their balance sheet, it's just hot. And some time back you said you have never seen such a good banking system in 50 years. So tell us more on that. Why do you say that?
Thank you.
So
Tamal.
fireside chat, let the thing on fire. So.
Yeah, thank you, Tamal, and thank you, Standard, for having me here today. It's an honor. Just to add 30 seconds to that story, this is a story 25 years back, so it's not a recent story, what Tamal told you. And one more interesting thing was a day later or so when the story came, the story was really about green chilies. What we discussed was subsumed in the green chili. So that's Tamal for you. So you do not know where he goes. So now the question that is asked is the banking sector. Basically, I said that a few months back, and I honestly meant it because I've never seen a banking sector in India or abroad which is consistently running such high levels of capital adequacy, which is running such low levels of credit losses and such low levels of NPAs. I have not seen it. A. B. The India opportunity. You got a 25-year runway of growth where you can finance. So that part is there. And C. Profitability. Again, if you look at, banks are now nearing that magical number of 17 to 20% ROE, which makes them what I call perpetual engines. They don't need fuel at all going forward. And fuel really is equity capital. They don't need it. So I don't think that we have ever seen such a alignment of everything that you need in the banking sector. So what I said was from the heart.
We'll come to the domestic tab, but tell me the geopolitics now, what's happening, and currencies under pressure. Of course, rupee is the best performing among the emerging market currencies, etc. But the spread between US bond and Indian bond is shrinking. If you see the flow of foreign investors, it's pretty bad. It's the worst in the last decade, if you talk about the last 6 months FDI flow. So all these things, won't they have an impact on the banking system?
So I think these are transitionary. These are transitionary for the reason that the sort of inverted yield curves that are there, the sort of returns that are there in domestically investing for an overseas investor, for a developed country investor, clearly is taking a short-term view and arbitraging the opportunity there instead of putting long-term money here. So I think that will level off as we go along. So I'm not worried about that. But Tamal, there is something else that is very interesting that has happened over the last 1.5 years, post-COVID really, and along with the situation in Europe. What you saw was the inflation rising, and of course everywhere. Didn't rise to that extent in India, and India had an appropriate response, a very measured response. But surprisingly, the West, which always in a way taught us that if there is inflation, get your interest rates up, for a large part did not do anything at all, particularly Europe, didn't do much at all, and let inflation be very high and let interest rates be low. So what I'm trying to say is that I think the old economic theory that was written maybe over 100 years back is now being revisited by certain domains. So that also will need to factor in as to what is happening in the external world. A, they are living with high inflation. Some countries are living with high interest rates. Some countries have arbitrage opportunities. So all these things impact flows into India. But I believe all these are transitionary and they should level out.
Sir, you are talking about the health of the banking system. They are well capitalized. Their asset quality is impeccable at this point of time, etc., etc. But we understand that because of the rising interest rates, the quality of assets, particularly in the retail segment, there are certain cracks. Probably not NPA 90-day non-payment, but probably the so-called special mention account A or B, like 30 days, 60 days. Closer to 90 days already started happening, and it's a question of time before we see and hear the bankers saying that fresh slippage has started. Do you agree with that?
Yeah, I think we will have to watch. I don't think there is anything very clear that has come either from the banks or in a regulatory context as to what this is. But I hear what I best term as market perception. I don't want to call them rumors, perception. And some statements that probably the larger loans, larger we mean the 5, 7, 8 lakh loan, is more stable than smaller amounts of lending that has been done. I think over the next 6 to 8 months this will play out. But Tamal, one thing that needs to be noted here compared to the time when we lent. See, when we lent at a NIM of maybe 2.5%. 3% was very lucky, not 3% really. And so your ability to absorb losses was constrained. You're now looking at NIMs of 5, 6, 7, some people talking of 8% NIMs. So the ability to absorb losses is also higher. Now, we can always have a question, should you have been lending at that rate itself? That's a different issue. But once you run at that NIM, then you probably can, you need to understand that you're going to have some misses. And hope that the spread that you have on the overall book is good enough to take care of that. But this is all part of a learning curve, and I think we have a very watchful regulator, so I'm sure they will take appropriate in advance steps to prevent any systemic flow.
I remember when you took over the helm at ICICI and then it became a bank from the Development Finance Institution, there's a problem of liability side. You were, but that's a particular problem for ICICI, and you overtook this, converting itself into a bank, meaning by merging the reverse way, etc. But now the deposit mobilization, the war for deposits. If you drive down on the Western Express Highway, I think till recently, the billboards by banks were the maximum, not for any OTTs and others and all, that 8.5% or 9% for senior citizens and all. So have you seen this kind of deposit rate war in your entire career? And how do the bank, because there are other investment avenues, mutual fund, AUM is now closing to 50 trillion, which is almost 25%, because 196 trillion is the total bank deposits. So how would the bank manage the liability side?
Yeah, the war really
And can you have some tea for Mr. Kamath?
I'm fine with you.
Let's have, sir. Then fireside chat will become more
I'm
interesting.
fine.
Let's get him some tea.
Not
Vishal?
Not chilies. We'll have tea.
Not chili, just tea.
Yeah. No, I think Tamal, I think you underscored a very important point. Why is the deposit rate high? I think two key reasons as I see. One is underlying inflation, and if you have the government bond at 7%, you need to then make sure that you are pricing your deposits appropriately. So whether it should be how high or how much higher it should be than the government bond is something that I'm sure the markets will determine. The second is, I think, the same syndrome that I mentioned earlier. The NIMs are so high. So we are saying that banks are taking in money at 8 or 9%. But still, if you look at the last reporting quarter, which is just quarter preceded this quarter, we are talking of 4.5% as the average NIM for big banks. Whereas as I said in our time, probably 2.5% was lucky. We were happy with that. So it's I think two factors here. One is they keep an eye on inflation, they're raising money appropriately, and second, they keep an eye on their spreads and decide what is it they can raise at. But there's something else happening, which I think you alluded to. Whose billboards are going up and so on. I think the rise of the mutual fund industry, as you mentioned, I think is a key. If you see the relative share of either banks or mutual funds mutual funds are today taking in more money than this. And it had to happen because mutual funds are slowly being understood by the marketplace that these are instruments which could actually help you in a long-term context, give you a better return than banks. And so savers, and today's saver is probably an educated saver, educated in the sense of financial education. And he or she is comfortable taking that risk, and I see that happening.
Let's get into some macro thing, then we'll come back to micro again. You headed the BRICS Bank, right? And now the BRICS is talking about a common currency. That's one part of it. Now China wants G20 to be replaced by BRICS. That's what China made it very clear and all. So what's all happening? And in this context, our efforts to make rupee internationalization of rupee, how do you see?
I think all these will happen in parallel. And I can say this, that this talk about a BRICS currency, a BRICS settlement system, has been around, I think, right from the time that BRICS was founded. And quiet work was going along on these lines. And not only that, the BRICS, they had also a structure in place, which is akin to the IMF. So all the tools that were there in the Western world, the BRICS Bank, BRICS, the constituents were working on. So this is not anything new. Now it's almost 9-10 years old in terms of what they've been doing. And if you look at it now, I think the importance of some of the steps comes forth. For example, the settlement system, the global settlement system, which was riding on only one platform, in a way had to have other enabling platforms or competing platforms and so on. I think with each of the national platforms now in place and completely digital, end-to-end and so on, take UPI itself, I think using these in a concerted manner to settle globally, I think is not difficult. I think that is, I think the next move that probably one could see. Similarly, if you have a currency basket of like-minded players, you have an alternative system that you have in place. I see that evolving. It is not probably imminent today, but it will evolve as we go along, so that you have choice. I think the developing world has a choice how to settle and with what instrument to settle.
Mr. Kamath, another macro, it's not exactly applicable to India as yet, but if you look about the developed market, as a banker with, you are the retail guru, that's only one hat you wore, but you have done so many other things. Just tell us, particularly in the developed markets, is now interest risk is now becoming bigger and more critical than the credit risk. Because if you see the US Treasury 30-year, somebody who has put in money in US Treasury in 2020, my understanding is this institution had lost maybe 40, 45, 50% value. Now, because of the M2M, there is no mark-to-market for that. It's under the HTM category. Those who are, everybody is financially literate here. M2M is the mark-to-market, which is in the current price. You need to value your assets, irrespective of at what price was bought. And HTM is the hold to maturity. If you skipped in the HTM, then you don't need to do this. But if there is a run on the bank, which happened to the Silicon Valley Bank, then you need to liquidate and you are in trouble. The bank went for a toss. So do you think this is the threat for the banking system, particularly globally? Here we are managing quote unquote 10-year paper. There is not much of thing, it's holding on. But in US and some parts of Europe, do you see this happening?
Yeah, I think
this is the new risk.
Yeah, it is a new risk and it is a relevant risk. What you have pointed out is a relevant risk. But upfront, I want to say that risk is much less in India because the structure is very well managed and we do not have that sort of divergence that is there. That is, we never had interest rates near 0 and near 5%. 0 and 5, if you have 10-year paper, basically 50% is gone. That's what you are saying. So I would think that that risk is real, and I don't think they have an answer as to how to resolve that risk. The only hope is that over a period of time, things come back to manageable proportions where you are talking of interest rates 1 to 2%, because that will be dependent on inflation. So some countries will be more vulnerable than others. As we said, Europe, which didn't take any steps at all, could be more vulnerable because you've got old paper sitting there at 0.1% and new paper, and you got an incipient or not, you got a real inflation on your hands. So I would think that the next 2-3 years, this challenge that you articulated, I think you articulated very well, that the interest rate risk will become more important than the credit risk. I think it's going to be very true. On Silicon Valley Bank, I think it was a slightly different situation. It was a short-term matter. It was very clear and obvious in the balance sheet, but it slipped, I think, the regulator or everybody who was looking at it, and it slid very quickly down a very slippery slope.
So you give credit to Reserve Bank of India for what?
I give complete credit to our regulators and the government. Particularly, I've observed post-COVID or during COVID and post-COVID, what I would call supporting the economy. The government did two things. One was at the SME level, they provided that safety net, as it were. They provided food support to the mass. The Reserve Bank, unbelievably, took this bold step of keeping liquidity. I'm saying unbelievably because I cannot imagine that in any situation a central bank would have had that courage. But our central bank had the courage to keep liquidity and for a large part keep interest rates low. I think that allowed things to turn around at a pace which we didn't expect. Just to put a sideline which has not come out, when the expert group was set up in 2020 to restructure...
Under your leadership.
I was there, part of it. The estimate done, based on discussions with the rating agencies, industry bodies and so on, was something like 9.5 lakh crores. 9.5 lakh crores of assets will have to be restructured.
Yes.
1 year later, the scheme ended, and we ended up doing only 5% of that,
yes.
45,000 crores or so.
Yes.
Not because people are not interested, but people did not need it because they came out of the problem that was envisaged. Because liquidity was good, interest rates were held, and of course, I think companies were able to ramp up back to speed very quickly. But those are to me incredible lessons of how appropriate regulatory policy can put things on a right path very quickly.
Sir, a very micro question. Now, if you ask any banker, particularly in the private sector, in private, they said the biggest challenge is HR, retaining people. Because this new generation, they don't care for money, they just look for the challenge. If you can't give them the right kind of challenge, they will quit. They will become, they can start a startup, or they can do anything. I mean, they don't care about it. Mr. Narayan Murthy is talking about 70-hour work. That's a separate story. So how do you, because you nurtured so much of talent in ICICI Bank, that was you supplied blood to the entire banking system from here. So how do you see this HR issue?
This is a very interesting...
and the 70-hour work?
A very interesting challenge that you are putting out, Tamal. People. See, I want to analyze it on 3 frames. But I will say that anybody who is complaining that we don't have people, I have no sympathy for them. So any institution, bank or otherwise, if it says we don't have people and there is a 50% attrition, I have no sympathy. I'll explain why. In a country like India, where you have got this vast human pool of talent, to say this is your own failure. Now, I need to spend 45 seconds on this. We came from a situation, Tamal, in 2001, 2002, when there were no trained people to put in your front office. We did not have enough managers to put, we did not have front office staff to put in a branch. The licensing was opened up around 2001 or so. And so we were brave. We said we will get 500 branches in 1 year. And we had totally maybe 500-600 branches. But where do you find the 5,000 people for the branch? Where do you find the branch managers? Even if it is a manager and an assistant manager. So we said, we will train our own people. So we actually codified all our teaching material, gave it to NIIT, and said, you run programs. We will underwrite 5,000 in the first year. And thereafter we will then underwrite 7,000. And if there are more, let them go to other banks. But curriculum we provided, training they did, 6-month program, and the person was computer literate, then understood banking and could sit at the front desk. Then we had the same problem with the managers. We said we'll tie up with the university. We tied up with, if I remember, Manipal University to set up a campus in Bangalore, 1,000 a year. It continues even now. I don't know, now is 2,000 or 3,000 a year that are graduating from that one-year program. Tailor-made for branch managers and this. These are people in the first degree, come in there, get trained for 1 year and come in. So I would think that people need to figure out what is it that you can do before saying that, oh no, there's a problem. The problem, we need to go out and fix it. That's the only way it works.
So your tea.
Yes, okay. Yeah, thank you. Sugar? No, I'm fine. Yeah.
So another micro question, or rather macro, everybody wants to know that it's a time that banks should become tech companies, techies should run banks, because everything is data driven. Data is the lubrication and oil. I mean, I don't want to use the cliche. Recently, one large private bank has got a global CEO who's be taking over in by January, and he has an direct experience with the last 2 years with the tech companies. So is this the future of banking? We need to approach banking like banks as a tech banks need to approach the business like a tech company, transforming themselves?
I would put it this way, that the CEO need not be a techie, but he should be aware, he or she should be aware of what's happening around in the tech universe, because clearly technology is taking center stage as far as everything that touches us, but banking and financial services in particular. So if you have a setup where from the CEO down, nobody is really conversant with technology, and the IT department is very comfortable running technology that was there, I think this is going to be a challenge as you go along, because the new competitors are going to be very difficult to prevent new competitors from gaining market share and so on. So in India, you can already see it. You have the fintechs who I think are running great technology, and then you benchmark them with the incumbent banks who are still finding it difficult to raise their game to the same level. Now, for some time, you will have a regulatory moat. The regulator will provide you protection. But at some point in time, that moat is not going to be as strong as it used to be. And then you will have this large set of new players who have mastered technology coming and challenging you. So it's a real challenge. And the challenge has to be actually taken up by the CEO, not by the IT department. The CEO then has to have the courage to drive that technological change through the IT department. That's the only way it can work. Otherwise, it will not work.
RBI, you are all praised for Reserve Bank of India. Now the governor has been repeatedly talking about the governance in Indian bank, constitution of the board, etc. So do you think there's something seriously wrong? What is the provocation for RBI continuously talking about governance?
Yeah, I think, I don't think there's anything wrong. I think if you look at, what do you look at? You basically try to look at the health of the system. Ultimately, that is the outcome of governance. And if you find the health of the system is good, the supervisory structure is good, which it is, thereafter it is just probably, to me, at this point, looks like a cautionary thing. You need to caution, because an economy growing at 6, 7 or 8%, depending on how you want to look at it, and banks growing at, some growing at 15, some growing at 12, probably needs to need to calibrate growth as they go along. But I don't see anything that is particular that has been pointed out which needs to be done.
The RBI also looks at not only the balance sheet and other part of it, it's also the business model of banks. Now it's under the microscope. Is it a regulated job to tell a banker what is to be done and what is not to be done?
With my 50 years plus, I clearly am of the view that the regulator takes the final, he takes everything on its shoulders, the regulator. That is, the trust of the people, the deposits people have put in it, and the security of that, A. B, in its monetary policy role, where the two are combined, as in India, it also takes into on its shoulders the inflation fighting role. So given this, they have to act within the context of what they believe is broadly right and set broad contours. And that's what they're doing. I don't think as of today, for example, Reserve Bank is telling us how much of corporate and how much of retail debt should be done. They have basically given you freedom to do that. Reserve Bank has not told us what technology to run. That freedom is given to us. So within that, I think we need to exercise judgment and do things in a prudent manner. I think is what Reserve Bank says. For example, if you do retail lending and in first year you have got a very large NPA book building up, Reserve Bank would be right to ask, what were you doing and how did you have such a large, initial year loss itself?
Mr. Kamath, I'll ask you two more questions which you are involved in now in a very intense way. But before that, one thing I would like to know, is there any concern anywhere? RBI continuously harping on financial sector stability. Everything is, inflation is not bottled yet at 4%, but inflation is manageable. Interest rate, probably we have seen the highest, at the peak of the cycle, it can only go down. Question of 6 months or 9 months or 1 year, that's a separate story. So overall things are pretty good. India is the growth engine, global growth engine. But seeing all the external factors and even internal also, retail, etc., are there any concern that can derail the growth, that can spoil the honeymoon of bankers, both banking and economy?
No, I would look at it this way. At this point in time, looking at what's happening in India, in terms of the growth opportunity, which has been articulated, so I won't go into that. And I look at the India growth story as not only the 6.5% growth story that has been talked of, but you will have to lay on top of that another maybe 25% of that is growth coming out of the digital economy. Digital, which is about 5 to 7%, I think will grow to 20-25% of the overall economy. So you're talking of a larger number over the next 2 to 3 years. And that momentum is building up. So I am not too worried about that. And then, of course, the financial sector grows at a multiple of it. From an internal angle, so what am I worried about? My worry is about too many external things impacting not only us, but every country. And they having a diverse set of impacts on these countries and inability to then manage it. And they are coming fast and in a furious, as it were. You had a medical emergency, then you have a situation in Europe, now you've got a situation in the Middle East. So these sort of things could unsettle any country. So to me, that would be the biggest risk that any country carries, not us specifically.
Two quick questions, sir, and it's from your backyard. You are heading, as a chairman, of course, an NBFC. Now, I am not getting into all those details of what's the plan, etc., because you will not tell me. So there's no question. But I just want to understand one thing. In the Reserve Bank of India's new I would say new regime of introducing scale-based regulation, where the NBFCs, the upper tier NBFCs are treated like banks for everything, asset quality, even the liquidity LCR. Then what's the advantage of being an NBFC? Shouldn't they turn into banks?
No, I think let me put it very clearly. What's in my mind is every NBFC should be treated like a bank. See, if if a NBFC is a deposit-taking NBFC, then there is no question. It is basically public trust and public money is involved. So the Reserve Bank would be absolutely right to say, I look at you like a bank. However, wherever it is in that hierarchy, and it is lending. So supervision has to be as tight. Now, even if it is not deposit-taking, the way I look at it is, you are then borrowing from the market, or you are borrowing from another bank, or you are co-lending with another bank. So the risk is passed on to that saver in that bank. So I don't see any issue at all in the Reserve Bank. In fact, I would think that it is required. The Reserve Bank looks at it as a bank. Thereafter, I think it is for each entity to determine how, to differentiate itself from a bank and why it could be doing. See, one key differentiation as I see that's happening, Tamal, is the fact that the timing of technology. See, if you look at the first wave of technology, which say ICICI Bank put in and others, it's around the turn of the century, around 2000. Then nothing much happened. Then came cloud, 10 years later. Then came, what I would call cloud-based platforms, maybe 2015 or so. Now you've got open source and basically everything virtually free if you have the capability to build it. So if you then look at this timeline of technology and then you put the financial institutions, you will find most of the large institutions are basically that 2000 era. So you're basically running technology which is 20 to 25% old. Now people may say something different, but honestly you go into their guts, that's the technology they're running. The new course, let's say an NBFC, can run with technology which is current, which is today's technology, which is significantly cheaper, more competitive, scalable, and that's one. So that advantage comes in a significant way to all the new courses. And this is not the NBFCs alone. This is that entire cohort of 10,000 digitech companies which I think are ready to take the ball and run. So I'm not talking of NBFCs, the few incumbent NBFCs. This entire set of fintech startups are there and ready to go with technology. And they are going to be the differentiators in the long run.
So you are saying even if you are an NBFC and you are taking money bank, which is a high cost money because you are not taking public deposit, but still that can be taken care of by technology. You'll get the benefit out of the latest technology. That's what you're saying.
I'm saying two things. One is that regulator will have to have oversight on you. You can't escape that because ultimately it is the public's money.
Yes.
Second is, yes, by running technology appropriately, by using it to lower your cost and lower credit losses, then you got an advantage. And that's, I think, where the wheel is moving now.
So my last question. You are chairman of NAFED, which is the latest experiment for the infrastructure financing. You started your career at ICICI, which was a DFI, and then we found that DFI become an anachronism, they can't survive, so ICICI, IDBI, both of them converted into bank. IFCI, no, it's there but not there. Then we have the sort of experiment with IDFC, which failed. I'm not talking about the IDFC bank, the earlier avatar. And then IIFCL also, it hasn't worked. So what was your take on NAFED? How it will be different, and will it actually work, or we'll see another IDFC and IFCL experiment?
So I think NAFED is the right time for a reason. Why did we, say, take ICICI itself, in 95, 96, not continue as a development bank? We used to basically get bonds subscribed by commercial banks, which were eligible for their SLR, and our bonds were guaranteed by the government. It made no sense. We were really tapping into retail money. And there was no wholesale money. There was no real large player who wanted long-term instruments. Today the situation is completely different. You've got insurance companies, you've got pension funds, you may have mutual funds which are appropriately structured who are seeking longer paper. So that paper is available. You can issue that paper to these companies. So not only one NAPIT, but there could be more such entities that would come in. A. So the funding side, which was a constraint in 1995-96, is no longer there for an institution like NAPFED. And the capital market is well developed. So you don't need a government guarantee. You don't need to go to the commercial banks to raise this. Point A. Point B, if you look at actually the lending piece to particularly infrastructure, the long-dated structure, you're talking of 7, 10, 15, 20, maybe 25 years, banks are just not in a position to provide that sort of funding. So if they do, they carry a huge sort of risk you started off with. The interest rate risk that you talked of earlier, they or the borrower is going to have in their books. So you need somebody who can now intermediate for these sort of maturities. And there are people who want that sort of an asset on their books, pension funds and insurance and so on. And we become, that is NAPFID, and institutions like NAPFID become the intermediary. So with this 25-year segue that we have, the runway that we have, I think we need to have more such institutions which can provide this funding. And liability side is not a problem, and I think the asset side is not a problem.
Thank you, sir. Just a personal question. You said at that lunch, I'm just finding out that you said I still remember you said that you get a lot of energy because you take a vitamin tablets and some tablets, you told me that. And of course, on top of that, the green chilies. So green chilies still continue?
Other things continue, not green chilies.
Thank you.
Thank
so
you, Dhaval.
that brings us into the first session, and give him a big hand. I think we are as candid as possible.
Thank you so much, Mr. Kamath and Mr. Bandyopadhyay, for that very intriguing fireside chat, from the metaphor of chili to actually supplying blood and cutting-edge talent to the banking industry and understanding the banking operating model and the role of RBI. I think we covered all the nitty-gritties. It was anecdotal, pragmatic, and supremely insightful. Thank you so much. Thank you. Thank you so much. Ladies and gentlemen, moving on, we have in store for you another pragmatic and insightful fireside chat. And for chairing this chat, we have with us Mr. Christopher Wood, Global Head of Equity Strategy. And the fireside chat will be led and maneuvered by the Editorial Director at Business Standard, Mr. A.K. Bhattacharya. But we're going to have this fireside chat in a few moments from now. So I request you to please be around to make sure that you witness this this epic fireside chat, which is with award-winning best strategist in his stream and world, Mr. Christopher Wood. It's going to happen in a few moments from now, so I'll request you to please stay back inside the hall and witness the epicness of the fireside chat in a few moments from now. Also at this juncture, I'd request Mr. Bharat Kotaskar from Khaki Tours to please make his way on stage and tell us more about this endeavor.
Can I have your attention, please? My name is Bharat, and I am here to conduct a small session. We'll be totally conducting 4 sessions in this entire summit, which is there, 2 today and 2 tomorrow. It is about helping you guys understand Mumbai. I hope you find it interesting enough. Rest of the 3 sessions will be about, and all of these are not more than 10 seconds. 10-minute sessions which are there in between. This includes a quiz where you can win prizes. So, fastest fingers first, whoever replies. When Business Standard invited me and they told me that why don't you speak for a BFSI Summit, I was a bit taken aback because that's not what I do. I thought they called the wrong person because my wife handles BFSI compliance in PhonePe. And they said, no, we want people to know more about Mumbai because that is the theme of this event, right? So I'll do a small session on origins of Mumbai. And if you can participate in this, I'll ask a few questions in between. And if you can answer right, then there are some prizes for you, yeah? Okay, how many of you have actually seen Mumbai? Yeah, have you seen this image, many of you? This is actually Mumba Devi. Yeah, that's not a quiz question. Yeah, so when quiz time is written on top, that is the quiz question. Yeah, it's surprising that this city is called Mumbai and many people have never seen the temple of Mumba Devi, which is interesting. But how many of you have seen Bombay? Mumbai Devi, many people know, there is actually a statue of Bombay in this city. And I don't know how many of you have seen it. I'm going to show it to you and you have to tell me where is it located. Have you seen this one? And can somebody tell me where is it located?
Just put 8 and 9 on right now. वो sound का कुछ हो गया ना issue.
Check.
Not High Court. BMC headquarters. The gentleman here has given the right answer. So this statue is called Urbs Primae Indis, which means the primary city of India. I'm sorry the Delhiwalas here, anybody who is representing from that city, that Mumbai is the #1 city in India. And for last 150 years, it has been so, right? They tell you that the city is made of volcanic origin. Have you heard this? Yeah? It's made out of a volcano. Then if I tell you the last time the volcano from which this city was born erupted barely a year back, then you should have seen some lava flowing in Ghatkopar market somewhere, right? You didn't see it. So the next question coming is, I'm just showing you some proof of volcanic origin. Those in Andheri would have seen the Gilbert Hill, which shows how columnar basalt is there. Can you see the way it is? And at Ray Road, and at a place called Ray Road in Baikala, there is actually a lava flow which has been solidified, which is prayed to as Ghodab Dev or as God. So the quiz is, where is the volcano from where Mumbai was born currently located? First, Barren Island. Second, Jambulmar, which is the highest spot in Mumbai. Reunion Island, none of the above. Anybody can take a guess on this? Anybody?
1 second, sir.
D.
No, D is not the answer. Anybody? No. What did you say? B? No. C is the answer. It's basically Reunion Island. This is what the volcano looks like, and it is called Pito della Furnace or Peak of the Furnace. So Mumbai was actually born almost 5,000 kilometers from where it is today and shifted over millions of years, banging the entire landmass of India, banged into the Eurasian plate, creating the Himalayas. So the Malabar Hill on which some of the head honchos stay is actually much, much older than Mount Everest that you see in Himalayas. You would have seen something which is known as Ice Age. At least your kids would have ensured that you saw Ice Age. So Ice Age is the time when water receded. And can you see the blue, the red areas which are around? That was all land. So if you stood at Juhu Beach, the water line would have been about 150 kilometers away from Juhu Beach at one point of time. And what happened is when Ice Age was over, water came up and what were mountain ranges became islands, right? So what were peaks are different islands which are there, they don't float. So the question is, the Mumbai archipelago was originally made of how many islands? 1, 7, 23, none of the above. Any answers?
Anybody wants to raise their hand?
7?
7.
7? Anybody has a different answer other than 7? Actually, what happens is that's what the Brits told you, right? Actually, there are 23 islands. The 7 came to the Brits. And that's why you keep on learning in school that Mumbai is made of 7 islands. Now that you have talked about 7 islands, let's look at the 7 islands. They are actually mountain ranges which are connecting each other. What we have done over the past 300 years is tear down all the hills, these were all the hills in Mumbai which were torn down, and it was connected at various places, creating dikes. You go to Netherlands and appreciate how Netherlands was created. Mumbai was created in the same way. All embankments were created and new land was created. It can be seen from the black outline is what Mumbai is today. 60% of South Mumbai has been reclaimed from the sea. It didn't exist at all 300 years ago, right? And it continues. So now, this is an area where most of the BFSI originally was located in Mumbai. The first insurance companies, the first banks, everything was located here. This is what, when you were in college, if you were born and brought up in this city, you would have said, "Aaj town ja rahe hai." So this is the original town of Bombay, which is the fort area, right? The entire town of Bombay that time, 300 years ago, was just 1 kilometer long and half a kilometer wide. So if somebody works in HSBC or Standard Chartered and go to the fort area, that is the area where everything started. And I'm going to talk about this in greater detail in the rest of the sessions I'm going to do. Currently, I'm only going to ask you a question. I'm going to talk about the 3 gates which the original fort had. The entire city was protected from anybody attacking, right? And so there was very near to Regal a gate which was called the Apollo Gate after the Apollo Bandar which was there. Facing what is CSMT station today used to be B, the Bazaar Gate. You have to guess, the quiz which is there is, what was the third gate called? Which is the location where Flora Fountain stands today. Yeah, please go ahead.
Church Gate.
Church Gate. He is correct. Church Gate is not a station. It actually was a gate which stood where Flora Fountain was there. And it's just outside the St. Thomas Cathedral. Sadly, for most people, they ask, where is Cathedral? I have to tell them it is opposite Starbucks at Horniman Circle, right? So next time you are in the fort area, please start exploring. I hope you enjoyed. Our organization is called Khaki. Khaki stands for Keeping Heritage Alive and Kicking in India. I hope if you found this interesting, there are 3 more sessions that we will be conducting soon, and hope you enjoy what I did, right? So if you can give the prizes to those who are the winners, that's for Priyanka to do. Thank you.
the changes of BFSI coming in the imminent future. Ladies and gentlemen, at this juncture, I think it's time for us to get started with another discernible fireside chat. This time it's happening between an influencer and award-winning strategist who has been conferred upon the title of Best Strategist by many prestigious body, and his immense body of work has been recognized worldwide. It gives me immense pleasure to call on stage Mr. Christopher Wood, Global Head of Equity Strategy at Jefferies. Can we give him a huge round of applause, ladies and gentlemen? And maneuvering and navigating this fireside chat with him is Mr. A.K. Bhattacharya, Editorial Director at Business Standard. Over to you, Mr. Bhattacharya.
Thank you, Ridhima. Thank you, Mr. Wood, for agreeing to be part of this discussion, which I hope it will be exciting, just as your reports are. Ridhima gave a brief introduction of Mr. Wood, but I would like to add a few nuggets of information about Mr. Wood. Mr. Wood, and I feel very good about it, Mr. Wood started his career as an economic journalist and then got into the business of strategizing and advising the world, so to say, on what needs to be done with the equity markets. He's right now, of course, the global head of equity strategies at Jefferies, but one of his major, I would say, achievements was he was the first, as early as in 2005, to have predicted the American subprime crisis. So with that kind of reputation behind him, let's start our discussion, Mr. Wood. You run a weekly newsletter, and since you are a journalist and I am a journalist, you have named it Greed and Fear. And as you would know that we journalists think 10 times, cogitate, debate, discuss before giving the headline of a page or a series or a column. So what went behind in your thinking process that you called a market newsletter Greed and Fear? Why greed and why fear?
Well, it's very simple, actually. At that time, I was sitting on a junk in Hong Kong with some colleagues. And at that time, when people were discussing markets, the cliche was that markets were moved by fear and greed. Everybody always referred to fear and greed. So I just turned it around, greed and fear, because I think greed and fear sounds better. But obviously, those are the two emotions driving markets. But you only really understand the emotions driving markets if you invest your own money in the markets. So people who look, you can't understand the greed and fear unless you're an actual participant. So otherwise, you're just a detached observer.
So is there a division of how much of percent of greed and how much of fear?
Most of the time, markets are run by greed, but every now and then fear takes over. And when fear takes over, it's a more powerful emotion than greed.
At what stage the global markets right now, greed or fear?
No, global markets have been running, they're not excessively greedy, but they were greedier 2 years ago, I would say. But we're clearly in a monetary tightening cycle in America, which has been going on for some time, and the interest rates have gone higher. So right now, with world stock markets, particularly the US stock market, is ignoring, for now, this big move higher in US Treasury bond yields. So in that sense, it sort of reminds me a bit of 1987, summer of 1987, when I was in New York, when the Treasury bond yields went up a lot, and the market ignored them until they didn't. So there is a risk right now that the market at some point succumbs to these higher bond yields. I'm talking about the US market. But clearly other markets could be correlated to it.
Okay.
Yeah.
Okay. I mean, we had Mr. Kamath just before you, and he described the U.S. situation as little transitory. Would you like to add, modify, or differ with that perception?
Yeah, well, the big question right now, the big development in the last 3 months has been the rise in U.S. Treasury bond yields, the sell-off in the U.S. Treasury bond market. So the key question raised by this sell-off is what is driving the sell-off? Is it simply the higher for longer mantra, which is now the consensus? The consensus in world markets is that US rates will be higher for longer. Or is it also supply concerns entering the US bond market, i.e. the investors are beginning to worry about these rising fiscal deficits in America, because these rising fiscal deficits become much more painful if you have high bond yields, because the debt servicing costs rising. So in my view, it's a combination of the two. But the key question is, if it's only a theory that fiscal deficits are partly driving the bond market sell-off, we can't prove it. We can only prove that when we get weak US economic data. If hypothetically the next month we have a negative payroll report in the US, then there should be a big rally in the Treasury bond market. If the Treasury bond market can't rally on weak US data, can't rally convincingly, then that will tell you that supply concerns have entered the US Treasury bond market, which means that the US Treasury and the US government will have to start to demonstrate financial discipline, or they'll be punished by the bond market, just like an emerging market would be punished.
That's right. What role will US politics play in this equation?
Well, my view on US politics is neither side wants to engage in meaningful fiscal retrenchment. So that's why I think you should definitely consider the possibility, I can't prove this, but clearly there's a possibility that this US Treasury bond market partly reflects supply concerns. Because in the last 20 years, ever since the Asian crisis back in the late 90s, Asian governments, emerging markets have been practicing fiscal and monetary orthodoxy because they didn't want their bond markets to blow up and they didn't want their currency markets to blow up. But in the G7 world, the governments have become very used to doing what they want to do in terms of monetary and fiscal policy, and they just assume that their bonds will be treated as safe haven assets.
Okay.
So the US Treasury bond market is viewed as a risk-free asset by regulators. After 2008, they re-regulated the financial system, assuming Treasury bonds were risk-free assets. If the Treasury bond market is selling off on supply concerns, then it's no longer a risk-free asset. This is a very big deal.
That's right. Yeah, that's right. Let me spend a few more minutes with you on the global situation before we come to the Indian markets. As I said in the beginning, that you are the one to predict the American subprime crisis before it actually erupted. Is there something that is lurking somewhere, anywhere in the world, which makes you little concerned, worried that something may be happening and the global investors are not aware of?
Oh, well, yes, because the interesting thing about this is the biggest monetary tightening cycle we've had since the late 1970s, when Paul Volcker, former Fed chairman, crunched US inflation. So normally when you have a monetary tightening cycle, the problems emerge in the area of the markets where there'd been the biggest boom, where the most money had been paid. And then, monetary tightening exposes the problems, or as Warren Buffett once famously put it, when the tide goes out. So what's been interesting so far is the lack of problems that have emerged. But the question is who made the most money in the cycle in the US, which ran from 2009 till 2022, when the Fed began tightening. Who most profitably exploited the whole era of zero interest rates and QE in America? In my view, the answer is clear. The answer is private equity and private credit. This area has been booming much more than the area of listed markets. So the two key things to understand about this area is one, that it's almost as unregulated as the listed area I'm involved in, and I assume most people in this room are involved in, has become more regulated. The second thing to understand about this area is everybody involved in private equity and credit is incentivized to delay price discovery for as long as possible. And there's no bank regulator, there's no RBI equivalent in the US or making these funds demanding preemptive provisioning. So in my view, the credit risk in this cycle lies in that private equity, private credit area. But nobody's going to be in any hurry to admit to the problems, which means the impact of monetary tightening will be delayed. And the question is, if there's no US downturn in America, actually everybody in this world will get away with this.
Okay.
But if there is a downturn, without a doubt, the problems will emerge. But they're going to emerge with a lag.
So what you are saying is exactly we should be a little watchful about the private equity sector globally.
Well, I'm really talking US, because private equity in the rest of the world is smaller, and private equity in India has not been operating in a world of zero rates. So to me, it's much less...
So it's mostly a US
Yes,
phenomenon.
and the bulk of... But the other point to understand, actually the real risk is not private equity, but there's also private credit. So private credit was a very good, smart area to invest in 2009. I'm talking about the US here.
Yeah.
Because in 2009, the banks were heavily regulated. Banks were not allowed to do many things. So the huge gap opened up in the market, which smart people filled by providing private credit. But that was in 2009. We're now in 2023. Money's pouring into private credit. We've got it looks very attractive because they're lending at very high nominal rates, but clearly the credit risks are rising.
Already the US has seen some banks just going under.
Oh, yes.
So is that...
Well, the interesting thing, you're referring to Silicon Valley Bank.
Silicon Valley, yeah.
Now, the interesting thing about Silicon Valley Bank is that it's a very small window into what's going on in private equity, because Silicon Valley Bank was not a typical bank. It was basically a highly levered PE fund. So Silicon Valley Bank is the first glimpse of the problems which are accumulating in this space. The other point about Silicon Valley Bank is it delayed the impact of Fed monetary tightening. Because what did the Fed do when Silicon Valley Bank happened? The Fed effectively eased monetary policy. First of all, it bailed out all the depositors, many of them rich, so that sent a signal that all bank depositors in the US are now basically guaranteed.
That's right.
So that is a very aggressive form of monetary easing, but I can't quantify it.
Yeah.
The second thing the Fed did, it set up a special facility to lend money to these banks, but in a departure from normal prudential central banking principles, it's lending the money against par, collateral valued at par, not at market.
Okay.
So many US commercial banks are holding treasury bonds. Because they've said they've held them to maturity, they're not having to take a loss. But at the end of the second quarter, on those held to maturity treasury bonds in US banks portfolios, I think from memory, we were looking at losses at the end of 2Q of over 300 billion US.
Coming to the other parts of the world, Europe and of course China, how do you see these markets faring and what kind of impact they will have to the other
Well, Europe is more clearly right now looking like it's heading into recession than the US. My view is the US will have a downturn next year too. I just think the monetary tightening is working with a longer lag for the reasons discussed. And then China, the Chinese people this year have turned Japanese. So the animal spirits have been lost in China for now. And the key question, the key problem in China is psychological. It's not to do with economics. So the key question, which I don't know the answer to, is have the Chinese turned permanently Japanese or only temporarily Japanese? My hope is as the memory of the lockdowns fade, China will gradually return to normal.
How soon will that be?
Well, if you look at a chart of household bank deposits in China, they went vertical during the lockdown. So the growth in household bank deposits is gradually slowing. But probably if you want to take a long-term view of what Chinese growth rate will be in the next 10 years, I would say a conservative number would be 3%.
Okay.
So India should be growing 6-7% minimum, right? So
Okay.
that's why India is now viewed as the next big global opportunity.
So that's exactly at the point where we enter the Indian markets. And can you tell for this audience, how do global investors look at the Indian markets, the pluses and the minuses?
No, well, India is now, the consensus is now definitely embraced my long-standing view that India is the best growth story in the world, going forward, most particularly in Asia. And obviously the problems in China have further cemented that view. But if that is the consensus, the interesting point is that global investors, global equity investors, I'm not talking about dedicated emerging market investors, I'm talking about global investors, have barely invested in India. So their portfolios do not reflect that consensus.
Okay.
And even emerging market investors, we believe, are only moderately overweight India.
And your view on the Indian markets?
No, my view is my view remains what it's been for 20 years, that India is the best domestic equity story in emerging markets.
Okay.
And so you just have to be structurally invested. Tactically, India's done very well, and the mid-caps are obviously expensive. And India will be vulnerable to a Wall Street correlated correction caused by higher bond yields.
The government of India keeps talking about, 5 trillion economy, 30 trillion economy, dollar economy. You talk about 100,000 Sensex. What is this 100,000 Sensex
Well,
all
actually,
about? And how do you work this out? And at what point? What is the scenario like? Can you tell us about?
Well, apparently nobody looks at the Sensex anymore. They look at the Nifty. So I should have forgotten. I shouldn't have ever done that. But
yeah.
No, the key point to me, I look at it differently. The way I'm looking at the Indian market is very simple. Myself and my colleagues here in Jefferies Indian office, we conceptually think, we've thought this for the last 2 or 3 years, is that India is going to repeat the cycle we had from 2002 to 2009. What happened in 2002 is we began a property cycle in India, a residential property cycle, which then morphed after 2 or 3 years into a broader private sector capex cycle, which basically peaked at about 2009-10. And during that period, 2002-2009, India massively outperformed in an Asian context, and the cycle happened despite monetary tightening. So this time around, it's looking very similar because we have just entered the 3rd year of a residential property upturn here in India after a very extended 7-year downturn in residential property when income growth exceeded property prices for many years. And so we're now in our 3rd year of property upturn, which shows no sign of ending. The property upturn has been very resilient in the face of about 300 basis points of RBI tightening. and we see growing early evidence of a private sector capex cycle.
Okay.
So to me, if the private sector capex cycle kicks in, the story is any correction in the Indian market should be bought. But I want to tilt my portfolio in India more around the investment story and away less from the consumption story.
Okay. And I mean, no discussion on markets will be complete if we don't discuss two issues. One is, how do you see the role of the market regulator in India?
Well, one issue for India is I said that global funds have barely invested in India. Emerging market funds are invested in India, but there's a whole procedure you have to go through to be able to invest directly in Indian stocks. So to the extent that some institutions may find that meddlesome, over-bureaucratic, it may put them off investing in India, but then they can only invest in India via ADRs and GDRs, and you have far fewer ADRs in India than you have, say, in China.
Okay.
So that's one issue for the Indian market, the ease for foreign investment institutions to invest in India.
And there have been questions about the way the market regulator has looked at various market developments, particularly some disconcerting one, like the Adani affair. How would you look at that?
And I'm not so focused on it. No, to me, the biggest regulatory issue I've come across in India in the past year was a proposal, because India has got a highly, from my perspective, it looks like a very successful, thriving, growing asset management business. Mm-hmm. So I would say it's probably the most dynamic asset management business outside of the US, with a thriving capital market. So the domestic flows are very vibrant. We're long past the days when the foreigners moved the stock market around. The resilience of the Indian stock market during the RBI tightening cycle, in my view, was primarily because of domestic flows. So I believe a few months ago there was an issue where the regulator was trying to clamp down on fees.
Yeah.
No, I'm not an expert on this, but basically, to me, the fees, as far as I'm aware of them, in the asset management industry in India are not particularly excessive. I can remember in Hong Kong and Singapore, there used to be 5% front-end loads. Mm-hmm. Yeah. And, there were far, but so to me, this kind of regulation risks interfering with what is basically a success story. So to me, that's the biggest regulatory issue, yeah.
Yeah, before I come to the political questions on the markets, just wanted to say that Mr. Wood has agreed to answer some of the questions that the audience here may have. So I would request the mics should be distributed among them. If anybody has any question, in the next 15 minutes or so, they should raise it. So let me come to your assessment of the Indian markets, and even if it is Sensex, 100,000 Sensex, how critically dependent it is on the political developments in this country, in terms that we are going through a phase of 5 assembly elections. There will be a general election, and although the view is that most probably the ruling party will come back, but how critically dependent your market assessment is to continuation of this government in Delhi as well as in the states. Can you give us your assessment, how critically aligned with that?
Well, no. I mean, I think clearly the biggest risk for the Indian stock market is nothing in the US. Because while I'm saying that the probability the US has a recession next year, I'm not concerned that India is going to have a recession. Mm-hmm. So yes, by a long way, the biggest risk in the Indian stock market is that the current central government is not re-elected with a meaningful working majority. So I would say if there was a repeat of what happened, the surprise election in 2003, then I think the market would behave in exactly the way it did.
2004, actually.
Sorry, 2004.
Yeah.
Didn't it go down about 25%?
That's right.
Yeah, well, I would expect a repeat of that, if not worse.
Uh-huh.
But then I would say, while it would be a big problem, I think if the market down 25%, 30%, then you buy the market. Because the reality, this government has put through a lot of fundamental reforms which will be hard to be undone. But there will be a big correction. And I think particularly from the domestic investors.
Yeah, but there is a view that the inherent strength of the Indian markets and the Indian economy are such that even though there is a temporary correction,
No, I agree with that.
essentially the markets will bounce back.
No, I agree, but no, I completely agree. But I wouldn't want to own the Indian market on leverage before the election.
Okay, okay.
Because the message from 2004, because if my memory is correct, nobody expected that result in 2004.
Uh-huh. Okay,
Correct?
okay, okay.
But I agree, the momentum is such that it will bounce back, that there will be a big correction. But obviously that's very much the unlikely outcome, but we have to admit that that risk exists.
Is there anything that you would like the system, whether it is in the government or whether in the market regulator, that you would like them to do to sustain this momentum in the markets?
No, I think the key thing for, to me, as I say, the market situation here is thriving, the domestic capital markets. So my view is if it ain't broke, why fix it? I think the issues are more to do with making it easier for foreigners to invest in equities. I think India is now being included in the Indian bond, in the bond index. So that will help flows. But if I'm saying this is the best market to invest in globally, it's obviously a problem if there's a very cumbersome procedure to be able to invest directly in India. Most emerging markets are much easier for foreigners to invest in than India.
That's right. Yeah.
You don't have the equivalent of the FII
That's
status.
right. If there are any questions from the floor, yeah, please go ahead. Identify yourself.
Good afternoon, Mr. Woods and Mr. Bhattacharya. I'm Nidhi Kanoi from Millennium Mams. You mentioned that India's investment story is far bigger than the consumption story. Could you elaborate a bit? Because we are all gung-ho on our consumption story here.
No, they're both very big, but just as drivers of GDP growth, if I showed you a chart, fixed capital formation has been in a downtrend as a percentage of GDP since 2010 to about a year ago. And there's early signs that fixed capital formation as a percentage of GDP is beginning to pick up. And from 2002 to 2009, we had a big rise in fixed capital formation as a percentage of GDP. So I'm not saying consumption's bad, I'm just saying consumption as a driver of growth will decline relative to fixed asset investment. I'm talking about the private sector. But obviously under this government, a positive point, which has been that while this government has been running quite big fiscal deficits relative to most emerging markets, the big saving grace of that is that most of this fiscal deficits have been going on capital spending to improve infrastructure, not on what I would call entitlement spending, which obviously in most of the fiscal deficits in the G7 world are primarily on transfer payments. So, yes, sir.
Yeah. Hi, good morning. Thanks, Chris. Thanks for sharing your valuable insights.
Sure.
Myself, Pawan Goel, I'm coming from investment banking earlier in JP Morgan and Credit Suisse. And my question to you is, considering all these growth stories and all, the impact which the Indian startup story, which has been coming on the back of India Tech Stack, India Pharma Stack and all, how do you see that will contribute into the future equity growth and the new IPOs and new kind of, like the Flipkarts and all?
No, startups are booming everywhere. so the startup, I heard that I heard someone give a speech a few months ago saying that when they were in college, it was the cool kids had guitars. This was a baby boomer talking. Now the cool kids are in startups.
But we have seen the Flipkarts which is being bought by Walmart.
I was in Tashkent actually a week ago, of all places, and you know the startups are booming in Tashkent. But we have to, all this is great, but we also have to understand this whole startup culture originated in the US, and it originated in an era of zero rates. So while the startup thing is fantastic, and there's a lot of ideas, there's going to be a lot of, with these higher rates, there's going to be a lot of casualties, because you know, you can't have the same burn rate in a world of higher rates than you have in. But the big difference in places like India is the startups began in a world with real interest rates as opposed to zero rates.
Okay.
Thank you.
Yeah, yeah.
Yeah, please go ahead. No, you're not.
I can't hear.
Yeah, Mr. Wood, great insight. Question. With a country like India, now the unorganized sector, which is not, the small vendors, MSME, is coming into the capital market. Mutual fund statistics will show that the more and more participants are in the capital market, which will eventually responsible for the India's growth story. The India is robust economy because of the small sector, micro sector coming to the small vendors. Is that a scene in US where the recession is falling? You think that when the MSME sector comes into the mainstream, start investing in the capital market, small vendor on the state, who's also on his income is not taxable, but he's coming to the capital market by way of SIP and SWP. You think the country will come out?
What you are asking is that will MSME sectors coming into mainstream?
Mainstream will make a difference to the country like Russia or wherever, and country like US where there is a recession.
MSMEs coming into a mainstream in the Indian market as a bigger player will make a qualitative difference to the approach of the US markets to India?
There's a large unorganized market in India. That's the reason.
You know, the large unorganized market,
Yes.
which is in the small and the MSME sectors, if they become mainstreamed, then will that have a positive impact on the global market investors' perception of India?
I don't think they're not too focused, or they're focused on the big caps. But obviously, the positive issue in India from a tax revenue standpoint is the successful introduction of GST has brought many smaller companies into the formal economy, my understanding.
That's right. That's right.
And also we have this digital infrastructure, but the big global portfolio managers only look at the big cap stocks because of liquidity concerns.
Yeah.
Sir, I am Hemant Joshi. 25 years ago, we have a 30-day settlement by the regulator. Equity side, 30-day settlement. Today,
there was a 30-day settlement for on the equity side by the stock market regulator.
25 years
ago. The settlement of deals would take a 30-day time. 25 years ago.
25 years ago.
Today, sir, we have T+1 settlement. Regulator in a mood to go for a live settlement. What is your views for the Indian condition for live settlement?
Live settlement. Your views?
I haven't got a strong view. And I wasn't aware of that point, actually. So is that bad? Is that bad?
No, I think
no, sir.
There are risks involved.
Sir, I respect for the regulator, the news and the reporting from all the newspaper. They are in the mood, and lots of things is in the paper. There is no official communication. Only thing is the equity side is regulator is thinking, exchange is thinking that T+1 is okay, very comfortable for the last 25 years.
Yep.
But today, their regulator is in a mood from NISM, all the securities from Reserve Bank of India and all bank and participation, live settlement. What is your views?
Yeah, I mean, he is asking your views that if it becomes live settlement, will it make any big difference or will there be an issue?
Well, I'm kind of curious as why they want to do that, actually. I didn't know that. Why do they want to do that?
Well, discovery, the earliest discovery and settlement.
From a purely free market standpoint, that would seem to be positive.
Yeah. Okay.
Thank
But
you.
I wasn't aware that they were pushing for that.
Yeah.
Thank you.
My biggest concern on the regulatory front is this whole assault on fees, because I've seen the damage done in the Western world by pushing down on investment fees more and more, because at a certain point you can no longer finance research or anything. So that's my biggest regulatory concern.
Thank you very much.
Okay. And we can take 2 or 3 questions more. Yeah, please go ahead. Yeah, okay, go ahead.
Yeah, good afternoon, sir. I'm Neville, and I have a question related to US equity market. You know, I currently invest in US equity market via direct stocks. So what are your views for, say, if it's long term, which is the best sector, which is the promising sector if you take a 5-year view?
Okay, I think I would, you're talking US stock market, right?
Yeah.
No, I would recommend a barbell strategy of owning 2 different extremes. So you own the big tech stocks which you believe are genuine AI beneficiaries, because there's a debate which ones are and which ones are not. And then the other end of the barbell is you own energy stocks.
Energy stocks.
Yeah, so I would own so let me just put that in specific stock terms to make it easier. That would mean you would own Nvidia and Microsoft, and you would own Exxon and Chevron.
Okay. 2 more questions, please.
Thank you so much.
Mike? Yeah.
Mr. Wood, my name is Ash Bishnoi. Just a quick question. India has made a bid to become an offshore financial center with the starting of the GIFT City in Gujarat. Do you think this is a strategy that's got legs, given that we have financial centers in New York, London, Hong Kong, Tokyo, Singapore? Does this strategy, do you think it has legs?
Frankly, almost every country in the world has that strategy.
Yeah.
So that's the reality. So the point is, offshore financial centers, financial centers like that lend themselves to places like Hong Kong, Singapore, Dubai, which have specific jurisdiction, tax advantages, and are genuinely like offshore.
Yeah.
So to me, there's too many of those. So in the Asian space, or in the Gulf, clearly the dominant, the offshore financial center which has made the most progress in recent years relative to others, I would say, is Dubai.
That's
where
right.
you've seen a lot of people move from Hong Kong, Singapore to Dubai. I was just in Dubai. That place is booming, and it's a genuine financial center, because there's no tax. That's the key driver.
Okay.
And there's a lack of what I would call over-intrusive regulation. That's what drives financial centers, yeah.
That's right. Yeah.
Hi, Christopher. Good afternoon. This is Balram. I have a question. If I've understood 2 things you have mentioned, one is that geopolitical condition in Israel, that has not been priced in by market. Also, you have mentioned that the mid-cap stocks are highly or bit expensive in India. But since Israel issue, we have been finding that the Indian markets are getting corrected, typically the mid-cap. And you say it has not been priced in. Why do you think so, and what do you think the future in terms of?
Well, this is the Israel thing you are saying that has not been priced in.
No, I don't think this issue, I think the markets are assuming that, look, this is just my own personal opinion, but I don't think the markets have not priced in a broader Middle East escalation. So the markets are hoping that it won't escalate, and the markets are hoping that it will remain constrained to Palestine. So right now the question is has a full-scale ground invasion been launched or not? It seems to be it doesn't seem to be as yet what I would call a full-scale ground invasion. But if it turns into a broader regional escalation, there's no way this has been priced in. As you can see, the oil price has barely risen. Yeah.
One final question.
Yes, this is Dr. Bharat. And I was pleased to hear when you said China, you are factoring about 3.5% of growth for next 25 years, wherein India is going to grow about 6-7%. In spite of you very clear saying like foreign investors, they have not come in a big way, the way they are supposed to. Mostly emerging economy investors are investing. So my question is, India has been doing quite a lot in terms of fundamental corrections. Some regulatory aspects are being taken care of to build a lot of confidence for the investors. How long they will take to shy away from the Indian market? Because this is the real story going forward. Thank you.
Well, how does one, the Indian markets become more attractive? How long will it take? I mean,
No, I think part of it is that global money a lot of global money was investing in China, and basically in the last year, global money no longer wants to buy China, and the global money has been selling its China exposure. So as a result, the only people owning China now globally are what I would call dedicated Asian and emerging market funds. So all that money that was going into China has the potential to go into India, but India is still a very small part of the global index. So they don't have to invest in India, but they're looking at it. So this year we're seeing more global money go into Japan because it's not investing in China. But it's clearly an opportunity for the Indian equity market to attract global equity investors and not just dedicated emerging market investors. And all these global funds are now looking at India more seriously. But there is this technical issue that you have to get FII, you have to apply for FII status.
thank you. Thank you. I think we have completely run out of time. Okay, fine. Go ahead, quick.
My name is Sandesh. And dollar rates are decreasing every year. So what is about that?
Sorry?
Dollar rate is decreasing every year. So what about that?
Dollar rates are decreasing. Dollar rates are decreasing.
Which rates?
Dollars.
The interest rates aren't decreasing.
Compared to Indian rupees.
Vis-a-vis the Indian rupees.
Well, the dollar's been appreciating.
Yeah, but
the dollar will continue to appreciate until the Fed changes policy. So in my view, the key question is, what does the Fed do if we get a weakening in coming months in the US labor market, while inflation is still above its 2% target? So the key issue is, what does the Fed do when it has to choose between its inflation mandate and its employment mandate? And in my view, given the political pressures and the fact that it's a presidential election year, when the Fed has to make that decision between inflation and employment, the Fed will prioritize employment, and that will send a signal to the markets that the Fed's not going to enforce its 2% inflation target. That will then send a signal that inflation in the US is likely to settle in the 3, 4, 5% range, and that will be negative for Treasury bonds, which will then renew focus on what I discussed earlier about how sustainable are US federal government borrowings if bond yields are 5%, not 1, 2%.
okay, I think we have come to the end of this session. This session could have actually gone on and on with the kind of interest that Mr. Wood, your comments have generated. But I cannot resist in the temptation of asking you one question, which is particularly with regard to Indian policies, and that is that do you see any external sector risks upsetting the Indian calculations vis-a-vis the governance, economic policies? External sector, because after all, India's FPI investments are not flowing in as much as it was earlier. FDI flows have sort of slowed down.
FDI.
Yeah. So the external sector risks, and how would you look at tariffs going up and the production linked incentive scheme playing out for the productivity, efficiency, competitiveness scenario?
Well, obviously the hope is that the PLI scheme set up by this government, if the government's re-elected, my base case would be that there's a there's a good chance that you can get real momentum on these PLI schemes and really attract manufacturing investment into India. Clearly, there's very good news that the government has this scheme in place. I think you need the government re-elected for the scheme to be run properly. But the other good news from an Indian standpoint is that all these multinationals, from Apple down, have to hedge, can no longer afford to have all their production in China, even if they want to. If you're Apple, you run the risk of waking up one day and being ordered by the US Congress out of China. So in my view, given that India is the next big domestic demand for the next big domestic market for the next 20, 30 years in Asia, India only has to be as good as 70% as good as Vietnam, Thailand, Malaysia, which are the other people going for this manufacturing investment to get the business. So I think this is a real, so to me this can happen despite the move against globalization we see globally,
Okay. Thank you very much. And we end this session on this happy note. Thank you for being so patient, so candid.
Thank you.
And thank you very much. Back to you.
It's not working. All right. Thank you so much, Mr. Wood and Mr. Bhattacharya, for this highly pragmatic fireside chat. We discussed the nitty-gritties of how the Indian landscape is actually viewed by global investors, the impact of Silicon Valley banks, credit risk rising, the interspersion of different forces that actually impact the monetary policies, and the entire landscape of global and domestic investment as a whole. Ladies and gentlemen, with this, we come to the culmination of the second fireside chat. We are going to have a panel discussion at sharp 12:15 p.m. I'll see you then. And once again, can we give a huge round of applause for Mr. Christopher Wood for that highly anecdotal, engaging, and most importantly, very candid perspective sharing from a very pragmatic and practical application point of view. So thank you so much. of will global slowdown and 2024 general elections weigh on Indian markets? And this kind of topic definitely poises to incite shift in market dynamics with optimism and a bit of skepticism as well. Now, to navigate this conversation and moderate the panel discussion, we have with us Mr. Tamal Bandyopadhyay, consulting editor at Business Standard. And joining him on the illustrious set of panel members, we have with us Mr. Sankaran Narain, CIO, ICICI Prudential Mutual Fund. We also have with us Mr. Mahesh Patil, CIO, Aditya Birla Sun Life Mutual Fund. We have with us Mr. Rajiv Thakkar, CIO, PPFAS Mutual Funds. Mr. Rajiv Radhakrishnan, Chief Investment Officer, Fixed Income at SBI Mutual Fund. We have Mr. Shailesh Rajbhan, CIO, Equity Nippon India Mutual Fund, and Mr. Ashish Gupta, CIO, Axis Mutual Fund. So with this stellar lineup, I think we should get started.
Thank you, and good afternoon, and welcome to the session just before lunch, but it's pretty exciting session. I think food can wait. Quickly, the discussion, we have seen that will global slowdown and 2024 general elections weigh on Indian markets. So we have 6 of them, and roughly a little over 50% of AUM, asset under management of the mutual fund industry, which is 47 trillion plus, 47 lakh crore, close to 47.5 lakh crore. These 6 gentlemen represent that, 50% of that. So give them a big hand. They are here to discuss market, elections, impact, and all everything. So we will take a few questions also from the We'll take a few questions from the audience as well in between, so keep the microphone ready in the audience, and please don't ask for any stock advice, where to invest. Okay, that you can do over lunch or something, but not here. We will not discuss any particular stock. So let's come back to the session, which is where are we heading? Just the latest news is the JP Morgan last week upgrading Indian markets to overweight from neutral to overweight. And who are the others? Morgan Stanley, CLSA, Nomura, everybody is raising Indian exposure. Reserve Bank of India governor says India is the growth engine for the entire world. JP Morgan analysis says Indian markets have generated positive returns ahead of general elections. Nifty has generated 13% returns in 6 months leading to the general elections since 1991. Now, I have done a little work, and here I will end because you have come to listen to them. I have done a little work since 1991 general elections, how the market behaved. Now, 6 months prior, 1991, when the majority government came, 6 months prior, it was minus 2.4%. I'm not talking about the polling result day, I'm talking about 6 months ahead of them, 6 months leading to the market. 6 months post-market, 1991, when India embraced economic liberalization, market rose 42.9%. Post 1 year, market rose 1.5 times, 146%. And post 5 year, market rose close to 30%. That was 1991. 1996, coalition government leading to election, 13%, 6 months. Post-election, disappointment, 16% minus. 5 year, flat. 1998, again coalition government, prior 6 months, 20% minus, post 6 months, 11% minus, post 5 years, almost flat, 1%. 1999, again coalition government, prior 6 months, 30% plus, post 6 months, 20% plus, but 5 year, 5.3% plus. 2004 coalition government, 6 months prior 19.8% plus, 6 months after 1.4% minus. Over 5 year, market return is 14.7%. 2009 coalition government, but minus the left support. Run up to the market 3.5% because market was a little wary about left support, etc. But when the Congress came with on its own with others and minus the left. Market thought reforms will take place. The roadblock has gone. So post 6 months, 53.7% market rose. 1 year, 57.6% market rose. And post 5 years, 16.2% market growth. This is the best 5 year for the market. 2014, BJP-led majority government came. Prior 13.7%, 6 months. Post 6 months, 18.3%. And post 5 years, 13.2%. Finally, 2019, majority BJP, what was expected. 6 months prior, 13.8%. 6 months later, 1.7% minus. 1 year later, 20% minus, but we should not think about 20% because that was the COVID impact, so let's not discuss that. And till now, till September, it's about plus 14%. So overall, if you see from 1991, the best market performance post-election 5 years is 1991, 5 years, because 1 year, that's the Harshad Mehta scam time, you have to remove that like we need to remove also the COVID impact. So 1991 was the best, close to 23% 5-year return, and 2009 was the best in terms of post-election, 16.9%. So the general question for everybody, we'll start from you, Salish, that it seems that markets, both in anticipation and interpretation, there is no logic for the market. So 2014 election is knocking at the door. Of course, the state elections ahead, and after that, the central elections. So tell us, what's your expectation? Of course, the volatility is there for different reasons at this point of time, even though some corner says, no, it's in anticipation of election results also. Dalal Street only saying that, some people. Sure. But we believe more for geopolitics and other issues. Here I stop, and over to you.
Thank you. Good afternoon. See, elections, like you rightly said, markets never get it right. And even if they get it right, the only base thing which counts is what is the starting level of the market. If the starting level is low, everything is sorted out. Whoever comes to power beyond the point doesn't matter. But if the starting point is wrong, markets have disappointed very, very significantly, even if you have the results which are favorable from a market policy point of view. I think where we are today is we are in middling markets. Markets are not very cheap at one level. At one level, they are cheap on the larger side of it. At another level, they are not very attractively priced because there's a lot of expectations. In fact, the short-term expectations of investors is what worries me the most, because the long-term everything will be good. I don't think there's a problem from that angle at the moment though. But I think the challenge today is near-term expectations of whether it's earnings, whether it's expectation of returns people have. So I don't think there's anybody in India, especially investing in small and mid caps, who doesn't expect 20-25% kind of compounding returns. That is the kind of mindset people are investing with, which I think is a problem. So elections or no elections, this is a challenge. And if you have some uncertainty because of that, I think it could be a very different market environment we will enter into.
Ashish, there's no point in being diplomatic. Just khullam khulla bolo boss. They want to know.
So I actually get one insight from the data you quoted, right? So that there is no direct correlation of election results to the market over the long term. So first 6 months, post-election 6 months, market performance does get impacted. Of course, there is volatility around elections. But I think what longer term matters, the 5-year returns that you quoted matter, is what is the economic progress during that period, right? So how are economic policies that are being framed beneficial for the markets or not? So I think that is the main point. Historically, there have been concerns whether a single party comes in power or the coalition comes in power, and there could be different outcomes for the economy. But history has proven that also not to be true. So even some of the coalition governments have actually had most forward-looking economic policies. So I think we should not really worry about what happens immediately post-election, how market reads the election results, but worry more about what does the long term look like. Of course, there is enough reasons for the market to be volatile in the near term. Shailesh spoke about high expectations. There is, as your topic also says, there is increased global uncertainty, not just in growth, but in geopolitics. So I think we need to be mindful of that. And I think to me, those are really factors that are more front-end central in our investment thesis today rather than elections.
Naren.
Actually, one common thread which we could clearly see is volatility. So from an investor point of view, it became very simple for us to recommend hybrid funds ahead of elections because that's the best way to play volatility ahead of elections. Because, and that too, the starting point of markets today is not that the markets are cheap. So you get a combination of, valuations not being that cheap and volatility ahead and long-term being good. So the combination worked very well in terms of recommending hybrid funds. That's what we've been doing recently. And I think that's the only way to do at this point of time, given the global backdrop, high valuations and volatility ahead. Because, and your data also shows that it is impossible for people in Bombay to predict elections, impossible for fund managers to predict elections, and it's impossible for markets to also predict elections. And I have seen it as a fund manager in 2009. The most volatile period for market I have seen in my life was May 2009. And no one would have imagined the kind of returns that happened in May 2009. If you looked into May 2009, no one could have predicted. So that's why we came to this view that the best way to play it is hybrid. And you're able to recommend it to investors more comfortably and have less stress from an investor point of view.
Thanks. So, yeah, Rajiv.
Yeah. So I do understand and recognize that financial markets do consider elections as an event risk, and there's a lot of lens and focus on what the outcome of the elections are going to be. But when you look at in India, say in the recent history, the redeeming factor is elections have not necessarily led to any significant change in economic policies. And I think the same thing applies today. As Naren mentioned, it could create intermittent volatility, but to the extent that there is no directional change in the macroeconomic policies being pursued in the country, it should not necessarily impact financial markets. So I think over a period of time, it's largely the macro fundamentals that should play out, and financial market outcomes will be a function of that. So I would say that it's just an event which potentially could create volatility, but unless there is a directional change in the policies, it should not affect markets.
Yeah, whether you look at India or abroad, be it 2004 elections, 2009 elections, or the Trump-Clinton election, or the Brexit referendum, financial markets have got it wrong all the time. Firstly, we do not know what the outcome will be. And even if we knew what the outcome is, we don't know how the financial markets will react. So the only use for a panel like this, making any proclamation on election outcome, is to use as a contra-indicator. As if there's a group consensus, then probably do the opposite of what we are saying. And your data was very helpful in terms of pointing out that there's no clear correlation between elections and market outcomes. So 3 months before, 3 months after is what the impact largely is. I'll stress a bit on something that Shailesh mentioned at the beginning. The starting point matters a lot. And again, he mentioned we are not in a cheap territory. We are somewhat above average valuations. This combined with the fact that at least in the developed world, we are at 2+ decade high level of interest rates, there has to be a meaningful impact on equity valuations, which at least so far I am not seeing signs of. And again, it was mentioned that expectations are running very, very high. I think these are bigger worries in my case than the worry that I have around the election outcomes.
Thank you. Sir, over to you. Last one on this round.
Yeah, so I think most of my colleagues have already talked about that. It's very clear that elections outcomes, at least in the short term, there could be volatility, but it doesn't really matter in the medium term. And the good thing is that this time around, I mean, we have done a lot of the basic reforms, okay, policy reforms which needed to be done in the last 8 years. So that should not really, because normally in election you want stability to really push ahead with larger reforms. So I think that heavy lifting has been done. So to that extent, I think it will not really matter much. That's my feel, because any new government comes in, okay, will continue with the same reforms. I think we are in a much better shape at this point in time, and that should be able to endure the momentum, okay, what we carry in as an economy going forward. Obviously, the real risk volatility is coming in from the global front. I mean, that's where the bigger concerns are, whether it is global slowdown or the high interest rates. And that's going to be a part and parcel, I think, whether it is pre-elections or post-elections. And I think markets are fairly priced at this point. They're not expensive, so we're not really getting into a big expectations. Last 2 years, the markets have been kind of flattish. So I think it will take its own course depending on how the fundamental economy does. I think that's how one should look at it.
Thank you. So all 6 of them, which is representing 50% of the mutual fund industry, are unanimously saying that market is apolitical. I mean, it doesn't matter. Economy, that's what matters. Growth, that's what matters, right? And what is the market does is it becomes more volatile during this period. And you have been pretty specific that this is the time to go for hybrid funds. So talking about volatility and talking about market is overheated, again, I have done my homework. You can see that. So this is a 10-year overseas, how the Indian market has behaved vis-a-vis some other markets. Just a few pointers I would like to say. Between 2013 and 2023, but not till today, it's before the volatility started, about the first week of September. And now, US has given the maximum return, 11.9% in the last 1 decade. Followed by Taiwan, 11%, and India is just short of 10%, 9.9%. And then come China and Japan, 4.7% each. That's the market return. So they're talking about that we are extremely overheated, etc. If you see over a period of time, over a decade, it's not the question, not that. But when it comes to volatility, Indian market is pretty volatile. The volatility percentage, China takes the cake, 23.9% volatility. Korea followed 21.8%. Taiwan 19.5% and India 19.3% volatility. So in terms of volatility, like US, etc., much less than India. It's a very volatile market, and over a period of time, if you say 10 years, a decade, market return is not that great. So in that context, again, all of you, I would like to ask you, forget elections now. We are seeing the external what's happening in geopolitics. First, last 2 years, we are talking about Russia, Ukraine, now the new things added in the Middle East. And now what's happening in the US and the developed market, the interest rates so high, what's going the US yield. All these things are making it it's a very deadly cocktail. And of course, China is another animal. We don't know what's happening in China. And those who have been recommending putting money overseas and all, they are now having a relook and winding down their China, etc., kind of things and all. So at this point of time, what would be your advice? I mean, how do you approach the market? And tell us, because many of them are investors. We'll see the other way, starting from you. And then we'll get into some specific questions. This is also general round. And after this, we'll take 1 or 2 questions from this after this round. So please get the mic done and prepare your question.
Yeah, so you're right. I think in the last 10 years or last 15 years, if you look at the developed market, especially the US market, has done much better. I mean, coming out of the global financial crisis, where the biggest problem was, I think the whole liquidity-driven rally which was there, right? The central banks pumping in money, and it's the whole money power, which led to not only buoyancy in the economy also, but in terms of the markets. And we have seen low interest rate regime for a long period of time. I think that is something which is now ending. We are seeing now globally central banks trying to tighten, rates have hardened. So I think the bigger risk lies on the global side, right? Especially the developed markets. And in India, we never see really that kind of pumping of the economy which was there. Right, even during COVID also, okay, we've not had kind of a huge money which was thrown out. So what we are seeing is in India is a much more steady, sustainable recovery which is coming through. Again, as I mentioned earlier, there are a lot of reforms which have happened which has laid the foundation for that. And for me, it looks like India economy from here on should be able to chug on pretty steadily. From here, we might not grow at a very high pace when the global economy is also likely to slow down. But there are enough levers, right, in place for Indian economy to continue to grow at, say, around, say, 6.5% or so in that region. We're also seeing that the investments as a percentage of GDP, which was lagging for the last 10 years, right, is now starting to pick up. So earlier it was consumption. We have the second leg of the economy, which is coming through. Again, thanks to domestic manufacturing, China plus one, blah, blah. All this thing is going to sustain the economy. And so I think in my mind, there is no doubt that India should do relatively better than most of the large economies. And if that happens, our market should also do well, right, in that context. Obviously, as you rightly mentioned, there are a lot of concerns which are there, geopolitical risks that will lead to volatility. And this is a market where if you are clear about the long-term picture, I think any correction in the market because of whatever global factors, I think should be used as an opportunity to buy because that makes your entry point much better. So clearly it's a buy on dips kind of a market at these levels, slightly cautious, right? Some of these mid caps, small caps, but if you look at the larger cap space, it's not that expensive actually, right? Many of the stocks have not performed while their earnings have caught up. So there are interesting opportunities in this market even at this point also, I would say.
Thanks. Over to you. And, along with all the global headwinds, also we are seeing the record outflow. The past 6 months, it's a decadal high, the FDI outflow.
Sure. So when we are looking at the current environment, and since we are discussing global uncertainties and things like that, the logical thing that a lot of people do when it comes to investments is they start focusing domestically. They start investing in sectors which are Indian consumer facing and things like that. The challenge for that kind of a approach is that the starting valuations in that space have become very, very excessive and they have remained elevated for a very long time. So it may seem counterintuitive, but that is the space where I see the maximum risk. Things which are Indian consumer facing and where everyone is betting that India's consumption will keep growing. The other space that I see is somewhat worry prone is the newer startups getting listed and where as of now there may not be a clear path for profitability or they may just be about breaking even. So sure, 1 or 2 or 3 companies out of that will succeed down the road, but as a group I think they will or they are likely to disappoint the investors. On the flip side, spaces like the financial which have not performed, it was mentioned large caps have not performed, same way financials and a few other sectors have not performed. So those spaces one could look to invest in. Even taking a step backwards, I think after a long time, we are now in a scenario where medium-term interest rates are positive on a real basis when you deduct inflation. So people who have messed around with their asset allocation, put fixed income money in equities in the hope of getting some kind of cash flow, should take a relook and rebalance and not be overextended in equity because debt yields have also turned attractive recently. You mentioned about foreign outflows. Now, that when we combine the decadal return in dollar terms from India, which is in single digits, and where 10-year government bond yields in the US are touching 5%, definitely there is this relook in terms of how much money to allocate to emerging markets and those kind of things. So that is playing on the minds of global investors rather than any India-specific factors.
Okay. Ready? You should feel happy because you manage debt and he's saying that there's a time to put in money in debt because debt is giving good return. Anyway, quickly on the global headwinds and where are you positioned?
So lower interest rates and a very, I would say, stable geopolitical backdrop probably was a default equation, default factor that we sort of have been used to over the last 15 odd years. I think these are two things which are going to change. For one, I think incrementally, given where interest rates are, I think the basic thesis today is that global rates will stay higher for a bit longer. So that, plus the fact that today geopolitical frictions have come to the forefront. We saw that last year with Russia, Ukraine, now whatever is happening in Middle East. So I think these are two factors which probably need to be seen, given that that will impart a lot of spillover volatility in our financial markets. You mentioned debt, so I think I'll, from our market perspective, at this point in time, fixed income seems to be in a very sweet spot. After a long period of time, there is clear visibility that one gets a positive real rate on a prospective basis, whatever inflation estimate that you may take into. So I think that is something very attractive at this point. Of course, the RBI policy stance is likely to stay in a tightening mode, or at least on a cautious mode for some more time, but it very clearly opens up opportunities for fixed income investments in India. On equity side, I think my co-panelists are experts on that, but I think there are issues with respect to valuations that we keep referring to, but from a longer term perspective, there are a lot of positive factors in place in India equity markets as well.
Thanks, Rajiv. This is new SBI. Doesn't miss one single opportunity to market his own product. Go. Naren.
10 years back, when we used to go to Delhi, I used to tell them, you have had 1 decade of huge returns in real estate, be careful. So now you had 1 decade of huge returns in mid and small cap. So if Tamal mentioned 10% return in large caps in 10 years, actually the return in both mid cap and small cap is more than 20% per annum in mid cap and small cap index over the last 10 years. So once you get 20% per annum return for the last 10 years, automatically that asset class becomes extremely favorable for all new investors. All of them flock to it, just like 10 years back, everyone flocked to real estate all over India, actually. And that's the risk at this point of time. People look backward. If you look at small caps in US, last 5 years return is close to 0. So it's not that if 10 years back, if you had gone and told people small caps is the best asset class for the next 10 years, or mid caps is the best asset class for the next 10 years, people would have said, no, it's large cap, it's only large cap, it's only large cap. But once 10 years of 20% return has come, everyone flocks only to that asset class. And just like real estate 10 years back, today it's become small and mid caps, and that's the zone for worry at this point of time. Otherwise, if you look at large caps, what has happened is there's been so much selling by FIIs in the last 2 years, except a 4-month period this year, that many of the mega caps, have just stopped going up. So if you look at the 2-year return in mega caps from October 21 to October 23, the return is some 3% per annum, and most of the mega caps have delivered negative returns. So relentless selling by FIIs have ensured that the mega caps have given 0 return in the last 2 years. Once you get 2 years of negative returns or no returns, people say, what is this mega caps? Why should I have all these mega cap big companies? They will never deliver returns. So today the tough task for us is to tell people these mega caps are not bad. These small caps are not as good as what is made out to be. And that is the challenge of investing. And and to communicate that and get people, like 2 years back, 3 years back, it was such a tough task to tell people that anything other than quality can also do well, and even PSUs can deliver returns. So the last 3 years have shown that quality doesn't need to deliver returns, and non-quality, as it was defined then, as though PSUs are not quality at all, or many of the non-quality stocks like telecom or power and all these sectors now delivered such stupendous returns that today now people say no, quality won't deliver returns. And that's the beauty of investing. And if it was not there, it would not be, it would be difficult for us to come every day to look at the markets, because what was totally unpopular 3 years back have become very popular today. What is totally popular 3 years back has become
the reverse today, and that's what makes investing very interesting, I think.
Thanks, Naren. You're calling a spade, so Ashish, quickly.
Yeah. So I think you highlighted a few markets and you looked at their returns and volatility, right? I think another parameter to look at is the breadth of that, right? So I don't have the data for 10 years, but if you look at the US market for last 2 years, 80% of the return has come from just 5 stocks, right? So that market has done well, but it has been a very, very narrow market. And in fact, India has been inverse, that the market breadth has been very positive. And as was just mentioned, in fact, some of the large cap, mega caps have actually underperformed. So I think what is important to look at, not just the headline move in the market, but also the breadth of the market move. I think really it also underscores the health of the economy, that you are seeing broad-based move in the market. There is this often asked question about large cap, small cap. There are multiple reasons for this. One, as Naren mentioned, is technically very true, that with global interest rates, risk-free rate at 5%, foreign flow has turned negative. They own more than a third of the Indian market, and really most of that ownership is in these large mega caps. So obviously these have not performed. But equally interesting to see is that even in terms of the earnings growth in the past couple of years, some of these sectors like IT services, some of the conglomerates, etc., have not delivered earnings growth, which some of the companies coming out from the smaller market caps. So for example, if you look at hotels, real estate, industrial companies, manufacturing companies, they have been able to deliver in the past. So I think at the end of it, we have to go where earnings growth is going. And whether it's a large company or a small company, if it is going to be able to deliver the earnings growth, then we can be optimistic about its performance.
Thanks. Salish.
I think
we'll take questions from the audience, 1 or 2. If you are there, just get the microphone, please. After this, quickly, very brief question. These 2 gentlemen who raised hands, get them mic, very brief, after Salish talks, not now. Please.
I think the largest of the largest companies in India are cheaper than the smallest of smallest companies in India today. And that clearly signals that there's sensible value lying somewhere else. In fact, 4 years back, we also had very narrow markets where top 5, 10 stocks account for all the returns. All those companies today are those forgotten blue chips. Like people talked about mega caps and all that. They're all there available at, I would say, companies which are considered growth companies today are available at value companies' valuations. So I don't know how to define this, but I think this just tells you how dislocated the markets are. And that is where all the alpha opportunities are available for us. So that's what I just want to say.
Okay, thank you. So I think it's a pretty interesting thing. Naren, thank you, and everybody else. What he said is this. And Naren used a very, very interesting adjective for PSU. He said even PSUs. So that was the approach of the market earlier. That even he's saying that even PSUs are delivering returns. So that's that's the current context. And of course, it's the run for the it's the run for the small caps and mid caps. If you have seen for the past 2 years, and some of the mega caps, we are not going to name them any particular entity. They are typically we used to say if you have a solid business model, you have a steady growth, and you have a good governance, good board. These are the money to put in. But you have put in, we can at least 5, 6 companies we can name. You have put in money in the last 2 years, you have not got anything, right? So it's a puzzle kind of thing what's happening. Other part is this, we are talking about this is the time to get into debt, etc., and the hybrid front to overcome the volatility. We'll get into that little micro things little later. But before that, let's take 2 or 3 questions. Very brief question, introduce yourself, and no observation, just question.
My name is Heman Joshi. My question for the team is your views on the current and the next MPC members' views.
Can you repeat?
My question, next upcoming RBI members MPC policy views for the market.
So you are the person, date this thing. What are you expecting from the next MPC? December.
So I would expect, as I mentioned earlier, the RBI's guidance is very, very clearly focused on aligning inflation closer to the midpoint. And I think that is something that is very, very essential to understand. So my sense is the RBI's current stance of withdrawing liquidity or keeping financial conditions tight will sustain for some more time.
Thank you. Another? Yeah, just like brief question.
Hello,
Introduce.
this is Dr. Ajit. My question was regarding overall macro indicators like private capex is not satisfactory, unemployment data is not satisfactory, MSME and unorganized sector is suffering big time. On all this background, when do you think all these factors are, if and when, are these factors likely to get factored into the market at any point of time? Or probably they will improve and market will go on progressing regardless of these factors?
Any of you want to take it? Want to take it?
Yeah, so I think you're right. I think the recovery, what we have seen Indian economy, okay, it's been again in consumption also it's been a K-shaped recovery. A lot of pockets in the economy which are still recovering post-COVID and not up to that mark, right? We have seen the upper end of the market, like for example, the premium in any category, okay, that is doing very well. So that dichotomy is there. Similarly, even on the capex side, while we've seen government spending being fairly strong and continues, private sector capex, which we have been talking for some time, right, is likely to pick up, but it's still getting deferred. And now with global uncertainty, interest rates higher, it's getting pushed out. But I think clearly, I think if we continue to grow, right, at around current rate of around 6.5% or so, right, the capacity utilization levels now in the economy are reaching a level, right, where you will start thinking about capex. And we have started looking at, for example, in the power sector, just to give an example, we never had any private sector capex for many years now, right, after the big NPAs, what we saw, okay, from the private sector. But now the demand supply situation in power is now reaching a threshold level where you will see now deficits, especially for base load starting to come in. And that's why we see now a lot of capex starting to come in, not private, but even say PSU like NTPC now starting to put in large capex. I would guess that post-elections is where I think because whenever somebody is putting large capex, they want some stability, right? Because you don't look at the current, but you plan capex for the next 5-10 years. And I think the outlook for India remains fairly strong. I think you should see that coming through slowly. We have seen a few sectors like steel, for example, cement, and others where the capex has started to now slowly begin. So I would guess that year down the line is where real private sector capex could come in, and that would really be the cornerstone in terms of supporting the economy going forward.
Thank you. Yes, there's one more question to ask. Yeah.
Yeah, thank you so much
Quickly,
for the
very
opportunity.
quick.
Yeah, so my question was, rate cuts in India was one of the biggest triggers for the markets to grow. How can RBI independently of the US Fed cut the rates, and what would be the implications of that? And what are the sectors that could benefit from rate cuts going ahead?
I'm not very sure whether this is a question for this panel. You keep it for the economist panel. We have it later. So can this gentleman will have it? The last one? Yeah, this is the last question there. Yeah. Gentlemen, you keep this question for the economist panel, which will be post-lunch. Am I correct, Naren? Is that okay? Yeah. Please.
Sir, my name is Rohit Sangvi. My question is that when our total market capitalization is plus 47 trillion, okay, and when FPI is selling just 25,000 crore, market is crashed by plus 5%. It is always repeated in the past and even in the current situation. Why it is so? It means our capital market is totally dependent on FPI. Am I right or wrong?
Okay, sir. It's a classic question, it's an age-old question. Does market continue to depend on foreign money flow?
It is so. It is always dependent on that.
Thank you, sir. Thank you,
It
sir.
doesn't depend only on FPI. If you see last year, there was lot of FPI selling, but markets did not correct because there's so much of local buying due to EPFO local mutual fund investment and a national pension scheme, etc. So I think we should get rid of this whole thing of whether FPI is selling or local is buying or anything like that. From an investor point of view, I think what matters is whether you're buying cheap or whether you're buying costly. If FPI sell at the top when the market is very costly, actually it's risky for the local investor to buy. I think people just don't realize that. So I think it doesn't matter what, whether they are selling or whether they are buying. If they buy at the bottom and we are selling, it's a problem. But we have adequate local investors.
Thank you, Naren. We'll have another 10 minutes. Just we can hold on. Quick questions for each of you, separate questions. I'll start with you, Rajiv. 2 questions I need to answer. One, because you run the debt fund. Among 6 of you, you are the debt master. So tell us 2 things. One is this, the government's, the latest budget spoke about, spoke about it, imposed tax on the debt fund. So it's basically bank deposits and prima facie, there are some technical issues, but bank deposits and debt fund are almost subject to a similar tax and all. So will that help you to gather more? But still debt continues to be less than 18%, around 18% of the total AUM. So what's the future of debt funds in this context? Is it get a boost, something like that? That's one very quick answer. And the second part is this. So long people have been talking about credit risk. Now globally you are seeing interest rate risk. You are saying that. Because you have put in even the sovereign papers, the valuation is tremendous. So how do you manage at this point of time? I mean, can there be run on you? I mean, in the sense, not you in the sense, not an SBI mutual fund, but on the mutual fund industry debt fund, like there be, we had Templeton, we had seen what happened. And of course, I think people got their money back ultimately. So tell us on this 2 part, tax implication, and second, this, the debt, the interest rate risk. Quickly, sir. Yeah. 2 minutes.
Yeah. Okay. On the first part, on the taxation impact, yes, I think to the extent that the retail investor flow in debt mutual funds was to a large extent, shaped by the indexation benefit. So you could say that that has been a dampener. But what we have seen is, or when you look at the MF debt AUM data, a large part is still, I think about 60% is institutional flow, which is not being impacted by the taxation amendment. But what will effectively happen on the retail piece is probably the holding period of retail investors also now will align with the rate cycle. So when they take a favorable view on interest rates, you will definitely see money coming back into debt funds from the retail segment. But yeah, the holding period probably might shorten a little bit. But we have seen a lot of money or retail money coming into debt through the hybrid funds, especially the ones where the indexation benefit is still being retained. So that's a quick answer to your first question. The second one on the risk in mutual funds, there are 2 events, say, over the last maybe 10 years, which have given people a flavor of both the risks which are there in a debt fund. So in 2013, we did see a lot of money had come into duration funds. Then we had an interest rate shock when we had the taper tantrum and RBI had to react. And that in a way, I think probably was a learning experience for investors from the duration risk angle in debt funds. And the last episode was the credit event, which you mentioned. A lot of money moved into credit funds from the post-demon era till about 18 and 19. And then we had a series of events which sort of brought the credit risk angle to the forefront. So I think over the last 10 years, debt investors in India have been exposed to both the extreme interest rate risk as well as extreme credit risk. Having said that, post the credit events, the regulatory environment has changed significantly in terms of disclosure, in terms of what you can and cannot do in debt funds. So overall, I don't think this sort of risk is there because people are far more aware. There's a lot more of disclosure. And even on duration, a lot of funds have a very tight band where you operate in. So I think that risk is not there in the mutual fund space.
Thank you. And also, I think you disclose the M2M on a daily basis, right?
NAV, yes.
I think it's Rajiv. Rajiv, you spoke about consumption and you spoke about that's a fillip for the market. But if you look at the consumption pattern in India, and I'm using the cliche that the K-shaped recovery. Because consumption for high-end car, you have to wait for years. Low-end car, you can just walk into the this thing shop and get it. Bike, same story about it. You look at the import items. What are we import now? All the high-end single malt. Even though Indian brand is now the global brand first among the whiskies, but if you look at the trade data, it's the alcohol and the other food, avocados, etc. They are the we are consuming. You look at the tax payment again. The number of people filing return has increased, but number of people paying tax has decreased. And tax absolute percent, I mean in absolute term, tax have gone up. So actually and one of the wealth manager is talking about octopus generation, about 1 million Indians who has everything, and rest of them are going down. So where is the consumption? It's only the higher end, no?
So it is at the higher end, that is correct. So data point after data point shows that the richer people have been better off post-COVID in terms of recovery, and the low-income earners have been struggling at some point in time. But this entire narrative that people like me and this panel give out, that when the per capita income of a country goes beyond a certain point, that's when the discretionary consumption really takes off. And that's why you should have a lever in India trading at a premium to its parent Unilever. A Nestle in India should trade at a premium to Nestle, global company. We give these stories to the investors. But what has been seen is many a times the consumption does not even come to the listed space. You mentioned about the luxury cars. Now, most of those are in the non-listed space in India. So if someone buys a Mercedes or a BMW, a listed equity investor is not benefiting from that, or single malt or avocados that you mentioned. Plus, on the basis of this narrative, you have 70, 80 times earnings, 100 times earning valuations that are there. So I completely agree with you. Data is not bearing out that consumption is on a strong wicket, at least at the lower end, and plus valuations are not supportive. So because of that, I would be cautious.
We have 5 minutes. Naren, I want to ask you one question, then 30 seconds each of you. This question is, you dealt with extensively about large cap and mid cap. They're going up, and mid cap and chota one, penny stocks and others are going up, and large cap is not giving anything. I will not name a lot of the mega stocks despite their earnings growth, last 2-3 years, they have not given sometimes negative return. But the mid cap and low and chota ones are going. So what would be your advice to the people here?
It's a function of flows always. So flows have been very good in small and mid cap. But flows don't determine long-term returns. Flows came in infrastructure funds in 2007. Did the returns for the next 5 years become very good? In 2021, there were a lot of flows in technology funds. Returns haven't been good after that. So people mix flows and long-term returns. So right now, all the flows are in small and mid caps. So small and mid caps are doing very well. But valuations are very high in small and mid caps at this point of time. When the flows turn out to be, when valuations matter and when flows don't matter, we will never know. That's what we try to tell people. But people will realize in retrospect, like people realized only later in infrastructure or in technology in 1990.
And some of the stocks also behave like Kumbhakarna, what your colleagues say, that it will sleep for 3 years. I will not name one FMCG and into some other thing, one particular stock. It was sleeping for 3 years, and then now it doubled in 1 year. So those
that will happen. That will happen because everyone becomes underweight the stock. So for the stock to do well becomes very easy because everyone is not owning that stock.
Okay. Last round, 30 seconds each and all. Again, I have done my homework here. I saw that if you see that, let's not talk about mid cap and small cap and large cap, we have done enough. It's about the sectoral earning and valuations. So my data says that looking at the current sectoral valuations, again, this is not up to date, it's about till September. Utilities, financials and energy sectors are trading below their long-term average. Utilities, financials and energy sector. but rest are all trading a premium to their long-term average. So I would like you from the beginning, just tell us which are the sectors from the investor's point of view, which are the sectors they should get excited. We are not asking for any name of any company, but you are bullish on for the micro and looking at micro and macro. Each of you, that's the end of it.
So it's simply where some of the most hated sectors are banks today, and the largest of the largest businesses lie there, where valuations are very sensible. So the risk reward there is much better. After financials, there is pharmaceutical as a space which is sensibly priced because it's way cheaper than alternatives which are available with good longevity. Lastly, you have, other than financials and pharmaceuticals, you would have some value in utilities left because that is where growth is coming back. But other than these three areas, the rest of them seem very well priced because the growth is way inferior than what their valuations today reflect.
Sir, you. We'll come to you last time.
Yeah, I think I would agree there. I think this is a BFSI conference. I think
because it is BFSI conference, you don't have to praise,
I'm just saying,
praise financial sector. It's what you believe in.
No, I'm just saying because the crowd over here is coming. And this is a sector, right, which has underperformed. So I think normally there is always a mean reversion. So banks, despite good numbers, what we have seen, right, has underperformed, especially the larger ones. And I think if the economy does well, I think credit growth has been fairly strong, despite concerns this year. So I think that's a sector where valuations are reasonable, outlook is fairly stable, so that looks good. Apart from that, I think one is, looking from a near term, but you have to look at sectors or themes, right, which will do well from a slightly medium to long-term perspective. I think those are sectors where you want to invest into. So from that perspective, I would say manufacturing, for example, in India is something which is, as a broader theme, is getting momentum. We have seen a lot of focus on domestic manufacturing, the global China Plus One policy. I think that is going to aid the sector. So there are a lot of companies in that space, okay, which look exciting from a longer-term perspective. And among the defenses, I would say pharma, again, underperformed. After the COVID, we saw a big rally in the pharma space. And the last 1 year, it's underperformed, especially domestic pharma, domestic healthcare. I think that's, again, a sector where we see steady improvement over there. At this point, we don't want to chase. We want to look at sectors where the visibility is good. Even the growth rate is not that high, right? And valuation is reasonable. So pharma would, I think, fall in that category.
Thanks. Rajiv? Sector, yes, and if you wish, sector, no also.
Sure. So I'll split the BFSI sector, not give a uniform view. I like banks, but select NBFCs one has to be cautious about. And in financial services, capital market related financial services, while volume growth right now seems to be very, very high, but there could be a big cyclical element. So in a downturn, you could see earnings dropping significantly. Utilities also look attractive, but again, one has to be cautious. Look at the capital efficiency. Don't buy across the board. So very high upcoming capital expenditure, but poor return ratios, one has to be cautious.
Thanks.
And pharma as well, positive.
Ashish, big yes and big no to sectors.
Yeah, so I think I may be biased. Of course, the first one that will come will be banks and NBFCs. Besides that, I think the automobile sector, it has been in downturn, both four-wheelers, two-wheelers for multiple years. I think medium term, there has to be a recovery in this space as well. So these will be the two sectors.
Right. Yeah.
I'll just say, yeah, as a fund house on the equity side, financials is something that we've been overweight. So I'll just...
Financials. And debt already you said.
Debt too, I said I am...
Naren.
All other sectors have been mentioned, so I'll add energy and telecom. Energy, everyone seems to be underweight. No one looks at the sector. So that's why we would say energy and telecom, because even today, some companies, no company is earning returns still. And that's why I like any industry where no company is still earning enough returns.
Any big no?
Clearly, we are more pro large cap over mid cap and small cap. I think I've said it for the third time.
Okay. So thank you. I think this is one subject we could have gone on and on, but we don't want to come between the lunch and you anymore. So thank you. What are the key takeaways? Number one, market is apolitical. Market cares for economics and growth. So politics will come and go, government will come and go. There will be volatility, but don't lose your focus on that. Or don't focus on that, because market very often gets this wrong, both in anticipation and interpretation. Point number two is this: there are many large caps which are been earning well, and the market is not appreciating till now. But this is a time probably to dilute your focus to mid cap and small cap, and shift to some of the large caps in due course. In terms of segments, during the volatile time, which Naren says that hybrid is the segment. He says, the SBI gentleman Rajiv says that this is the time also to invest in debt fund, because interest rate is very good and we will not have any interest rate risk, which probably overseas is a reality, but in India that would not be the case. And finally, we have not discussed any stocks, but sector-wise, almost everybody said BFSI. And this is Business Standard BFSI Summit, so everybody should feel happy that BFSI is the biggest segment to focus on, pharma also another, and then there are others like energy, telecom, utilities, etc. So if you have enjoyed our discussion, just give them a big hand, please. And goodbye from our side. We will see you after lunch.
All right, thank you so much for that incredibly engaging set of panel discussion. Ladies and gentlemen, this was the first panel discussion on day one of Business Standard BFSI Insight Summit, where we are getting some of the big BFSI Insight Summit, India's largest BFSI event. Our next panel discussion, ladies and gentlemen, looks to explore, demystify, and really understand in full granularity the following topic. And the topic is how to speed asset under management growth from India to Bharat. And to really maneuver and navigate this conversation, we have a set of luminaries from the world of mutual funds. So I'd like to take this honor and privilege to call on stage Mr. D.P. Singh, Deputy Managing Director and Joint CEO at SBI Mutual Fund. And after Mr. Singh, we have Mr. Navneet Munot, MD and CEO, HDFC Mutual Fund, joining him on stage. Ladies and gentlemen, can we show some energy? I think we've got the who's who and thought leaders from the world of mutual funds, and they're going to be discussing a very discernible and pragmatic topic today. Next up, we have Mr. Nilesh Shah, Managing Director, Kotak Mutual Fund. And then we have with us Mr. A. Balasubramaniam, MD and CEO, Aditya Birla Sun Life Mutual Fund. Next, we have Mr. Nilesh Shah, MD, Kotak Mutual Fund. Mr. Nimesh Shah, MD and CEO, ICICI Prudential Mutual Fund. And Ms. Radhika Gupta, MD and CEO, Edelweiss Mutual Fund. And also, Swaroop Mohanty, Vice Chairman, CEO, Mirai Asset Investment Managers India. And to really facilitate this conversation and navigate the dialogue, I'd like to call on stage Mr. Tamal Bandopadhyay, Consulting Editor at Business Standard.
Very good afternoon and welcome to, as you said, that biggest BFSI summit in India. And this is a post-lunch session. The challenge among us, Nilesh, somebody among one of his colleagues said he can bat on any pitch. So I'm depending on you to keep them awake. Okay. Radhika, unfortunately, is stuck on a phone call, so she would join us soon. Well, so I will not wait for her to come. We'll start. We just had before lunch the CIOs meeting who actually on the field and they take the call where to invest, how to go about, and now we have the CEO. Once again, these 6 gentlemen, and if you consider the lady who join us, they are again more than 50% of the Indian mutual fund industry. So welcome all of you. Let's start immediately. How to spread the AUM growth from India to Bharat. This is a subject, and CIOs are the people who decides on products, processes, distribution, and everything else. So I think we'll ask them. Before that, very little thing I would talk, and then some statistics, and then rest of it you will hear them. And like the CIO panel, we will take a few questions from the audience. So brief and no specific where to invest, meaning not the company name, but on a macro issues, anything you want to ask. Okay, we'll tell you when to ask the question. So as we speak, assets under management, which is called AUM, is now we are talking about 47.8 trillion, which is roughly almost 25% of Indian banking deposits. 196 lakh crore is bank deposit and close to 48 lakh is mutual fund. At the last 2 years, it has increased from 39.88 to 47.79 September. That's all. Some of the other numbers are equity-oriented scheme is about 54%. Debt-oriented scheme is around 18.8%, so not much, even though interest rate is pretty high. Everybody is saying it is a time to lock in money in fixed income securities. We will of course ask this gentleman, but debt continues to be, actually debt is slipping down from 19.9 September 2022 to 18.8 despite the high interest rates. Rest of us are other ETF market 12.5, etc., etc. We are not getting into that. Institutional investors are 41.2% of the assets. Okay, and finally, what we would like to, total number of investors in, and all of you know that the mutual fund investment is growing and all, but the total number of investor 40 million. 4 crore and India's population is 140 crore. So you can imagine in percentage term how many of us are actually investing in mutual fund. More importantly, this close to, as I said, close to 48 trillion, they are concentrated in 30 Indian cities. So these people who always say that mutual fund is subject to market risk, at the same time they also said the mutual fund is concentrated in 80, T30 it's called, I think. T30, that 30 cities, they are there. So we want to discuss now how to take this beyond this, B30, beyond 30. Why would 30 cities only account for 81% of the total assets? So that's the question. What we have seen in a decade back, there was a focus on financial inclusion. And then, of course, PMJDY came, and you know how the entire banking sector, inclusive banking, the scenario changed. This is the world's biggest experiment about inclusive banking, PMJDY, Prime Minister's that particular scheme, which was launched, I think, 2016. About 55 crore accounts are there and all. And right now, as we speak, insurance regulator is doing the same thing, inclusive insurance. No, they are going into the hinterland and customizing the products, etc. Even bypassing the regular distribution channel, it's going ahead on that. You'll hear the IRDA chairman tomorrow, and the insurance segment panels will be there tomorrow. But here I end, and we'll start with Bala. First, vanilla. Then we'll get into some micro issues and all. How do you actually go the insurance way, if I may say so, or the inclusive mutual fund? Okay, you are putting up a lot of ads. You are investing in marketing. Navneet, you are here. You are wearing two hats. Not only HDFC Mutual Fund boss, but also Amphi. You are now chairing Amphi. So right, recently you have done. So you two and all of you will hear first, how do you mass market it? What are the problems? Is it products a problem? Is it processing the problem? Is it distribution the problem? How do we take it to Bharat from India? Over to you, Bala.
I think you mentioned about the rate of the growth of the industry, which is about 47 lakh crore AUM, about 25 lakh crore AUM coming from equity. That itself, I would say, it's on the back of the push that was given by the Indian mutual fund industry, making mutual funds sahi and making it larger than mutual funds subject to market risk. I think the narrative had to be changed given the fact that people are coming to mutual fund for long-term investing. Therefore, the experience over longer term will be very good. That's the way I think the whole mutual funds sahi thing did wonders. Second is, since all of us sitting in this floor have been part of the industry for last more than almost 2.5 decades, or we can say 30 years, I think we moved away from focusing on the large cities to the smaller cities. That has been the journey that all of us have seen from 2012, when B30 itself is nowhere in the marketing textbook. You'll find B30 as a word, but still mutual fund industries discovered that B30, thanks to, of course, SEBI also giving higher impetus on growing deeper parts of the country. That's something which came. The reason why we are still having almost 17.5% of the total industry, roughly about 24% of the equity AUM coming from B30 market, is coming on account of the effort that industry has put in to go to the deeper parts of the country. I think third, in my view, I think as we progress in terms of promoting mutual fund, we have moved away from the language of connect, from English and Hindi to the vernacular language. Today, we run the entire, all of us together running it in multiple languages. Amphi as a single body running it as single languages, multiple languages. So almost about 14, 15 languages, I think now mutual funds are being made to understand, which again is a fact under which people are understanding more, therefore the more and more investment is coming. I think it's just a journey. I think it can only take off from here. I think we have also moved away from physical presence to actually digital presence. the way I think country has progressed on creating the digital infrastructure in the country, especially the revolution that you have seen in the payment banking side with the UPI having touched every citizen of the country with the mobile penetration. I think we are at a stage where it can only take off from here. And what you mentioned about the Bharat, as we have always seen, there is always a belief. So almost China took about 20 years to bring in telecom revolution to the country in terms of increased penetration, whereas India started late, but it took only 10 years actually to penetrate in India in terms of mobile telephone in the country. The same way, if you look at after mutual funds IA launched, we have seen a significant growth. With UPI now is coming in, with the whole world is connecting through the India connected to the payment banking systems. Probably the next round of 5 years growth will be much faster than what is in the last few years. That's the way I put it as an opening remark.
Okay. Nimish, mutual fund sahi hai, how do you take it to, how do you tell the people in hinterland?
I think it is spreading. I believe that it is spreading very fast. I think the campaign of mutual fund sahi hai changed everything for us. If you see the growth in the last 3 years has been post-COVID or as the time of COVID has been our maximum expansion. So in a country with 7 crore PAN numbers, if we have got 4 crore customers, I think we have done well, right? And the rate of growth is also, and we are spread. I think digital has completely changed the way we have grown. The number of customers hitting us digitally is way higher. Almost 62% of what we get today is new customers that we get come digitally. So as far as reach is concerned, each one of us have spread across the country. We would be more than 200 locations across the country. So the reach is there. We are, wherever we see reasonable amount of bank deposits, we would be there. And this industry is significant. As I said, 10 years back, we were 10% of the banking industry. From 10% of the banking industry, today in 10 years time, from 10% we have moved to 24% of the banking industry. So it is expanding, it's expanding very fast. By 2030, minimum I think that with the number of investors that are coming in, will be 1/3 of the banking industry. And the way banking industry is growing from 196 lakh crores, as you said, this industry would be more than 100 lakh crores in the next 7 years. So we are more focused. We know expansion is happening. The product is very good for the final investor. Because the product is very good for the final investor, he is reaching us. He is reaching us through a distribution network. He is reaching us through banks. He is reaching us through digital medium. So there are various mediums that have been created for the customer. And whichever way he prefers to come to us, he has been coming to us. We keep on explaining people. A lot of investor education programs are happening. And this is how we are reaching maximum possible customer. And growth is happening, right? And it's happening at a very healthy rate. And we plan to continue it further in the similar way.
Singh Saab, at 47.8 trillion mutual fund industry AUM, it's bigger than State Bank of India deposit base. Right?
Almost. Almost. They are 50 lakh crores.
Slight. I mean,
almost there.
Okay, I don't have the September number.
Yeah. Almost there. Yeah.
So it's like a State Bank of India.
Yeah.
So sir, sorry, I'm not.
No,
it's
he
represents State Bank as I'm saying. So उससे फिर आगे कैसे बढ़ाएंगे?
देखिए आगे बढ़ने के लिए जो आपने बात पूछी उसमें 2-3 चीजें हैं.
What? Because say when it comes to technology, what we are doing better than the developed markets.
Yeah.
No, UPI. If you talk about that. I was recently in Body and all in the Gujarat and Mumbai border. 4 days I stayed there. I did not open my purse. Everything I did through UPI. Right from buying cucumber for salad to sitafal as snacks, everything. So that's what, and that's not a metropolitan town, that's not even a mid-town, that's a village. Everything there. So that's the case. So using that, I mean, isn't the right way to actually penetrate? Because Nimesh seems very happy what you have done. That's all.
No, Nimesh is very happy and he has a reason to be happy and we all are very happy about the growth because we get our fee on the AUM only. So we all are very happy. But we also have to look at it that the AUM which have also grown because of the very good bull market in the market, and mark to market has also increased our AUM. Whether net sales have happened or not, that's another question. And we keep on talking about 16,000 crore coming every month. But is the net sales of the industry
SIP?
Yeah, okay. 16,000. By that, metrics, at least 1 lakh plus, 1 lakh 5,000, 1 lakh 6,000 should have come through that money only. But the actual net sales of the industry is 70,000 crores. So I think
Meaning net of redemption, you are saying,
net of redemption, net of SIP, we are not even having the net sales in the industry equivalent to the SIP money which is coming in. So we need to do much more than what we are doing. Mutual fund sahi hai has reached every level, but now there's a time to tell mutual fund किसके लिए क्या सही है, कितना सही है, किसके लिए क्या product होनी चाहिए. I think we need to go to that level, and I think we will go to that. Because the concept selling of mutual fund has happened, the concept selling of this, the other things have to happen. And now coming back to the, when we are comparing ourselves to banking deposits, we have to keep in mind they are B2C and we are B2B. Mutual fund industry is B2B, and B2C, there are 1,65,000, almost 1,65,000 scheduled bank branches in all across India. And the number of distributors with us is hardly 100,000 crores. Of course, in addition to that, banks also are doing it. But how many banks in B30 are selling mutual funds? And how much they are selling and what they are selling? And what is the trigger for them to sell? Which kind of product? I think we need to go to the deeper things. We need to do much more. And see, we are happy with the growth which is happening, but if we have to take it to 1/3 of the banking industry or 50% of the banking industry, the lenses which we are using today need to be changed.
Thank you, Singh Sahab. So Nilesh, this is your responsibility. He says that mutual fund सही है. आपने last time ऐसे बोला था at the end. I think you ended saying that mutual fund सही है. Fine. But ये किसके लिए सही है, क्यों सही है, आपको convince करना है hinterland को. बताइए कैसे करेंगे?
So Dada, what Bala, Nimesh and DP mentioned, I'll try to put it in your roller coaster style. So first we need financial awareness. And there is this beautiful Hindi song from Sant Gyaneshwar. ज्योत से ज्योत जगाते चलो, ज्ञान की गंगा बहाते चलो. राह में मिले जो दीन दुखी, सबको गले लगाते चलो. So Dada, we need your blessings and all the stalwarts' blessing so that we can spread financial awareness among people. Today, 18 crore Indians have gone and traded in crypto to lose money. 2 crore Indians have gone and invested into PSCL company to city limousine to lose money. 10 crore Indians play rummy, ludo, poker online to lose money. And then as per SEBI's own research, 89% of people try to lose their future in FNO trading. So we need your blessings, Dada, to ensure that financial education is spread. We are not sun, we are lighting lamps, but jyot se jyot jagaenge to pahunch jayenge. Second चीज, जोड़ी हमारी जमेगा कैसे जानी, हम है अंग्रेजी, तुम हो हिंदुस्तानी. So as Bala mentioned, we have to communicate in the language which people can understand. And we have faced challenge. There was a time when I pushed all my fund managers to record a message in their mother tongue. So from Bengali to Odia to Tamil to Telugu to Kannada to Gujarati to Marathi to Hindi to Punjabi and English. The cumulative viewership of all regional language put together was 1/10 of the English viewership. We started doing Hindi monthly presentation. Audience को लगा कि इनको English आता नहीं है, मतलब समझदार नहीं होंगे, तो उन्होंने आना बंद कर दिया. So I need to still speak in the language which people can understand. तीसरी चीज, साथी हाथ बढ़ाना, साथी हाथ बढ़ाना. एक अकेला थक जाएगा, मिलकर बोझ उठाना, साथी हाथ बढ़ाना. अपना सुख भी एक है साथी, अपना दुख भी एक, अपनी मंजिल सच की मंजिल, अपना रास्ता नेक. दादा वी हैव द बेस्ट प्रोडक्ट, सच करते हैं, ट्रांसपेरेंट है और नेक रास्ते पे चल के डिलीवर करते हैं. बट आई नीड डिस्ट्रीब्यूटर्स हु कैन हेल्प मी टेक आउट टू द हिंटरलैंड. एस डीपी मेंशन डिस्ट्रीब्यूशन चाहिए. एंड फाइनली वी नीड लेवल प्लेइंग फील्ड. देखे जरा किसमें कितना है दम, जम के रखना कदम मेरे साथिया. सो ट्रांसपेरेंसी, कमीशन, डिस्क्लोजर, एक लेवल प्लेइंग फील्ड चाहिए. फिर B30 क्या B100, B200, B500 सब जगह पहुंच जाएंगे दादा.
Sarup and Navneet, I'm afraid I would hate to be in your chair because after this,
it's not fair.
How do
Tamalda, it's not fair. We should have sat that side.
ये तो मोहम्मद सामी से भी कमाल कर दिया यार.
नहीं ये गलत बात है.
You can have a Oriya song, whatever it is.
Navneet sings better. Let me tell you.
So anyway, we'll see that and probably we'll have a mass song later. But ये तो मोहम्मद सामी है बॉस, उसको बैठा था आया
तमल जी
6 wickets then missing and all.
ऐसा ही है.
तमल जी इंसिडेंटली म्यूजिकली लैंग्वेज का बैरियर नहीं है, इसके लिए अभी आजकल म्यूजिक भी चालू करना पड़ेगा.
अभी करेंगे ना. हाँ ठीक है सब लोग. चलिए सर बोलिए. What are the, tell me, how do you expand it?
Sure. So first of all,
you want to speak at the end?
He said that. Navneet, I thought you wanted.
He said that he wants to be the last and after me.
Fine, no problem.
But Tamal, the sincere compliments to you and to the entire Business Standard family. I think every year we think how will you take the bar higher next year, but kudos to you. Every year you take the bar higher. So sincere compliments to you. And it was so heartening for all of us, and luckily all of us have been in industry for long now. It was so heartening when you were narrating those numbers about where the AUM and a couple of things are there. You talked about 47 lakh crore plus, and some of us, we were fund managers, Nilesh Bhai, I and Bala, and then DP, Sarup and Nimesh have been in the industry for long to sell our products. I remember in 2002, we celebrated 1 lakh crore AUM of the industry. So 1 lakh and 47 lakh crores, it's a big journey. It's a huge journey, and you have played a big role in that. So you mentioned about the AUM is still concentrated in the top 30 cities. So if you look at one number, that 83% of the AUM is from top 30, 17% of the industry AUM is from B30 cities. But that's not the right reflection of what's happening in the mutual fund industry. 27% of equity AUM, so 17% of AUM is from B30. 27% of equity AUM is from B30 cities. 30% of incremental equity flows are from B30 cities. 40% of the SIP book is from B30 cities. 44% of the folios in the mutual fund industry are from B30 industry. And the most fascinating number is 55% of the new SIP accounts are getting opened in B30 cities. And hold your breath, the last number. For fintechs, the impact of digitalization, so we believe that digital and technology is more about the larger towns. For the fintechs, that number of new SIP account is more than 60%. So for fintechs, 60% of the SIPs are coming from the B30 town. So the word is getting spread, and over a period of time, we think that if you look at some of these trends, penetration is increasing. But as everybody said, I will echo the same sentiment that we haven't touched the tip of the iceberg, given that all said and done, all the numbers that you narrated and the other people mentioned, we only have 40 million or 4 crore unique customers. But the increase it takes the, for every industry, if we take the example of consumer companies, and we were all fund managers, I remember in 90s we used to discuss about why the per capita consumption is so low. And then the sachet movement happened. For several years, per capita consumption was very low. When the sachet movement happened for the FMCG industry, that took the numbers in a lot of categories to a different level. And I think the SIP sachet movement of SIP, where now even with 100 rupees, a person can start the SIP. I think over a period of time, we are going to see a substantial increase. I'll also give you
It took us 25 years for all of us to keep talking about the power of SIP, the power of compounding, importance of long-term investing to reach $1 billion per month in SIP. And then the second billion happened in just a matter of little over 5 years. So it's like you get a J curve after a lot of hard work by the industry. I think we have hit that J curve, and together I think if we continue to work harder and harder with your help, as Nilesh bhai mentioned, we have a long way to go. And I'll just take maybe 2 more minutes,
Sure.
Kamalda. I think the 4 things, what has really happened in the growth, the way it has happened, what has really happened? To me, I think there are 3 or 4 things. Number 1, the track record of the industry. Despite the roller coaster in the market for last 25, 30 years, there are so many products in India which have got a track record of now 25, 30 years, going back 25, 30 years in terms of delivering the returns to the investor. So we have built a credibility for a reasonably long period. The second is the transparency. I don't think any product comes anywhere close to mutual funds in India who are as transparent to the investor or to the ecosystem as mutual funds are. The third is the technology, and I think Nimesh alluded to that. One of the reasons post-COVID our growth has been faster is I think the adoption of technology. India is a country which is digitally enabled, digitally aware, digitally powered, but financially underserved. So just like a lot of other spheres in financial services, we have also hit that tipping point. And just to make that acronym, I'm using the word T, the 4th T, but it's basically the investor education, I can say training. The mutual fund Sahi Hai campaign by MFI and supported by all of us in our individual capacity, what we have done to create the awareness along with all our partners and people like you has given a lot of confidence to the people. But as we all mentioned that we have just hit the tip of the iceberg, but I think we have crossed that J curve, and over a period of time, the numbers are likely to look much larger and larger.
Thanks, Navneet. Swarup.
Yeah, very difficult to fill in after all this. But see, every
you
industry...
See, Oriya song is fine.
No,
because
I'm so
he
happy
says language
Nilesh
is not a
bhai used
barrier.
the word Odia.
Are you?
I'm so happy Nilesh bhai used the word Odia. I think 10 years ago people didn't know. I used to say कि पूरी ओ जगन्नाथ पुरी ऐसा बोलते हैं. But that's the growth of the country. See, every industry needs an inflection point. And I think for us, that started with demonetization, when there was shift from fixed assets to financial assets. That got catapulted with COVID. You know, today, when you look at the country is very different because it's reached that very instrumental threshold of $2,000 per capita. And that's where people start earning money. And when you earn money, the first instance is probably to fulfill your desires, which people are going through the consumerism. But like Nilesh bhai pointed out, some places where they are putting money to invest, hoping they will earn money. That process has started. Just to take on from what Navneet said, it took us 25 years to get 2.3 crore folios before COVID. Post-COVID, we've added 1.7 crore folios. Now look at this country. We are now 60% of world population under 30 is in this country. They will earn money. Their approach is very different from my approach. They're economically superior. They will definitely not aspire to buy a fixed asset. My son will create experiences, not assets. They will have far more opinions about investing. Their risk-taking capability will be very different. Here's what Navneet said, that we've created 25 years of a good product, transparent product. We tell you the value every day. No other product tells you that. When you look at that as a stage, the inflection point is here. We are now adding at least 80 to 90 lakh folios per year. It used to take us years to do that. It's just a matter of time with technology that in the next 4 or 5 years, we'll probably start adding 4 crores per year, something which we had done in 25, 28 years. So it's not a question of India or Bharat. With technology, everything is one. Tomorrow, we can reach everybody's mobile in a matter of minutes. And that is what will change the speed of the growth of the industry. What used to be a luxury to buy a car now is a necessity. The need of investing has to be risen, and that has to be risen by all of us. When you look at what DP said, is very important for all of us to understand that when a country is poised from 3.5 trillion going to 6 trillion, why should I take money out of this market? It is a business of conviction. If it is a business of conviction, there is no greater story in this world than the country that we are sitting in. 10 years ago, we used to say India is a structural growth story. Today we are saying India is a structural growth story. 10 years later, we'll say India is a growth structural. How many of us are so fortunate to be sitting in a 30, 40-year-old structural growth story? Till that time, that conviction does not seep into each one of us, the need for investing will not rise. Let me be very clear on that. Any redemption you make today, unless it is for the need of any individual, is wrong in the next 10 years perspective, and I will walk the talk on that one as I speak here today. So that's something which we have to understand. Till that conviction is not there in all of us, that inflection point may be a little far away. I mean, I'm sitting with 3 fund managers here, Bala, Nilesh Bhai, and Navneet. Look at their track record over the last 10, 20 years. Unblemished. What more do we want? Right? So for me, it is that need for investing which all of us have to show. The entire thing changed because as an industry, we stood up and showed conviction in saying mutual fund sahi hai. Aur wo sahi hai. Keep it simple at that. Enjoy the ride called India. Don't leave India. If that happens, this inflection point is tomorrow.
Thank you. So very optimistic, very bullish, and waiting for the inflection point. And you, I mean, the audience and the investors, a lot of things depends on you. So we'll get into some specific issues and get ready with questions, whoever you have and all. So Bala, let's start with you. That taxation, that the new government regime, the tax on debt, I mean, how do you, one way of looking at it, the advantage mutual fund has over bank deposit to some extent diluted, because it's not apple to apple comparison, because there are certain things, etc. there, but still, which was tax-free income, now I have to pay tax. So why would rather I put it in bank deposits, because bankers are paying pretty high, even 7.5, 7.25, 7.5 for safe for your savings bank account, no, which is liquid and high return. So one way of looking at this. Other way of looking at it is just within mutual fund, now there's unlevel playing field. Despite fixed income, this is the time, but people are going more for equity. And if I go through your numbers, equity, as I said, debt-oriented scheme is 18.8%, equity is 54%. So can you demystify this? What is the impact of this taxation? Yeah, are you happy or are you unhappy? And what does it mean?
Of course, we can never be unhappy when government takes a call on certain taxation issues. So, but having said that, I think if you look at the fixed income as an asset class, one of course a large asset class, not just only in India, even globally, it's a big asset class. It doesn't guarantee you any return, no doubt, but it provides all the convenience that one needs, that is being provided by the fixed income schemes. Second, the largest component of fixed income is the carry, which is nothing but the coupon that get accrued on day-to-day basis in our portfolio. So therefore, the relevance of fixed income scheme doesn't come into question mark, even after the incidence of tax being removed for that. And third is actually the tax as you redeem and pay. I mean, you pay tax as you redeem. Tax is not getting accrued, unlike deposits.
Yes.
You definitely get that benefit.
Yeah.
I would just like to mention is again, this is something need to be looked at in what circumstances we are looking at fixed income as an opportunity. I think it always becomes a big opportunity when the rates are high. One of the asset class, I think we all talk about equity has been growing faster. One of the asset class in the US have grown the fastest in the last 2 years is actually the money market funds. The money market funds have received the largest inflow, not because of they are going to give substantial higher return, but as against the money that they have in either savings account or any deposits account in the bank, they get a better return actually in the money market funds because the rates are high and the Fed has been rising interest rates. Even in India, we have seen interest rate being hiked. Therefore, the carry and money market funds is far better than I think what they get actually in fixed deposit. I think one has to look at from that angle. Second, the other asset class within the fixed income combination is hybrid as an asset class. Hybrid has got a multiple varieties. And most of the investors who are coming in the fixed income, they are basically the conservative investors, if you have to call them. The time period is not shorter anyway. Nobody comes actually for 1 year or 2 years. The time period is longer. But they are conservative investors, but they don't want to take a significant risk towards the equity investing. Therefore, they look at fixed income as an option. But for those investors, again, mutual funds have created a beautiful vehicle, which is called hybrid funds, which is called a savings fund, hybrid fund, whatever you want to call it. Such kind of product also comes in. Therefore, that can also act as an alternate to the traditional choice that they have. Last but not the least is, but in every cycle, you will see one asset class doing better than the other asset classes. And equity asset class have been, of course, performing better than any asset class so far. We must also remember there will be period of consolidation, there will be period of volatility, there will be period of absolutely no return coming in. So therefore, fixed income asset class always acts as a question. Every portfolio may create, if you want to create a most satisfactory, best possible outcome, that for investor experience, one has to look at it. And then the combination of equity and fixed income hybrid should always be part of the investor's portfolio. That's why I think the fixed income will always play a role. See, tax is only an added advantage. I think there's another question which was there when Government of India introduced 10% capital gain tax for long-term capital gain as an equity and mutual fund equity schemes. All of us sitting on the floor, we felt that it can be detrimental to the growth of the mutual fund industry in India as well as an equity asset class in India. In fact, we have seen actually the reverse of that. When anybody who comes actually for investing in mutual funds, the first consideration is not the tax. The first consideration is actually what is the purpose for which investing, which asset class investing, what is the period for which I am investing. If that actually is superior to the taxation will be only the small element of the whole pie. But the one thing that I think Nilesh mentioned about that level playing field, I think what government has been doing periodically removing the differential advantage that everybody has got it. I think one we got hit last year. I'm sure next year they'll also consider other instruments that are available in the market, which gives a better tax advantage compared to the traditional investments like mutual funds or fixed deposit. I'm sure government will be looking at that. If that's done, then I think the level playing field, I think will make sure the fixed income asset class will equally grow bigger than what you have seen in the past.
Yeah, Navneet, can you take us through what's now at this point of time, which is much talked about, the geopolitics, what's happening, etc., US Treasury yield, currencies under pressure, inflation in developed markets and all. So in that context, where do you see the market is going as a sort of not only for the mutual funds, this thing, but overall, are there concern or you think that what RBI governor says India is a growth engine and we can be confident enough, there is no fault line? What do you think?
Oh, I thought you would have asked that in the previous panel of CIOs.
No.
They would have given a better perspective. But I mean, looking at the world today, the only thing I can say with certainty is continuity of uncertainty. I think the geopolitics, the overall economic situation, I think the world hasn't seen an inflation or level of interest rates this high in a very, very long period of time. The geopolitics is highly unpredictable, and I know the word VUCA is cliche, but we are actually in a VUCA world which is volatile, uncertain, complex, and ambiguous. We have to learn to live with that. At the same time, I mean, if you look at India, the picture is very, very different. I think if you look at India from a growth perspective over the next several years, will continue to remain the highest growing economy in the world. There are very few places in the world which have done something like this, what we have done. In last 25, 30 years, nominal GDP has grown around 10, 11%. Corporate profits have grown around 11, 12%, and market cap has increased by 12, 13%. In last 30 years, when China was the biggest growth engine for the world, Chinese investors, stock market investors hardly made money because the market moved just 1% per annum. So an ability of a country or an economy to consistently deliver higher growth, a corporate sector which converts that growth into profits, and a capital market, a well-regulated, vibrant, deep capital market, which have converted that profit into the profits that can be shared with minority shareholders, and a mutual fund industry where even with a 500 rupees per month, somebody could participate in that growth. That hasn't happened in many countries. So I remain very confident, as is echoing the views that Swaroop mentioned earlier, that everybody needs to have this faith that over the next 10, 15, 20 years, we'll continue to deliver higher growth. Our corporate sector will participate in that. And given the nature of our capital market and the mutual fund industry, we'll be able to deliver that growth to every investor. So the trick would be to not get swayed by the volatility. The trick would be not to get too bogged down by the noise, but have the faith in the long-term growth story of India. That's very, very important. By the way, Swaroop and I were just talking, Tamil Dada, that you were talking about the need for multilingual. You have 8 people on this dais, and between us, we can speak 7, 8 different languages.
Radhika, you just relax. You relax. I'll come back. I'll come to you.
I'm going to enjoy listening to Navneet, and hopefully he'll sing till then.
Also, one point, because Nimesh and everybody mentioned about that how the industry size has grown from 10% to 25% of the bank. And I think you mentioned that the industry AUM is bigger than the largest bank in India. We were a fraction of the largest bank in India when we started our career in the industry. But we must remember one fact. The largest bank in the world is a Chinese bank, which has assets of around $5 trillion. The largest AMC in the world is BlackRock, which has assets of almost double of the largest bank in the world. So you know where we are headed in next 10, 20, 30 years.
That is you picked up from Nimesh, but Nilesh ka jo Gana, you cannot pick up that? He said you are a better singer.
मैं तो गाना ही सुनने आई हूँ मैं दोनों के गाने सुनने आई हूँ
She will give you a good poem.
Yeah. Nimesh, I'll ask you one thing. I mean, I don't know whether it's actually I am asking you the right question or not. But what I see is, on the one hand, we are talking about taking the participants from India to Bharat. And you people all said that, yes, it's happening. And by data, Navneet says that it's happening. And technology, you'll ride on technology and all. But within India, when I find that when you talk about the super HNIs and all, they prefer PMS and ATF, not mutual fund. Is that correct? And if it's why, how do you change them? Why don't they come to mutual fund?
There is a asset, we are all asset management companies. So we have got one department, which is the mutual fund. And mutual fund product, when we design the product and when we put the risk parameters to it, we are very clear that the common man of India, I always say that the retired school teacher of Guwahati, if he invests with us and he stays with us with a period of 5 years, he should have a reasonable good experience. Risk is managed in that way. We diversify to that extent so that the risk is managed. So amongst many other things, we diversify also in that manner. But there is a certain section, the same AMCs which manage mutual fund also manage PMS AIF schemes, where the same risk department of ours will be looking at those schemes, that is those alternate schemes, and they are managed with slightly more concentration risk, right? So we understand the risk that each customer wants. Maybe the HNI customer wants more risk, and if it is very transparently explained to him that this fund, this particular scheme can have more risk, but it has also the chances of getting more return. And after knowing it fully well, if he wants to come with a higher ticket size, then he is welcome to come in the AIF PMS scheme. So there is space for mutual funds also, with the risk parameters defined for mutual funds, and there is a space for alternates also. We call it an alternate business, where we'll have, as an AMC, I will have all types of customers, people who want various kinds of risk into various kinds of products. So I, as an AMC, will have mutual funds also, PMS also, AIF also.
Thanks, Nimesh. So, Radhika, you, just to give a quick summary, we are discussing how to take AUM from India to Bharat, because our, of course, Navneet gave a lot of data, which shows that things are changing, but what we are seeing is this, yes, mutual fund is growing, mutual fund sahi hai, okay? So it's about 48 trillion plus. 48 trillion, close to 48 trillion, which is roughly 1/4 of the banking industry, equal to State Bank of India's deposit base. But when it comes the investors, we are saying that about more than 80% are from the T20, T30, and B30, which is beyond 30, the rest of it. So how do you, the product, processes, where are the gaps? He said, Mohanty said, we are at an inflection point. What we have done today, maybe in the next 5 years, we get doubled, all these things. Nilesh Bhai, he took the stage. He didn't dance, but he sang. He sang 4 songs to how to take mutual fund industry going beyond sahi hai, kaise sahi hai, kyun sahi hai, kiske liye sahi hai. He explained through songs. I will be very happy if you do that same way or whatever you want.
Okay. Firstly, my apologies to everybody, especially you, Tamal, for being late. My regret for being late is partly for missing the discussion, but more for missing Nilesh Bhai's songs. He's a fantastic singer and he's getting better and better. Unfortunately, Tamal, I will not sing because then you will not have an audience for your next panel. I might do something else, but I have learned in the asset management industry, जो capability है उतना ही करो और मुझे जहाँ capability नहीं है वो काफी पता है, तो I will leave that to Nilesh and Navneet. You know, firstly, I think, Tamal, we should give ourselves tremendous credit as an industry for where we have reached. Often, you know, कहते हैं कि घर की मुर्गी दाल बराबर. I spent about a week out of India. I was at a conference of World Economic Forum where we were 100 countries and young CEOs from many parts of the world. And when I talked about a campaign like Mutual Fund Sahi Hai, and the fact that we have this retail savings SIP book, which is $2 billion US, and it has come, you know, when most people hear this abroad, they ask me two questions. Ma'am, do you have a retail savings book because your government has any special tax incentive for SIP? Acha, do you have some kind of 401k program that your government has forced that makes people do SIP? None of this is true. And I think in industry coming together and pooling assets to create something like mutual fund in itself is one of a kind in the world. So firstly, I think we should give ourselves and our infrastructure a round of applause because when outsiders look at it, they almost look at it with a feeling of wow, whether that outsider is from Japan or whether that outsider is from Africa. And this is something I got to experience over the last 10 days. I think as Swaroop said, the migration from T30 to B30 is a journey. It is a significant journey. I also believe that while it is very easy to talk about T30 to B30, we have not even conquered the T30 opportunity. You know, if you do an average poll in your housing society, like I go speak at Naval War College in Goa, which is armed forces professionals, and I do this poll, how many percentage of you invest in mutual funds? Less than 10% of people raise that hand. They're all T30 people. So we have not even conquered the problem in T30. We have not conquered the problem in your college alumni group. You have not conquered the problem in your housing society. So we have a long way to go in both parts. One thing I would say is that today we have perhaps 1.3 lakh ARNs in this country. We probably need 10 lakh ARNs if we have to take the message of mutual fund to that many people. It will not happen with 45 asset management companies. It would have happened if it had to. We need to go from 1 to 10 lakh ARNs if we have to make that journey.
Okay. We have not too much of time left because it's a so interesting time actually was flowing fast. Any question from anybody? Can I have the microphone, please?
Hello?
Microphone, please.
Yeah, so my question was on TER regulations.
Quickly, very short.
Two sides to it. One is, do you think it will help the TER regulation help AUM spread grow from India to Bharat? Was it necessary and how effective it will be? And on the second part, on the other side, what are the stakeholders that will affect, will it affect, will it be the brokers or the mutual funds? How will it pan out? Your views, please.
Amphi Chairman will answer the question on TER.
Thank you.
Your question was that
get the mic to the second person. Yeah, please.
Will this help investors? So post 2018, when the new TR structure came in, if you look at journey of any fund in India, over a period of time, the scale benefits have been passed on to the investor. And if you look at most of the funds that have grown, would have anywhere between 20 to 40 basis point. I mean, the TR would have come down. And over a period of time, as the funds keep becoming bigger, the benefits are getting passed on to the investors.
Thank you. Yeah, please.
Yeah, hi. My name is Hoshang. A very quick question to Navneet as a MP chairman as well.
Short.
Very short. I am very
you have
pro.
a couple of past chairmen also here and vice chairman.
I can ask Bala sir as well. Very quick
but
question.
happy to answer.
Carry on.
I am very pro mutual fund, very pro India, Bharat. You'll be happy to know all my money in mutual fund. One cause of concern which we did not talk about is the front running case. Recently Axis, which is in public domain. So that as a retail or an HI investor also, it leads to a little backlash as well, right? You guys are transparent, hats off and everything, but those cases also looks at a little dent. So any one of you can,
Okay,
I mean,
thank
your
you.
general thoughts.
Thank you. Front running. Again, Navneet, you are focusing on, you are the most
Others can
transparent.
add as well for any industry, for any society, for any country, or for any organization or as an individual. Failure is not about falling down, but staying down. In last 30 years in our journey as an industry, and maybe going back to maybe some of the previous like UTI and all, we would have countered like a lot of those challenges, but every single time, credit to this industry, and I'm saying with a lot of humility, and it should not sound immodest, every single time we would have strengthened our house, we would have put many more processes in place with the help of regulator, which is absolutely best in class in the world. I think industry has always come out with flying colors, and that's why the trust has got built into the industry, the reason it has got built into the industry.
Thanks, Navneet. Yes.
Can I answer
Question.
something?
Please.
So,
Through a song?
Ushang bhai, encourage good behavior, give money to good people.
Okay.
I also want to say that because we are a transparent industry, we are a little bit like Bollywood, not to do their songs. We are very visible. So we get criticized for everything we do. All industries make mistakes. I think the objective is to get stronger, but we tend to be in the limelight a lot. तो वो हम आप भी करते हैं तो हो जाते हैं बदनाम, लोग कत्ल भी करते हैं कुछ नहीं होता. That is a little bit of the reality of life, and that's okay. Our transparency has got us this far.
Thank you. Yes. Can I have, yeah, please. Quickly.
I'm a,
And one more question from the end we'll have. Acha, this lady. Okay, fine. Please.
So, म्यूचुअल फंड सही है, पर क्या म्यूचुअल फंड सरल है? Now that's a very pointed question, and I have 3 dimensions to that, and each one of you on the dais, please help me with that. मैं जब म्यूचुअल फंड इन्वेस्ट करना चाहता हूँ, तो मुझे बड़ा कंफ्यूजन रहता है. एक रहता है कि जो पहले साहब हैं, इनके म्यूचुअल फंड के एग्जिट लोड कोई 90 दिन से ऊपर है नहीं, और एक है जो 2 साल का एग्जिट लोड है, दूसरे हैं जो 3 साल का एग्जिट लोड लाने वाले हैं. तो हाउ डज एग्जिट लोड ड्यूरेशन? A, 0.10 to 2% is the exit load. B is the duration from 15 days in some equity funds, equity active funds. 2 years, and HDFC now launching a fund for 3 years exit load. So how does that help? Or is it only to help the distributors get their higher commission? Or what is the purpose?
Thank you. You made your point.
No, I've not made my point, sir. I've not made my point. I said 3 points. Please, no, you have to listen to me.
Sir,
I'm asking question which is relevant to the audience. You don't want to answer it, you tell me, I'll sit down. Would you answer my question? Are you willing to?
I am asking you, please quickly, because running the time.
You are wasting my time by interrupting me. So, that is one. The second is, there are so many options. You have general, you have direct. Then you have IDCW, and then you have growth. And then you have stray examples of bonus, and you have yet more institutional. How do I choose? Or what is it for? And the last is the confusion as to वाकई में म्यूचुअल फंड सही है? क्योंकि RBI allows only 50% leverage, which means it is a high-risk product. On the other hand, NSE allows 7.5% haircut on NTF, which is even lower haircut than the Nifty. So, I am very confused. तो मेरा सवाल है, म्यूचुअल फंड सही है, परंतु म्यूचुअल फंड सरल है?
Thank you. So, Singh Sahab, and then you can answer. First Singh Sahab, and then you answer.
देखिए, पहली बात तो ये है कि म्यूचुअल फंड 100% सही है, 100% सही है. इसको तो आपको मानना पड़ेगा. ओके, नहीं भी मानते तो हम जबरदस्ती मनवा लेंगे.
Anyway, just
ठीक है.
Singh Sahab, just his confusion, he is confused, he said, you just answer that.
No,
and then
confusion देखिए, ये IDCW, बोनस प्लान, ये सब एक समय पे टैक्स लॉज के हिसाब से लाए गए थे. आज की डेट में सबसे वैलिड सिर्फ एक ही प्लान है, वो ग्रोथ प्लान है. को कन्फ्यूज़न आपको रखना ही नहीं चाहिए, क्योंकि जब तक उन प्लान्स में वो पैसा पड़ा हुआ है हमें वो प्लान चलानी पड़ेंगी, क्योंकि अगर हम उन प्लान्स को ज़बरदस्ती बंद करके उसमें दूसरी प्लान में डालने की कोशिश करते हैं तो टैक्स ट्रिगर हो जाएगा, एन भी डिफरेंट है. एक मिनट मेरे को.
No, we have interaction. We can please take outside
We
the
will
thing.
take
Let
it
him
outside.
answer, sir.
तो
If
ये
you
जो
are
आपने
not happy, you can always catch him. You can always catch him outside.
तो ये
Okay.
जो प्लान्स हैं, प्लान्स इसलिए हैं क्योंकि आज की डेट में प्लान है. दूसरी बात रही 1 साल का एग्जिट लोड या 2 साल का एग्जिट लोड, मैं तो ये कहता हूँ कि एग्जिट लोड हमेशा लंबा होना चाहिए, क्योंकि क्या करते हैं हम मार्केट में, हम सबको ये बोलते हैं कि इक्विटी में पैसा लगाइए कम से कम 5 साल के लिए, और उसी सेंटेंस में आगे बोलते हैं जब भी पैसा चाहिए हो निकाल लेना. Isn't it a contradictory statement? Because we want the money for 5 years and people are putting money and reducing. That's what I said. In the SIPs, people are putting money for 10-year SIPs. SIPs are running, but in between they are taking the money out. So that discipline, they are not getting the benefit of the compounding impact. So the discipline has to be there. If you are going to be in equity funds, especially, you have to put in money for the long years. We are not saving bank deposits. We are not liquid funds. When we are talking about liquid funds have to be taken as liquid funds, and equity funds have to be taken as 3-year, 5-year product. So that's what we were saying. अभी हमें म्यूचुअल फंड सही है से आगे चल के ये देखना है म्यूचुअल फंड किसके लिए कितना सही है, क्या सही है, वो हमारी जिम्मेवारी है, वो हम ले रहे हैं, वो हम करेंगे. पर म्यूचुअल फंड सही है.
Thank you, Singh साहब.
So म्यूचुअल फंड सही भी है, बट सरल से आगे है. मैं चार्टर्ड अकाउंटेंट हूँ, मैंने सीए करके सरल आईटी फॉर्म भरा है, उससे तो हम बहुत ज़्यादा आगे हैं. और दूसरी चीज़, आप लोग सब रेस्टोरेंट में जाते होंगे, वहाँ पे आपको वेटर आके बोलता है सर सादा डोसा, घी सादा डोसा, मसाला डोसा, सादा मसाला डोसा, ओनियन मसाला डोसा, रवाई डोसा, इतनी सारी चॉइस है. वहाँ पे तो आप कंप्लेंट नहीं करते, वहाँ पे आप ढूंढ निकालते हैं. सो थोड़ी मेहनत करिए. म्यूचुअल फंड सरल भी है, सरल से आगे है और सिंपल भी है.
और अगर हेल्प चाहिए तो एडवाइजर लोग भी बहुत अच्छे हैं जो आपकी हेल्प कर सकते हैं.
नहीं, बट जस्ट टू put things in perspective, we are 7 fund houses bringing different options in front of you. Why should we be one? We should necessarily not be one, so that you will get different aspects of different talents from each fund management team. जब आप कुछ भी चीज खरीदते हैं कि एक ही गाड़ी बिकना चाहिए, फिर एक ही फंड होना चाहिए. Why should there be 7 funds or 40 funds? That's the beauty of the industry, is to give you choice. And then, as DP said, जो फंड आपको फिट होता है उसमें आप लगाओ. आपको अगर कॉम्प्लिकेटेड लगता है, कोई और प्रोडक्ट अगर ठीक लगता है तो उधर आप लगाओ. As simple as that.
Thanks, Swarup. This lady has been waiting. That's the last question. Okay, we are running out of time.
Nidhi
Please.
Kanoy. I'm from Millennium Mams, and we encourage financial literacy for women. So my question actually to all of you, actually we met Mr. Munot earlier this year. So how would you encourage women to participate in India and Bharat's growth story?
How do you encourage women?
Sam, I can take that. He's already answered.
No, I'm so happy that you asked that. As of now, around 25% of the investors in mutual fund industry are women. But over a period of time, our belief is that that number is likely to increase. Both SEBI and MFI are working together. How do we spread awareness more among the women investors? At SDFC AMC, we are very proud that over the last couple of years, we have worked very hard. Our flagship campaign within investor education has been Barni Se Azadi, which has been like creating awareness among women that don't put that money in kitchen jar because it doesn't grow there. It's better that you put money in mutual fund where it can grow over a period of time. In just a week before or 2 weeks before, in one single week, we did 76 Nukkad Natak across the country, and this was a pilot. And now with the success, I think we are going to take that to every corner. As Association of Mutual Funds of India, we have a huge program, Mutual Fund Sahi Hai, you are aware. And in this year, for next several years, one of our bigger focus is going to be on women investors. Radhika, can I
Just
go
to tell you
Thank you,
something,
sir.
in 2000, Mr. Dhanuka and I started some of the earlier sessions in Calcutta. From that day to today, women investing aspect is completely changed. Maybe Radhika is a better person to talk about it. But please, the landscape is changing fast and very fast. At our organization, we are 39% women, okay? And we don't go to choose a man and a woman, we go to choose the best candidate. 39% of the last 5-6 years of the candidates who have come are more women than men. That's what is happening at the underlying.
Thanks.
Kudos to Mr. Dhanuka and all of you are sitting from Millennium MEMS, and we really appreciate the efforts that you have been making to do what you have been doing.
So if I may just quickly, one last question, if I may be allowed, Tamalda. I'm Praveen Dwivedi from Evoke India Foundation, sir. So I think half of the people I know. So, it's my indeed privilege just to tell you one basic question, I think, which is about financial literacy, investor education. For last 10 years, we have been passionately driving it and working with RBI also. So money, when it comes to money, I think everyone wants to feel and, look and feel when you count the notes. And people want to have trust. Chris Wood spoke about greed and fear. And which is what grips people at villages and other places. So what I want to ask question, I think anyone can answer that question, is that, why not when we have bank like SBI reaching to the topmost, highest mountain range of India, why not mutual fund physical presence, either MFI or anyone, or some non-government, I know we are a non-profit, anyone, how can not we have a reach which can build some trust? I think that is where, while of course, Radhika rightly said that IFAs can be increased to 10 times, but that is one question I would want somebody to address. Thank you so much.
Quickly, because you are the MP person.
So I don't know whether that was a siren that you are right, that we should be doing it. I mean, that was, but I completely echo your point. I think all of us in last 20 years have invested a lot in expanding our reach. There would have been several branches which would have taken several years to even break even in terms of the AUM that we gathered, but we continue to invest in future. And over the next several years, I agree with you that we would need physical location. As much as we invest in technology, as much as we invest in our digital assets, we would continue to expand across the nook and corner of the
Thanks,
country.
Navneet.
And same thing with our RTAs.
We are really running out of time, but the last one sentence each from Bala, and this way, Reddy will have the last line. Just tell us one thing which we don't know about mutual fund.
One thing?
One thing, but take it as an investor education. So I'm not turning it into a grievance sale anything, but people have many questions on all. Each of you tell us one thing which you don't know about the industry. You're saying you are most transparent, everything is fine. But about future, about now, anything that normally it's not in public domain about the industry. One sentence each, quickly, from you.
Yeah, I know. I think we must ensure every neighbors invest in mutual fund. Because most of the people will not know whether my neighbor is invested. If the distributor doesn't know that my neighbor is not investing, therefore we should ensure that every neighbor of mine should be invested in mutual fund.
Okay.
I am very happy to say that we define happy customers. So 99% of our customers who have stayed with us for the last 3 years have got double-digit return. So that is what creates happiness in us. So if this is one thing that I love.
Things up.
No, my message is for everybody, and this message to go out, that if you are, I am sure all of us are having SIPs. Please, for God's sake, don't stop the SIPs. Don't take the money out of the SIP kitty. Otherwise, your returns will be half of what you are actually contemplating. This is the big message. Please, please don't look at it as a liquid thing that I can take the money out of it. Whatever for goal you have taken the SIP, please let it continue for that.
Okay. Nilesh, no, I'll keep you for the last, maybe at the song. Saurabh?
Yeah, see, there is a risk to investing. There is a risk to not investing. The risk to not investing in India is very large at this moment. Keep that in your mind.
Navneet, you spoke
And the
about
one fact some of
Navneet,
you might be aware, but
you spoke about sachet SIP. What is the
No,
lowest
so
now? What is the lowest SIP quantum
100
now?
rupees, yeah.
Huh?
100 rupees. Most of the
It
AMCs
can go
100
down
rupees.
below?
But the fact a lot of people may not be aware, and those who are confused, for them to remember this, that if you did 10,000 rupees per month SIP in SDFC FlexiCap fund, after 28 years, if you remain disciplined and kept putting 10,000 rupees per month, today the value in your statement is 14 crore rupees. I'm not saying that this will get repeated in next 28 years, but it just shows the power of compounding. It just shows the power of discipline.
In a country where there are so many divisions across economic strata, this, that, ye, wo, this is one industry that treats a 100 rupee investor and a 100 crore investor equally. When you come to purchase a mutual fund, we are the most democratic industry in the country.
Okay.
And this is one industry where if you want to take your money back, you will get it back in 2 days without needing to make a call to Radhika or visit a bank branch or fill out a form.
Thank you. Nilesh, I think you want us to stand up or something?
नहीं नहीं खाली सुन लेना बस
Okay.
So Dada, you रेड इन रामायण कि लंका सोने की थी, बट अपनी उम्मीद क्या है? जहाँ डाल डाल पर सोने की चिड़िया करती है बसेरा, वो भारत देश है मेरा, वो भारत देश है मेरा। सो सोने की चिड़िया अगर भारत में बसेरा करनी है तो म्यूचुअल फंड में इन्वेस्ट करना पड़ेगा, चॉइस नहीं है।
After this, I don't want to sum up. You heard them. I think you enjoyed it. So give them a big hand.
Thank you so much, Tamal. I think this is the first time I must also say that this entire panel discussion was also lyrical and musical, Tamal. So many panel discussions you have moderated, but this is one of its own kind. So thank you so much, our panel members, for sharing your insights, your depth of expertise, and your diversity of experiences. Brent Brown once said that stories are nothing but data with soul, and I think the conversation today was riddled with anecdotes, stories, statistics, not only from really the world of academia, but from the world of practitioners whose outlook, whose point of view has the potential to impact the future of BFSI. With this, ladies and gentlemen, I'd like to call Mr. Bharat Kotaskar for the next set. And thank you once again, panel members, for your insights and your pragmatic outlook being shared with us. of our panel discussion that's going to be explored by some of the most revered economists of India is inclusive economic growth still a mirage? India, ladies and gentlemen, at present is ranked 62nd out of 74 emerging nations by the World Economic Forum's Inclusive Development Index in terms of inclusive growth. This actually puts a stark contrast to whether we are or whether we are not growing with inclusivity. And to throw light on the same, I'd like to call on stage our stellar set of panel members, beginning with Mr. Sajid Chinoy, MD and Chief Indian Economist at JP Morgan. Can we give him a huge round of applause, ladies and gentlemen? And joining Mr. Chinoy on stage is Mr. Samiran Chakrabarti, MD and Chief Economist at Citibank. Ladies and gentlemen, can we show some more energy? All right. And then we have Mr. Soumya Kanti Ghosh, a Group Chief Economic Advisor at State Bank of India. Then we have Ms. Sonal Verma, MD and Chief Economist, India and Asia ex-Japan, Nomura. And then we also have Mr. Abhig Barua, Chief Economist at HDFC Bank, and Ms. Aditi Nair, Chief Economist at ICRA. And to navigate this topic and this conversation, ladies and gentlemen, can we give a huge round of applause for our moderator, Mr. Tamal Bandyopadhyay, Consulting Editor at Business Standard.
Hello, this is the economics panel, and I trust you, this is my last panel. You don't have to suffer me anymore. Okay, for today, this is my last panel. Sorry? You can't hear me. Okay, fine. Okay. They don't need any introduction. We are running little behind time, and this gentleman, they are the finest brain in that particular field. And the subject is inclusive economic growth still a mirage? So I'm sure there are a lot of people who will get upset that when you are talking about India is a growth engine and all, why you are asking this kind of silly questions. Now, sometime back, a few years back, our slogan was, we will become 5 trillion economy, rightly so, growth, etc. will be there and all. Now we have changed the track. We are saying, no, we will be the third largest economy in the world. In fact, this is even latest IMF also saying that S&P Global Market Intelligence said that by 2030, India will overtake both Germany and Japan. India will become third largest economy, second largest in Asia after China. So US, China and India, that's all about the story and all. And, but what is actually happened, what's the ground reality? We'll dissect with this finest brain, the two ladies and 4 gentlemen. We'll ask them, because if you see, I'm not getting into any kind of naming anybody or who is critical and all, but if you see some of the reports and data, etc., it says that, in one book, I don't remember exactly where I read, it's talking about Brazil sometime back was called Blindia. Why Blindia? Now 10% of Brazil was like Belgium, which is solid growth, very upmarket, and 90% was like India. So now people are talking about, recently one wealth manager spoke on a TV channel that this is the octopus generation, 10 million Indians. They are doing everything, they are grabbing everything, and the rest of it, we are 140 crore, that is 1400 million people, they have nothing much to show. And then you see some of the parameters like IT returns, number of returns are going up, but number of people filing IT is going down, and the quantum of IT income tax is going up, which means lesser number of people giving more tax, so they are earning more. You're talking about, you call it K-shaped recovery, whatever it is. You look at some of the trade data, imports of alcohol up 54%. Exotic food items, dragon fruits, preserved olives and high-value cheese import jump between 24 and 30%. Caviar, very small quantity but double. So all these luxury items are going up. People become rich. Rich people are become richer, but this is not percolating everywhere. Another thing, I'll stop here and rest of it we'll hear them. Household survey conducted by People Research of India's Consumer Economy Prize, a think tank, in 2021, amidst the COVID, found that incomes from the richest quintile of households have risen 39% since 2016, and for the poorest quintile, it collapsed 35%. Low and medium income Indians have also suffered unprecedented decline in their incomes. So that's the story, and we can reel, I can reel many data points, etc. I'll stop here, and this is my end of it, and my job is to provoke you and hear you. They're here to hear you people, not me. We'll start with Aditi, not because, typically we start from the right-hand side and end there first round. So typically is that, is it true the so-called K-shaped recovery, the rich have become richer, the growth is only for the wealthy segment, and it's not percolating down, despite all the talk of 5 trillion economy and becoming the world's second biggest economy by 2030? Or you are seeing no, this is a fallacy, everything is fine, hunky-dory. Carry on.
Thank you. Good afternoon, everyone. Very happy to be here again, second year in a row at Geo Center. So I think, K-shaped recovery is one of the things that economists have pondered on the most since the pandemic started. And we like to think of it in a couple of different ways. One is that some sectors clearly emerged as winners and others didn't do so well during the pandemic and after that. And different kinds of households also did come out with a differential impact on their income and their consumption levels after the pandemic. A lot of what Tamalda was just talking about does resonate. We see that there is a lot of unevenness as far as demand is concerned. Richer households are clearly consuming a lot of high-end products, which is what is showing up in these imports of dragon fruit and alcohol. And while a lot of not so well-off households do seem to be struggling, especially in high inflation phases, I don't think that it's entirely gloom and doom for that part of society either. I see a lot of aspiration, and I see that there is a lot of consumption at that price point. So at different price points, the kind of items that are being consumed are different. And certainly within our society, I do feel that we're going to find at different price points, different sectors will thrive. But more than that, I have an existential issue. India is the sum of its parts. And when we look at the state level, we've seen the divergence in per capita income widening quite a lot even over the last 10 years. So how can we talk about inclusivity when we have some states where in 10 years, their real per capita income has only gone up by 6,000 rupees? Whereas in the last couple of years, other states in a couple of years have seen their per capita incomes in real terms going up by more than 20,000 rupees. So we have an issue in terms of being able to take along every part of the country. And I think that is something that we don't talk about as much when we keep talking about the K-shaped in terms of sectors and households.
Thanks, Aditi. So you're talking about consumption. Again, you see when the consumption, the high-end car, you have to wait for 2 years after placing the order. But a relatively cheap car, you can just walk away with the car. High-end bikes, again, you have to wait. Relatively cheap bike, you can just buy right now. So that's the consumption pattern. I don't think it's changing very fast. Avik, up to you.
No, I think am I audible? I think I'd just like to go beyond the idea of a K-shaped recovery or unequal recovery when it comes to describing inclusion. I think you can still have growing inequality and have inclusion, although, the fruits of an unequal growth will not be evenly distributed. And I think, we fret too much about this K-shaped recovery, but I think the problem of unequal growth or uneven growth is twofold. One lies in the process of growth itself. And we come to the question of the employment impact of growth. So what we call the employment elasticity of output. And there are various issues here, but the bottom line is that if you take, various periods, if you take a very long period, output growth in India has not led to adequate job creation. This is a long problem. It has, I don't think it's sort of the, the post-pandemic K-shaped recovery is perhaps just an element of it coupled with various other things. So that needs to be addressed. There are issues of gender participation. There are issues of choice of technology, the incentives to adopt technology, which is, so I think it's a far more complex than just looking at, how much cheese and how much wine has been imported. The other thing is that, is to look at it indirectly and what is happening with the growth that is being generated. And some of it is being plowed back into welfare programs, which I would like to believe, given the data, are actually working better than in the past. And we have things, indicators like the multiple dimension poverty data, which the Planning Commission, along with the UN, has brought out, or simple income data, which seems to suggest that with the plethora of welfare schemes that have worked in between 2015 and 2021, we have some excellent numbers, and excellent numbers in some of the states that Aditi were talking about. UP, let me just give you a number. About, if you use the MDP, which goes beyond just the simple income definition of poverty and goes into things like access to sanitation, access to clean water, right? This shows, and I mean, there are issues with the methodology, etc., but this shows that 135 million people have been pulled out of poverty, defined in the MDP sense, between 2015 and 2021, and of the 135 million, 78 million have come from UP, Bihar, and Rajasthan. I think these are encouraging numbers. So I don't think we should necessarily see the glass half empty. I mean, I'm sorry, I'm forcing a metaphor, but I mean, there is a positive side to this. But I think the process of growth and how to make it more employment intensive, I think is a huge challenge, and it's a long-term challenge.
Thanks, Abhik. We'll hear you more, all of you, about the challenges and how to do that. You spoke about unemployment. Just a few numbers. National Sample Survey Office, that is NSSO data, which is recently released, talks about decline in India's unemployment rate in urban areas to 6.6% during April-June 2023, against 7.6% a year ago. That's the NSSO data. Unemployment is going down. CMI also says that in September, unemployment rate falls to 7.1%, which is 1 year low. But if you go back little beyond that, earlier, I am quoting a World Bank ILO report, actually, International Labour Organization. In 2022, it says youth unemployment rate in India 23.22%, which is higher than Pakistan, double of Pakistan. Pakistan 11.3%, Bangladesh 12.9%, Bhutan 14.4%. So this is 2022 youth unemployment. And what is youth they are talking about? The workforce who are aged between 15 and 24 years without a job, but actively seeking one, which Mr. Narayan Murthy spoke about, 70 hours work. So this is that particular segment, that youth, which should work 70 hours, but 23.22% of them do not have jobs, or rather did not have jobs as of 2022. That's World Bank report, and it's as I said, lower than, much higher than Pakistan, Bangladesh, Bhutan. It's equivalent to, not even higher than Syria, Indonesia, Malaysia, Vietnam, South Korea, Singapore, China, everybody else. So anyway, sitting in Singapore, every 2 months you come to India for a recce. So tell us, how do you see India's growth? Do you miss?
Sorry?
You must be missing India from there?
Of course,
Yeah.
without a doubt. I mean, I would make 3-4 points actually. One is, if you take a step back, I think this is actually a challenge globally. This is not just about India. And over the last decade and more, the role of technological changes, globalization, financialization has actually increased income and wealth inequality worldwide. So a number of countries are actually facing this challenge, and of course India is as well. Second, I think, the concept of inclusion, and, this is something that Abhik was referring to, is more broad-based than just income inequality. There are it's a multi-dimensional concept, and when we talk about inclusive growth, it is, of course, income inequality, but we have to also look at, access to health, access to education, employment opportunities, entrepreneurial opportunities, financial inclusion. So there are multiple dimensions to inclusive growth. We are obviously focusing on the income and maybe the rural, urban, and interstate dimension of growth. But if you take a more holistic approach to whether, inclusive growth is a mirage or not, I think in some of the parameters, for instance, access to maybe health, crop insurance, social security on, rural employment guarantee, I think India is making progress. And then there are certain other aspects of inclusion, such as employment opportunities, maybe even on education, where there's still a lot of work to do. Now, third, I think, focusing particularly on this income inequality and sort of rural-urban divide that we are seeing in India, I mean, I do think that is the case. You can see that in, any kind of high-frequency data. And I think the rural terms of trade, particularly over the last 5, 6, 7 years, have seen a moderation, and a good part of rural incomes today, of course, comes from non-farming activities. So it's not just about agriculture, but also the income opportunities that rural have in the non-agri sector. So we need to focus on that as well. And just finally, I think, from a sustainability of growth perspective, it is extremely important that we lift, the segments that are not contributing to growth, because when we look at sort of the composition of growth right now, a lot of that is being driven by public capex. You need public capex and urban consumption. You do need rural consumption. You do need private capex to kick in for this growth recovery to be more sustained over the medium term. So from that perspective, it is an issue.
Thank you. So these two ladies and one gentleman, all economists on my right side. Sort of, Avik says it's glass half full and half empty, that kind of look. Aditi says, yes, there is some kind of inequality, etc. she is seeing. And Sonal says, in certain aspects, we are doing pretty good, access to health, access to toilets, etc., etc. But in certain other aspects, including education and, of course, employment and income, we need to do much more to have an all-round growth, right? We'll come back to you. All of you will ask you suggestions because election round the corner. Government will be listening to you. Soumya, over to you, representing the India's largest bank and world's among the top 50 banks. You are the chief economist of the group. So tell us. I'm sure you have a very different point of view because your writings show that.
Yeah, thank you, and thank you for giving this opportunity. I think in the last 3 to 4 years, there has been a lot of writings which has gone about alphabets and alphabet-based recovery, which is basically means K-shaped. Someone calls it V-shaped, L-shaped. So there are different alphabets which have been thrown about. Without getting into these alphabets, let me just quote you some numbers which shows that where we are, what we may need to do. I think sometime back there has been reports saying that India, there has been an increase in the inequality. Now, some of the indicators, very quickly if I look into, one of the indicators which is often brandished is basically people are taking in preponderance of gold loans. If you actually look into the data on gold loans, they are taken mostly by the richest states, southern states. So by that logic, it means that the southern states, the which are actually the richer states in India, Karnataka, Tamil Nadu, Telangana, Andhra Pradesh, and all those places. So by that logic, I think the richer states are actually more in jeopardy, and the people there are taking gold loans. Similar arguments have been made about two-wheeler sales, these sales, but if you look into the data dispassionately, we'll find out that the number of electric vehicle sales have significantly shot up in the last 4 to 5 years, which was zero at some point of time. So you need to do an proper analysis to understand what is the reason for why this increase may have been staggered over a period of time. Now let me come back to the this argument part. I think in the last, if you look at the last 10 years data, I think someone was talking about states also in the beginning. If you just look into the states' per capita incomes of around 29 states over a period of the last 10 years and do an typical in economics which is called the Gini coefficient analysis, you will actually find that the inequality between the larger states and the smaller states are narrowing. Of course, there is an issue in absolute numbers, but anything in economics in absolute need to be looked into in terms of GDP. In terms of the income tax returns, which Tamalda just mentioned, there is a lot of discussion on the income tax data, but in August we had done a study which showed that 13.6% of the overall income taxpayers has migrated from below 5 lakhs to over and above. And very recently we did another study whereby we wanted to understand that there has been a huge formalization of deposits to the Jan Dhan accounts. Around 50 crore accounts have been formalized, more than 2 trillion numbers, whether there has been any impact on the credit. And we found out through our regression analysis is that people who have taken Jan Dhan loans, basically formalization of deposits, that is driving formalization of credit in a significant manner. One of the examples is the Prime Minister Swanidhi scheme. I am not getting into the details of that because the data is available on public domain. But there also we found out that the scheme is structured in such a manner that if you pay back the 10,000 rupee loan, which is, of course, people may argue is a small amount, you get a loan of 20,000. And if you pay back the 20,000 loan, you get a loan of 50,000. So in aggregate, you are getting 10,000, 30,000, 80,000. And the persistency ratio, meaning that the people who are giving the second loan out of first loan is 68%, and third loan out of second loan repayments is 75%. That means the marginalized are also clever. They are getting integrated into the credit system. And I think it is one of the best things which is happening currently, that formalization of deposits is also leading to formalization of credit at a significant pace. And if you do an spending analysis also of those people, for example, sample with the Jan Dhan accounts who has been given a Swanidhi loan and who has not been Swanidhi loan, you will find that the people who have taken a Swanidhi loan is actually spending on items of mass consumption, which is not very different from the people in the upper echelons of the society. So I would like to end here by saying that yes, India is a large economy. There will be always challenges. But I think we need to accept the reality that there has been a lot of structural transformation which has been happening in the last 4 to 5 years. And at some point of time, these numbers will actually try to show up on the headline GDP growth. And that is one of the reasons. Last year, almost all of us were caught by surprise when the growth rate clocked 7.2%. And this year also, the prognoses have actually moved up from low 5% to mid 5% to 6% to towards 6.5%. Hopefully at the end of the year, these estimates could move northwards of even the RBI projection of 6.5%.
Thank you, Dr. Ghosh. So, Dr. Ghosh, I will not say demolishes all the theory that we have been discussing, but he has another set of data which exactly says the opposite. The things are happening actually. Things are happening. There is inclusive growth happening. More and more people are coming into the credit net, so on and so forth. We'll hear the two other economists. Yeah, over to you, sir. Samiran from Citibank. Yeah.
Thank you, and thanks, Business Standard, for this opportunity again. So let me start off by saying that it is quite natural for income inequality to worsen when a country witnesses very high GDP growth. This has happened historically in over centuries. And it's also quite natural that when you have a significant supply side shock like COVID, that also worsens income inequality compared to normal times. So that way, some worsening of income inequality is, if I may use the word, okay. The question is that it should not cross a limit beyond which it starts affecting in a more socio-political way. With that prelude, let me delve into 3 different aspects of inequality that I think are important. The first aspect is with respect to employment, the second is with respect to wages, and the third is with respect to the regional aspect of inequality. So if you look at the employment part of it, what we are witnessing is that compared to pre-COVID, the manufacturing employment is down about 15%. And what has changed is that the employment in construction has significantly gone up. So people who have lost jobs in manufacturing has mostly moved into construction. But since manufacturing jobs are relatively more well-paying compared to the construction jobs, the overall income inequality must have worsened because of that. Another key thing is that urban employment is not growing as fast as rural employment. That's another sign of income inequality worsening. Another aspect of employment is what Shomo was referring to. If you look at the PLFS data for FY23, 2023, it shows that in 1 year, there has been employment growth of 25 million people. It has never happened in the past. But out of this 25 million people, 23 million are self-employed. The actual wage employment is only up by 2 million. Now that's where all these newer people are coming into the workforce. It's great, but it's just that the self-employment people, they don't earn as much as regular wage workers. If I move to the wages discussion, there are 2 elements to it. One element is that there are 122 million people out of 580 million people who are in salaried employment. That's the best kind of employment. In that 120 odd million people, the average wage is 20,000 rupees a month, less than $300. But if you look at that versus the self-employed, there is a significant difference. It's almost half. And if you look at another aspect of wage, which is the gender equality, you'll find that within the self-employed, who are like 350 million of them, the female wages are 1/3 of that of male wages. In regular employment also, it's 2/3 of regular wages of male employees. So there is significant inequality within that wages also. And I will end with the regional inequality part, which Aditi and Abhik was referring to. For me, the most interesting data point is that if you aggregate the per capita income of northern states and southern states, north and eastern plus south and western, you will find that 10 years back, the per capita income differential was $900. In 10 years, that per capita income gap has doubled to $1,800. So north and east versus south and west, the per capita income gap is doubling in 10 years. And why this is important is that the demographic dividend that we are going to see over the next 10 years, 42% of people entering the working age population in India will come out of just 2 states, UP and Bihar. Right now, UP and Bihar are contributing 25% of the youth population, but incrementally, they will be contributing 42%. That's a staggering number to me. So unless we have a more equal regional distribution, managing this demographic dividend will be a big challenge. Let me stop here.
Thank you, Samir. And so a lot of homework, each of them have got a lot of homework, a lot of data showing the real picture. I think government is also aware of the unemployment scenario, which is why Honorable Prime Minister Mr. Modi recently distributed 51,000 employment letters under a special scheme. Over to you, Sajid.
Thank you, Tamal. First, let me just say thank you to Business Standard for having me here. I think we need to just step back. I don't think this is a 3-year phenomenon. I think we need to go back 15 years and go back globally. That I think what was very clear after 2009-10, after the global financial crisis, was that globalization as we knew it for 20, 30 years had been extremely unequal. People were drawing these elephant curves where the top 1% did very well, people in China did very well, and then the entire middle class in the US, in parts of Europe, and other emerging markets had been hollowed out. Blue-collar jobs had been hollowed out. So I think the challenge for blue-collar job creation, which is at the heart of rising inequality, was that there have been several headwinds. First was the China shock, that as China became the manufacturing workshop of the world, it hollowed out blue-collar from different parts. Barely had that alleviated, that we saw post the global financial crisis, that the cost of capital had come down to ridiculously low levels. The choice of monetary policy so dominated fiscal policy that in my mind, it was exactly the wrong policy mix around the world for 10 years. When cost of capital goes to zero and fiscal policy is contracting, that widens inequality. So the second challenge to blue-collar workers, the first challenge was China, the second challenge was capital. Because when the cost of capital came down so much around the world, including India's exports, you saw capital-intensive means of production. Barely had we navigated that, and came the third challenge, which was COVID, which, as we know, around the world was very Darwinian. It was survival of the fittest, any which way you look at it, socially, health, economically. And that accentuated this even further. And now we're facing a technological challenge. If you think about AI, as we were discussing before, every industrial revolution has meant that the share of capital has increased and the share of labor has reduced. And so if we're in the midst of another technological revolution in AI, that means the odds are stacked even further against labor and blue-collar workers. So I think the central challenge, Tamal, is this is not a COVID phenomenon, this is not an Indian phenomenon. The world has been struggling and grappling with how do you create blue-collar jobs. Now, why is this more pressing for India? Because if you look at demography, most populations are aging. The working force in China is now contracting. They don't need to create those blue-collar jobs at the pace and scale that we need to do. And so for us, this is of particular importance the next 10, 15 years. Here's the simple reality about growth. No country which has not been endowed with natural resources like a Saudi Arabia or an Australia has been able to grow at 7, 8, 9% for 10 years, 20 years like we need to with our export growth. It just hasn't happened for a large economy in the last 100 years. So India's challenge is going to be to create blue-collar jobs, which is at the heart of compressing this inequalities. How do you get exports and manufacturing exports? Now, we've shown to the world in the last 3 years we're very good at service exports. Creating white-collar jobs is our revealed comparative advantage. But the challenge is going to be how do you create blue-collar manufacturing jobs and get the kind of structural transformation that China saw and what Shaumiran alluded to. Pulling people out of agriculture, pulling people out of construction into higher value-added, more productive blue-collar jobs. Here's the opportunity. Everyone speaks about China plus one. These things happen every 40, 50 years. So I think the next 5, 7 years becomes absolutely crucial because once these companies decide to relocate, they will do so only once in 40 years. It will not happen every decade. India's challenge is the following, that we're not competing only with Vietnam and with Mexico. We're actually competing with the US and EU because they've got massive industrial subsidies to reshore activities. Last thing I'll say is, the China plus one is well known. What's less well known is that as China has focused more and more on technology, right, they have vacating large amounts of space globally in labor-intensive, low-skill manufacturing. That part is not fully appreciated, that a vacuum is opening up. Now, this is where India's opportunity the next 10 years is. That if we can grab some of what China's leaving behind on labor-intensive, low-skill manufacturing, that becomes the route to solving a blue-collar job problem and an inequality problem.
But Sajid, the PLI scheme, isn't that answer for this? That's what we,
I think that's
that Make in India project and PLI scheme?
Tamal, I think in a world where industrial policy has become so fashionable, I think the PLI scheme, is perhaps necessary, but question is it sufficient? I think for India to attract the kind of FDI we will need and the jobs we create, it will have to be PLI plus, 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 plus. What is the plus, plus? It will have to be infrastructure. It will have to be trade facilitation. It will have to be factor market reforms. It will have to be a competitive exchange rate. It will have to be getting part of mega regional trade agreements. So I think there's a whole package of measures. And to be fair, it's not all gloom and doom. We've started down that road. We've begun down that road. We're seeing some of the benefits in some sectors, but we have to keep walking down this road for many years to grab what is a unique opportunity.
We'll talk about that more. We have We have completed 35 minutes, we have 25 minutes more. We will take a few questions like the previous panel, so please keep the microphone ready. And gentlemen and ladies, keep your question. We will come back to you, But before that, we'll have quickly little different stuff related to that only. Maybe Aditya, once again, we'll start with you. Very briefly, Reserve Bank of India governor says that we are the engine of growth. Financial sector stability and growth. These are the two things which distinguish India from the other nations and all. But whatever the geopolitics we are seeing, which was earlier Russia and Ukraine, now we have spilled over to Middle East, and it looks like more critical in some sense what's happening in Israel and entire Gaza Strip. We are seeing currency, not rupee, but overall other emerging market currency dollar index is going up. We are seeing what's happening in US Treasury bill yield and the shrinkage between US Treasury and Indian Treasury bill yield. We are seeing banks suffering more from interest risk in the credit risk historically. I'm talking about overseas and all. So can we remain decoupled from all this wave and all, and remain wherever we are? Because already we have seen the past 6 months, the outflow of foreign money is some decadal high.
So my view on the macros for India is that our own domestic macros are quite well positioned. I am quite constructive as far as our own domestic consumption and infrastructure-led stories are concerned. And I do think that that is something that can sustain its momentum over the next few years. Barring a few hiccups, I mean, we've had a bad monsoon. We do have issues like tepid global demand for our merchandise exports in particular, and a few other reasons that we feel that growth will slow down in the second half as compared to the first half, especially as we get closer to elections. Naturally, the momentum of government capex will have to slow down around the time of the Model Code of Conduct and the elections. But other than these specific issues, overall consumption, the aspirational young consumer will keep demand high as long as they have meaningful employment. And I think all of these discussions will keep coming back to whether we can create that meaningful employment or not. But on the other items, I mean, certainly where the rupee is right now, where the yields are, if there is an event risk globally, then perhaps we will be in a position where suddenly over the next few months, we could see a meaningful change as far as our exchange rate or our yields are concerned. But that would be again in line with what's happening in the rest of the world. It will not be for domestic factors. If at all there is an event risk which happens globally, then certainly I don't think that our rupee or our yields will be completely immune to that, and there may be some transmission to our rates as well. But that would be more from the global side. Commodity prices is something that, in all the scenarios that we're analyzing, it's unlikely that we'll be in for a period where globally commodities will go into a super cycle. So we feel that the base case is very much that commodities will remain range bound. Everything other than oil. Oil is more tightly controlled by the suppliers, so there, it's easier for them to move prices up. But the world economy doesn't remain in equilibrium for very long if crude stays above 100. So naturally, we start seeing that there is a cap and there are downward pressures on the crude oil price as well. So for a commodity importer like India, the baseline scenario still seems to be quite constructive.
Okay. Aditya feels macro is pretty strong to withstand all the global headwinds, which I did not mention is the oil. Also, Reserve Bank of India estimate 85. Now it's 90, 91 kind of thing and all, exceeded 90 and all. So anybody has, from you to anybody else, want to add anything? How strong is our macro and how decoupled we are from the rest of the world?
Ironically, I wrote a piece for the Business Standard 5-6 weeks ago arguing that the pressures we saw in 2022, Tamal, were in fact more acute than 2013. We're at the 10th anniversary of the taper tantrum, right? And in 2013, what happened was the rupee was the worst performing currency in emerging markets. Interest rates actually had to be raised by 300 basis points in India overnight. We had to have a subsidized NRI bond, and there was a lot of pressure. Last year, nobody even realized there was the economy is under so much pressure because I think we've learned over the last 10 years. And the three things we've done very well, I think, is build lots of buffers. Reserves were almost 700 billion. And those buffers have allowed us for our monetary policy to diverge a little bit from the center country. The interest rate differential between India and the US used to be 550 basis points in 2018. It's now 100 basis points, and nothing broke. So I think we have buffers. Inflation, even though it's flirting at the 6%, is much lower than where it was 10 years ago. The current account deficit down. Macro fundamentals have improved. The challenge is the following, that India has normally a natural hedge externally. When you have higher oil prices, because of the inverse correlation between oil and the dollar, you get a weaker dollar. So when the current account widens, when oil is high, the capital account gets supported because the dollar is softer. What's happened in 22 and 23 is you're seeing that because of US exceptionalism, the US economy is accelerated to almost 5% last quarter, even as Europe is stalled and China has disappointed. And I think this could continue for a while. So we have to brace ourselves that you will get higher for longer in the US. And because the US is outperforming the rest of the world, the dollar will strengthen. Now, coinciding that, you've got oil going up for a variety of reasons, geopolitical issues, OPEC. So the challenge for India in the next 12 months is going to be that the hedge is gone. You could see your current account under some pressure. You could see your capital account under some pressure. Thankfully, we've got enough buffers and more to absorb that. Last thing I'll say is, I know Sonal also covers Asia. I think Asia more generally is facing this trilemma issue. Because if you look at Asia's recovery, we're still 7-8% below our pre-pandemic path. And left to its own devices, Asian policymakers would have much rather focused on domestic growth and inflation. But they are unable to do that because the exchange rate is very stable, your capital account is open, and therefore at the margin, you're forced to react to what's happening in the US. So this is a pretty hostile global environment that emerging markets in Asia will have to contend with in the coming quarters.
But we have enough buffers, that's what you're saying, right? So anybody else join, please. Please. Yeah, take this. Is he audible? No? It's like England's wickets. Microphone, sir. No.
Evidently, you don't want to hear me, so.
It's like yesterday's match, England's wicket.
No, I just wanted to sound a general note of alarm.
Please, please.
I'm kind of a little freaked out at this moment because I think the frequency of crisis has increased, and you have climate events in which are getting worse. I thought the Ukraine conflict was the end of the geopolitical strife, but then you have what happened in Gaza. We really don't know where that will head. We have Chinese housing lenders sitting on tons of potentially bad debt. So I think we're in a world where crisis is the new normal, and I'm not too sure whether the conventional tools of macroeconomics, which do recognize crisis, but treat it as somewhat of a rare event in your happily managing business cycles, whether that will necessarily work, or whether we need to have a more aggressive buffer building, preparing for contingencies kind of macro policy. And this is not certainly confined to India. It's a global challenge. But I really don't know whether we're really prepared for a world where we sort of lurch from crisis to crisis. This is not new. It happened in the first half of the last century. So yeah, it's very Nietzschean in its manifestation, but there we are, and I'm certainly very worried and very frightened by what is happening around me.
Okay, thank you. Yes, go ahead.
So, on a lighter note, one of the debates we've been having internally is whether EM is the new DM, because you have US yields moving 20-30 basis point every day, whereas EM yields are actually quite well behaved. So we have seen more prudent policy making in EMs. Certainly in Asian EMs post. Now, I think there are sort of three shocks that India is facing right now, and broadly within the global context. You have the food price shock because of El Nino, the potential oil price shock because of the Middle Eastern tensions, and of course, the currency-related pressures because of the US exceptionalism. On all these three fronts, I do think India has buffers at this stage. We are self-sufficient in food. We've essentially kept retail prices unchanged, so the loss is being borne by all oil marketing companies. Retail has not really paid for higher oil prices, and we have FX reserve buffer. Completely agree with Abhik. I think there is absolutely no room for complacency because we don't know the duration of these shocks. The world that we live in, where geopolitics is becoming a new normal, we could face downside risk to growth just when there are upside risks to inflation picking up. So I think as a country, we need to build macro resilience. So whether it's on monetary policy, fiscal policy, exchange rate policy, macroprudential policy, but building resilience is the main focus for India right now.
Thanks, Sunil. You want to add anything?
Yeah.
Please.
I just want to give a little bit different dimension to this global issue. The first thing is that I'm a little bit concerned about the global economy because if I take the example of last three instances, I think in 2007 what the Fed said, in 2001 what the Fed said, and I think in 1990s what the Fed said, what turned out to be 6 months later was exactly the opposite. I think in 2007 it said that the economy is doing quite well, and you know what happened in 2008. So this time we are all saying that the economy is for a soft landing, but a lot of data points from the US suggest that there is an element of household stress. Auto loans is for an example where the number of delinquents and other things have actually gone up significantly. So that is one thing we need to keep watch on. But the second thing which actually gives us, I think, a lot of pleasure is that our central bank and our government this time has worked far better, far in unison than the developed countries' central banks or even the government. They have been prudent. They have been adopted the policies in a coordinated manner. And I think there is a lot of things, and even recently the banking crisis which happened in the Fed, I think in terms of the interest rate ones, I think in terms of all these regulations, supervision, fiscal management, monetary management, I think we have shown that we actually could be an example of how an effective policy coordination could stave off from policy crisis. So that is, I think, one thing which we should not learn. I think the entire world should also learn that how responsible should be policies in times of crisis.
Thanks, Soumya. Yeah, Somiran, last word is yours, and then we'll open the floor a few questions. Yeah, please.
It's now quite well established that from this trifecta of rising crude prices, rising dollar, and rising rates, we have created enough buffers. I think the elephant in the room is what happens to global growth. See, what has happened is that last year around this time, we were talking about a global recession in 2023, and that just did not happen. As Sajid just mentioned, US has clocked a 5% quarter. So now we have turned the other way, and almost no economist is talking about the possibility of a recession next year, or at least not talking about it very strongly. Now, if I go by Citi's house view, we have a US recession call next year. Our global GDP growth forecast for next year is only 1.7%, vis-a-vis almost 2.8, 2.9% this year. Now, I know that India has so-called the lowest beta to global growth among most of the Asian countries. But still, if global growth next year is only 1.7% with a US recession, I think as economists, we are underappreciating that risk in the Indian context.
Just take 10 seconds, 2 points, Tamal. One is to the fiscal monetary coordination. You know, people don't fully appreciate in the US, as the Fed was raising rates to 500 basis points to bring inflation down. Guess what happened to the US fiscal deficit this year? It widened by 3% of GDP. So there's, right? And that is one of the reasons why growth has been so strong. If India had done this, this would have been called Fragile 5, 10 years ago. Now, I think Shamalan makes a really good point. When US yields are close to 5%, And given that you will not get this 3% of GDP fiscal expansion year after year, you cannot get it given where debt levels are, it becomes very hard to start thinking of a soft landing. At 5% US yields, the odds of two tail events increase. One tail is you have an accident at some point in time, somewhere around the world, breaks, we don't know what asset class will. It's not about 5%, it's about being close to 5% for many months and quarters. It's the duration of that stress. And secondly, the odds of a hard landing, in JP Morgan we call it boil the frog. You're cranking up the temperature and further, that the odds of a hard landing. So we should not take comfort from the fact that US yields are 5% and things are okay. It increases the odds of something break soon, and when things do soften, we go into a hard landing. So this is a very hostile global environment that we cannot be complacent about.
Thanks, Ajit. Yes, we'll have 5-7 minutes. So one or two questions you can take quickly.
Yeah.
Please.
My name is Nimish. I have a question for the panelists. Inclusive economic growth being as old as communism, I wonder if India's answer to that is India Stack. Three examples that come to my mind. One is UPI. A beggar or anybody on the stage has the same access. Vaccination. We all had the same access. Going forward, democratization of credit as the intent of next India Stack product is. And lastly, ONDC. Would love to know from the panelists, is this really the answer that the world is also looking for?
Okay. Very quickly.
Yes, I think I think Sonal mentioned various elements, and the others have mentioned various elements that go beyond inequality, in economic inequality, and help in inclusion. So I think the democratization and free access to these platforms, be it credit, be it skills, we now have the PMKVY, you have the UPI, certainly enablers in this very large matrix that would sort of have to come together to ensure full inclusion. So I think, yes, certainly, yes, but I think you shouldn't expect, clear, I mean, there is no one solution. And let's not seek just the one answer to what is a very, very complex and multidimensional problem.
Thanks, Avik. The second question, yeah, this gentleman, sorry, we're running out of time. Quickly, whoever, just.
So we have seen India doing well than the rest of the world. As the inflation goes down, will it be possible for RBI to decrease rates in spite of US Fed not doing so?
Okay. RBI rate cut, when do you expect? Anybody? Komiron or whoever was answer. What do you expect RBI rate cut?
Well, we think that RBI's rate action will be primarily determined by India's own growth inflation dynamics rather than what's happening globally. And in that context, as RBI has been repeatedly saying that the inflation has to come down closer to 4% on a durable basis for them to cut rates. So our sense is that the first rate cut is probably middle of next year. It will be a function of whether by then we start forecasting at least a closer to 4% inflation on a more sustained basis.
Next calendar year you meant, or fiscal year?
Yes, next calendar
year. Yeah, next question please. Quickly, sir, will come. Quickly.
Recently, we have seen lots of gaming app like Rummy and online, like the gaming betting actually in our India actually. So how are you going to deal with the NPA generated by this industry actually, especially the credit line given by the banks recently to this gaming industry?
Lending apps.
No, betting apps.
Gaming apps, I don't think
like Rummy and all the stuff like that.
This panel, I'm not very sure whether economist panel, no.
So yeah, I'm Praveen here from Avoken Foundation. So we work for financial literacy and financial inclusion. Just want to understand, in terms of India's decoupling from the global prognosis of recession, which is looming large, the day US data on unemployment comes. So how do you think India will be impacted? How
Sir,
much
we have already discussed the decoupling part. If you are there, we already discussed it here. Can this gentleman have it, please? The last one, these two, quickly. We just only previous round we discussed decoupling. Yeah, please. Sir.
Yeah, hi, morning. I'm Hitesh. In the morning, Mr. Chris Wood, he just termed the possibility of foreign investments into India as cumbersome. So we discussed this morning that recession next year, China +1. China's growth is 3% versus ours is 6%. How would you, as an economist, see this, or have an option to create an impetus for global funds to come into India from that perspective?
Global
Yeah,
funds to come to India, how to make it attractive? What? So we want to answer? You want to answer? Quickly. Okay.
I mean, have a tidy house if you want guests to come in. So we need to set the right reforms and funds will come in. It's as simple as that. Growth and macro stability both.
So, Soumya want to add?
I just want to add one point to one of the earlier questions. I think this is again pure data. Somebody was talking about democratization of credit. I'll tell you one thing in terms of debit card transactions. What we found out that people, this is over a huge sample because 70 lakhs, there's a large sample around 10 lakhs. People at the bottom of the pyramid who are doing 1 to 10 transactions in a year, that number has declined by 9.6%. So 9.6% of the marginalized people in the 1 to 10 debit card transaction in a year has now moved to 10 to 20, 20 to 30, 40 to 50, in some cases more than 100.
Thank you. This gentleman, yeah, please, can you? This is the last question, yeah. Then we'll round up, yeah.
So I understand that the global economy is in doldrums, in particular the US, but of course the Europe and China as well. But how, what I could also gather is it's okay for India to be considered as a safe haven or in an oasis of peace. But I don't entirely believe, like you mentioned, that RBI will only look at domestic and 4% inflation, and that's all that'll be the, or rather that'll be the primary driver for interest rates. But two data points I want to ask you of. One is that RBI sold $100 billion just to manage the currency a little while ago. And very recently, they announced buying of bonds, which can only tighten interest rates rather than reduce it. And my understanding, no, I'm not an economist, is primarily to hold the interest rates, or that action would tighten interest rates, and the action is primarily to control the currency. It's 83.30 now. The 83.40 is a key number. So how can we, as an investor in the Indian equity markets, which is probably larger part of the audience here, remain complacent about what's happening around the world and believe that we are in our own cocoon, safe and hunky-dory?
Thank you. Anybody, just essentially decoupling or whatever you said there.
I think from an exchange rate perspective, there are two things which are important. One is inflation differential, the other is productivity differential. So what we have been arguing is that if RBI focuses on domestic inflation and keeps inflation lower than rest of the world, then the currency does not need to depreciate. So just to give you a perspective, last decade, the average inflation differential was 320 basis points between India and rest of the world, and the currency depreciated 400 basis points every year. This time around, our inflation and global inflation are almost the same right now. So we don't need to depreciate. The second is if global economy is growing at 2-3% and India is growing at 6-7%, then there is a productivity differential which would also help the currency to be on an appreciating bias rather than on a depreciating bias. So RBI does not need to necessarily have an interest rate differential argument to control the exchange rate. It can do it by inflation differential and growth differential.
Thank you. We have come to the end. From you, just one sentence each. Sajid, we will start with you. Elections round the corner. We have spoken about uneven growth. glass half full, half empty. We have spoken about macroeconomic stability, and we have enough buffer to tackle the geopolitics and everything else. One line suggestion for the government on this entire macroeconomy and economy and this front. Government, Reserve Bank of India, the authorities I am talking about, starting with you and ending with you from there. Just one sentence suggestion.
I think the evidence, since this is the 10th anniversary of the taper tantrum, I think the advice is self-evident. But one, I think that this government has followed very diligently, that macroeconomic stability is the foundation on which growth prospers. We've been down that path over the last 10 years. We should continue to go down that path. That do not compromise macroeconomic stability in the pursuit of short-term growth. And that is something that this government has taken to heart. So I do believe fiscal deficits will be met, inflation will be in the band, and we will be building buffers.
Shamiran?
I'll have a slightly radical suggestion. I would say that include social housing within public sector capex. And right now, the spending on housing is just about 0.2% of GDP. Increase it to about 1% of GDP. This sector has the maximum employment elasticity. That will solve the inequality problem the best.
I have also one suggestion. I think at some point of time, the fruits of the indirect tax code, indirect taxes revolution should cater down to the direct taxes revolution. I think we should have a tax system where both the direct and indirect taxes should converge. So ideally, there should be, tinkering with the direct tax rate at some point of time so that the tax transparency and the compliance goes up further. We have now 10 million, 10 crore taxpayers, which was 3 crores at 10 years back.
Thanks, Amin.
In the context of inclusive growth, I think we need to focus on ways to build more entrepreneurship. Could be access to different things, because not only are you generating employment, you will enable somebody to actually generate more employment and asset creation over time.
Don't be, for the government, don't be tempted by short-term fixes like using protection to grow domestic industry. We've had a rather unsavory history of that. So just be careful. Just walk the right path.
Aditi, last word is yours.
So I'm going to say something that's slightly more medium term.
Please.
Stick to the medium term fiscal consolidation path, which has already been announced. Don't deviate from it. And within that, it's going to be tough to find more space for capex, but it will have to be found somehow to make sure that the infrastructure story continues at the momentum that we've seen in the last couple of years.
Infrastructure story should continue. So, yeah, ladies and gentlemen, thank you. We could have gone on and on, but just time is up. So, give them a big hand. And goodbye from me, my side.
All right, I think it was immaculate, very distinctive, and immensely cogent. Can we give a huge round of applause for our erudite economists for sharing their most candid, intuitive, and analytical take on the inclusivity in terms of economic growth of India. Thank you so much for that very engaging narrative and dialogue. Ladies and gentlemen, up next is another riveting and engaging conversation that's going to take place between Mr. A.K. Bhattacharya, editorial director at Business Standard, and with Mr. Sameer Nigam, founder and CEO of PhonePe. We're going to start that conversation in a few moments from now, so I'd request you to stay as he makes his way on the stage. And navigating this fireside chat is going to be Mr. A.K. Bhattacharya, Editorial Director at Business Standard. With this context, Mr. Bhattacharya, the stage is all yours.
Thank you, Ridhima, for this introduction. Just to sort of, instead of welcoming Mr. Samin Nigam in the usual and traditional way, I want to ask a question to the audience here. And if I can get a quick answer to that question, it would be wonderful. May I ask, and you can give me the answer maybe in a raised voice, that which is the largest car maker in this country? Maruti. Wonderful. Now, the person I am having right now with me, Mr. Samin Nigam of PhonePe, is actually the Maruti of India's digital transaction. You know, it's Maruti's market share is right now 42 or 43%, but Mr. Nigam's PhonePe is now close to 50% of India's digital transaction that take place in this country. Now, Mr. Nigam his background is very interesting. He was a computer science master's in the US, and then he set up his own startup, and this was a startup called Mime 360, right? And that Mime 360, which was a digital media distribution platform, got sold to Flipkart in 2011, am I right? And in 2011, obviously as a result of that acquisition, Mr. Nigam became part of Flipkart. And then by 2015, with the new owners of Flipkart as Walmart, PhonePe was set up. And 2015 to now, 8 years, you have seen that 49.8% to be precise, the latest numbers of August, are the transaction that the share that PhonePe has. So a big round of applause for Mr. Nigam for this achievement. Samir, if I may call you and call me AKB, my question to you to start the discussion would be, why PhonePe? I'll tell you why I'm asking this question. There's Google Pay, which is PAY. There is Paytm, which is an abbreviation of ATM and all that. Now, PhonePe looks to me, is a work on kind of a bilingual, nuance. Now, was that the idea, or how did it come about? Can you tell us a little more about how did PhonePe name come out instead of phone, PAY, why it was PE?
So, my co-founder Rahul, myself, we left after 4 very, very meaningful and fun years at Flipkart. Prior to that, Mime, which you mentioned, was a music venture. So 12 years ago, I was selling MP3 music, and digital payments was really painful. Our funnel drop used to be 99%. People would come, add songs to their queue, and then say, I'd rather go to a torrent than do two-factor authentication. Yeah. Then at Flipkart, 4 years later, while e-commerce was exploding, anyone here who might have tried the first Big Billion Day and remember that fiasco, all of the payment rails broke. So I think we were pretty clear that we want to do something around the payment space, but we couldn't agree on anything else. So my co-founder was very interested in financial inclusion and financial services overall. That partly explains why we've now entered into lending and insurance and wealth. I was way more interested in building infrastructure layers. So payments to me, like search, like networks, it's the infrastructure layer of the economy, which is why we've invested behind the Indus App Store, or we are working on ONDC. So we couldn't actually agree on what the reason for existence was, but we knew there's some payments in there. So just as they say, bato bato mein, it was a Hindi conversation, and we said payments karte hain, and then we said, okay, let's not put a boundary on the canvas. We'll just call it anything that's on the phone. So it's literally stemming from anything on the phone. So it's phone pay.
Oh.
So we said, our ambition is limitless right now. As it should be on day zero, you never know what you're going to do.
But you mean to say that you didn't sort of consult or commission an advertising agency to say, give us a name. It actually happened during a conversation that you hit upon this name.
So our shopping app's called PinCode. Our broking app's called Share Market. Our Indian app store is called Indus and PhonePe. Very proud. That's actually my only direct contribution to the company. We build our own brands. We build our own logos. For that part of it, we've never engaged an agency, ever. It's too personal.
And how has the journey been in the last 8 years?
It's been fantastic. It's way more than we'd ever imagined. I remember when we started out, there was no UPI. There was IMPS. You used to use it through your net banking apps. It was painful. You'd add a beneficiary and then do an EFT and RTGS. And then, again, all good ventures, there's moments of serendipity. Nandan Lekani and folks from the RBI and Dilip Asbe were in Bangalore doing a hackathon, and they said, everyone come, engineers build on this new stack called UPI. So we suspended whatever else we were doing at the time, and we started working on UPI. Then it was, as is always the case, slower to launch than we hoped for. But then immediately after that, demonetization happened, and suddenly every banker in Bombay, whether by choice or by push, was basically getting on the UPI bandwagon. So we went from 0 to about 10 million users in 3 months.
That is during the monetization.
Yeah, I mean, there's no cash. People still need to move. So I think a Paytm came out of that with the wallet play. We came out of that with the UPI play. I think everyone, the entire industry has grown really well. So it's demonetization, COVID. I'm not going into social impact, no political opinions.
Sure.
I'm just talking about the impact on the payments industry. I think each of these have been massive accelerants.
Okay, wonderful, wonderful. Tell me, there's this view in some segments that because the banks did not show much interest in this area of digital transaction, digital payment ecosystem, players like you, Google Pay, Paytm, have gone and acquired 94% of the market share. How true is that assertion? How true is that assessment that because the banks were not getting into it, and if the banks had been savvy, probably your journey would have been not as smooth and as successful as it is? Give us a perspective on that.
There's definitely some truth to it. But I think the sort of more important question is why they didn't and why it should matter. If you meet people from the FMCG industry, they go deeper into the heartland than anyone I know.
Yeah.
Nobody's ever said Levers needs to know every last mile customer. They need to know their distribution chain. If you talk to a banker, initially when I started talking to them, I used to get very confused. Because when I deposited money, that's my asset. They used to keep talking about liabilities, and they talked about loans as assets. So it took me, as a 20-some-year-old, I just couldn't figure out why they were calling assets liabilities. I thought they had it wrong. Then I realized in their world, they make money by lending, and what I give to them is their liability. But there's a natural business model in there. They take on the cheap and they lend on the high.
Yeah.
Now, if that's where you're making 90-some% of your money, and the rest is on account opening, why do you care about this thing called digital payments? That's just distribution or dispensation. I don't know a banker who was super excited about operating ATMs once they became interoperable. Why would anybody be excited about digital payments? So I think in part, like a UPI model itself is all about the experience layer and building very, very robust, scalable tech. That's not what a banker's core purpose for or reason for existence is. That's ours.
But would it be correct to say that that you don't exist without the banks? In a sense, your transactions, it is from a bank or a bank to a merchant, and you are a facilitator. So if one fine morning, if banks become savvy, they come in, how seriously will you be challenged?
How long have FMCG companies wanted to distribute themselves and go D2C? Again, I think it's like this. Every time I hear a fintech who's saying, I want to become a lender and I want to become a bank, I laugh. It's the benefit of having similar hairstyles. You've seen enough to know you're not going to become a bank overnight because your mood said you want to become a bank. It takes a ton of work and discipline and governance and skill and all sorts of other stuff. So I think respecting boundaries, I think, in the same way, I think 25 years working as a computer scientist and usability expert, I think I can defend turf when it comes to the application layer. The day people here start saying that their banking app services them better than a PhonePe or a GPay or a Paytm or what have you, it's over. I mean, food apps, I'm sure restaurants can make really good food. Swiggy and Zomato don't own the market because they have the best food kitchen. They've tried. Restaurants have their own apps. They haven't won the market that way. I think these are completely unrelated items. I think a lot of hullabaloo is made around it because people assume payments is the natural birthright of a bank. Payments in the cash era, what role did the banks have once you took money out of the bank with cash? Cash movement happened left, right, and center all day long.
And yet, there are some players, I don't want to name them, who tried to enter this market, big names, but didn't make much progress. What would you think, I know, you can guess who I'm referring to.
Hasn't worked well for me in life.
I'm referring to WhatsApp.
Okay.
And yet, sort of, we have seen the failures they have faced, in a sense, making inroads into this segment. Now, if you were to sit back and see where you went right and you acquired this 50% market share, and where some of your rivals did not get it right, and you wear that thinking hat, and how would you analyze the difference between success and failure, and what went right for you, what went wrong for them? Without taking names, I understand.
So, as you can imagine, we got asked this question. It's a pretty existential question by all early investors. I think we did two things right, and we got lucky on a third. We got lucky because we bet on UPI before everyone jumped on the bandwagon, and therefore we got that all the wallet players who are now also trying to become UPI players, including Paytm, MobiKwik, Freecharge, they were already on IPL, they were really popular. I think they were so deeply sort of rooted in this value proposition that a wallet is better than the bank. It was hard for them to do a brand pivot. It was actually just a marketing problem. The tech of UPI wasn't harder. And so they were saying wallet is still better. The banks were not interested. The banking app was better. So we were the only ones who were screaming from a rooftop saying UPI is better. It was actually quite just, again, it's just luck. But we exploited that, and we marketed very aggressively. By the time Google, WhatsApp came in, Amazon came in at the same time on UPI, a lot of other players came in. I think my response to this was, we will win because we are willing to deploy human beings on the merchant acceptance and operating side, which I don't think a WhatsApp, just DNA-wise, you can't get to 2 billion people on chat clients and social media and then have an operating leg of any kind. It's impossible. But similarly, you can't be in a space as sensitive as payments. Payments is not the same as sending a chat message or an Insta post. If the post doesn't refresh, you'll be bummed, but you'll go to sleep. Money is critical. It evokes the most amount of anxiety in life outside of health. So you have to put people on the ground. Banks do this really well. This is why we trust them. You walk into a branch, some outcome will happen. So we've got about 10,000 employees on roll. We've got another 20,000 that are on contract, but permanent contract. And for the merchant acquiring side during COVID, we had about 1.5 lakh freelancers in rural India. That's what it takes to have a QR code everywhere. I don't think big tech companies, especially global big tech companies, are comfortable putting 1.5 lakh people in rural India. So I think that is something we did right. I think the second one was wiring. I think we're a lot more comfortable being regulated. We actually welcome regulation. Big tech, well-established big tech that is getting into financial services has always resisted regulation because they've never been regulated. Whereas a Stripe and a PayPal and all these companies, they're used to being regulated. So I think there we won, specifically in the example that you shared. I think I would bet against WhatsApp winning on payments, just as much as I would bet that they will win the business solutions that they now have on WhatsApp. That's about engagement. I think they'll win that. That they have a natural right to win. Let's put it that way.
So you are saying that the lack of felicity in dealing with regulation was a key differentiator?
You don't want to do KYC. You don't want to be audited. You don't want to actually work deeply with the banking system. There's 50,000 things we do behind the scenes with the regulatory framework and FIU and MHA and others, right? I mean, we all have a serious role to play as well.
So who made that difference? I mean, you are also owned by a multinational of sorts, and they are also owned by multinational. So what
I
made the
didn't correct
difference?
this one. I left Flipkart. We set up PhonePe, then we merged back in. Walmart came 3 years later. We already had 200 million people. So that's one part. Our wiring was in place by then. Second, Walmart again is a brick and mortar retailer. In every market they go, tax is never a struggle. You don't worry about jurisdiction and DMCA and all of the floozy stuff. You're on the ground, you operate by the rules of that market. So for Walmart, the fact that we are very heavily regulated, it's an obvious outcome of the nature of the sector we are in. It was never a discussion.
Okay.
I'm very proud, and we spent $1 billion last year in tax money to Delhi to move our domicile from Singapore to Delhi, to India, because the regulator said you're too large, we need to make sure there's no sovereign risk. We moved to India. So I think Walmart is under tremendous public scrutiny themselves.
That's right.
Fortune 1, so they're used to this.
But they rely a lot on PhonePe's success and saying that PhonePe has succeeded. So they're using PhonePe for promoting their success in India particularly.
I'm proud of it.
Just one question before I come, maybe ask some of the audiences here to raise some questions if they have one, is that you have a regulator in this space. How comfortable are you with a regulator, which I'm talking about the National Payments Corporation, NPCI. How comfortable are you with a regulator which is owned by banks? Is that a conflict situation, or is it okay? Or, how do you see this regulation panning out, given the fact that NPCI is, after all, an entity that's owned by banks?
So NPCI is a quasi-regulator. They're not the regulators. It's the Reserve Bank always. But because they're a PSO and they're defining the rules of the network, they end up defining a lot of the individual sort of policies. My answer is in two parts. At nearly 50% of market share, I think we have a seat on the table, and we all work very closely with NPCI, have from day one, in institutionalizing the right practices and SOPs. The operating side, we are in perfect harmony. We are also audited for, most people think that fintechs have it easy. We have 8 regulatory licenses across RBI, SEBI, and IRDA. So we get audited more than once a week, 55, 60 times a year. So I think there's a comfort on the governance and the operating part. On the policy part, sometimes there's a conflict. It's not because they're owned by the banks. The banks also compete. The Bheem UPI app from NPCI also competes. Everybody competes. And I think that's okay. It's an interoperable platform, right? So we may roll out a feature that others adopt. Others will roll out features we take inspiration from, and life goes on. I think everyone wins. God knows, we are at I'd say about 40% market penetration if I take the adult population, right? We're still at about 400 million people actively using UPI, all in, life till date. There's about 1 billion people who should be able to. So I think it's a pretty happy ecosystem.
Okay, I have 2 more questions before I throw it open. to the audience for their questions. So the mics may kindly be get readied so that if there are questions, we can take them. The NPCI had put out a paper which suggested that maybe by end 2024, the market share for the digital payments player would be capped at 30%. And you are already a giant with 50% market share. When that, I think, comes around, gets enforced eventually, how are you planning to deal with this big regulatory challenge which will cap your growth and market share? Because there are the competition issues involved, everything is there. So how do you see this, and how would you like policy to be tweaked or modified or changed to ensure that growth remains unhindered?
So the original version of it, the deadline was December 22.
Yeah.
It's now been pushed out by 2 years. And as you can imagine, a lot of discussion and background. Again, I think the regulator has a view, NPCI has a view, we have a view, government has a view, Competition Commission I'm sure someday will. I've only asked 2 questions till now, we've not got an answer. One is, tell me what you expect me to do to reduce my market share. There's 115 other TPAPs. Somebody else has to outspend, outwork, outhustle, and pick up their market share. That burden can't fall on me. Second, I think we are all celebrating UPI's success. But if there are another 600 million people left, are you telling me that as market leader, you want me to start telling them, don't use my app because it's the most popular, please go to the next person? That burden can't fall on me anyway. So it's not a regulation, by the way, it's a circle. Again, I'm clarifying this. And I think at some level, Dilip also clarified this from NPCI, they want the market to have more participation. And if you see, again, Tata Neu came in, Flipkart's announced, Zomato's announced, Swiggy, everybody's become a TPAP, right? There's, again, over 100 people grow. So there are so many new entrants, and WhatsApp now allowed to actually also expand more aggressively. As long as there's no barrier to entry, this is not a CCI matter. There is no demonstration of abuse of dominant share. So again, it's not a problem for the government. I respect the risk, the systemic risk side of it. We have 5 data centers, we are active. You can be rest assured whether it's NPCI or RBI, they're up our wazoo to make sure we run 24/7. I don't expect any passes on systemic risk as a large player. I don't expect any pass on good governance or good sort of behavior, not being monopolistic or any of those words. That's fine. But all that being true in an interoperable system, as long as we are playing right, I won't feel the burden of trying to actually tell customers, you can't use my app because I'm more popular. That's not mine to solve for. The rest of the market has to pick up the pieces.
The second point that you were making, or have you made that second point?
I think the second one is that I checked myself because I just realized I'm here live. I think there is a market share discussion to be had once you've actually penetrated deep enough. When the MDR in a particular industry is 0, when there is no natural business model, you will see a contraction of investment by stakeholders. So while there are 150 people, guess who's not advertising for the last 2 or 3 IPLs? We are not because of cap, but nobody else is. Why? You'll invest in a sector if you can make money.
Okay.
And that burden, again, is not on me. I didn't make MDR 0. So you can't say there's no money and then tell the people who are still investing in laying the railroad, don't invest. I'm taking a 10-year view. Either others take a 10-year view, or you make it attractive in the short run.
Okay. You know, I mean, in response to your first point, how would you react if, like the European regulators, the Indian regulators were to tell you that we split you into 2 companies to bring it down to market share of 30%?
It's what it is. I mean, when we started out, we didn't assume that like we'll cross 500 million users in the next few days. No entrepreneur who's being honest will tell you, I knew when I started I'll have 500 million users. So it's been a wild ride. And if they say that you're too big to exist and we have to do something extraordinary, it'll come our way. As I said, I mean, I can think about this and worry myself silly. 25 years in the startup sector, I don't have hair left to worry about this stuff. So I can only focus on governance. I can only focus on meaningful growth, fiscal responsibility. I can't focus on hypotheticals.
Is this issue agitating the minds of the
Sorry?
Is this issue a real pain point for the digital payment sector?
I think, to be honest, there was a panel not so far away. The sector, the industry, is way more concerned about the business viability, given that there's no MDR for the last 3 years. And it's a very, very low margin industry to begin with. Then caps. Again, there's no barrier to entry. Anyone here can build a UPI app because the APIs are public.
Yeah, which is why you said there are more than 100 players. Yeah. If there are any questions from the audience, please raise your hand, identify yourself, and ask your question to Mr. Nigam.
Yeah, this is Mahesh, but...
Sorry, where are you from?
Yeah,
please.
I'm independent software consultant and we work on regulations and compliances. As a telecom operator, I mean, I've been in telecom for donkeys years. Interoperability is sacrosanct. Do you see any interoperability across these payment service providers? Google Pay will accept Phone Pay will accept Paytm. In the ecosystem of fintechs, individual handshakes are only with the parent system. Will it be interoperable across the apps or across the payment companies?
UPI has been interoperable since its origin.
That's a parent exchange, but...
No, not just at the QR level. The mobile numbers that you send money to for peer-to-peer transfers are interoperable. There's a global mapper that's maintained by NPCI. You can send money to any app user. So app to app, QR to app, wallets are now interoperable through UPI. So I'm not sure.
Merchants many times say, I have Phone Pay, I will not accept Google Pay. I mean, I have A, I cannot take from B. I have B, I cannot take C. Down the line, the T vendor or the...
I used to hear that in 2016, 17, 18 until merchants knew. But then actually it's not just us or anyone else, individual player. As an industry.
I'm talking
saying
about
as an industry, we have all made sure every single QR has the logos of all the competition. Every PhonePe QR has the logo of at least 6, 7 other players. So I haven't heard that in a while. I don't mean to challenge, but I guess I do mean to challenge a bit.
Okay. Any other question? Yeah.
Hello, sir. Mr. Samir, I'm Shruti Mehta. I represent Millennium Mams who advocate financial and economic literacy for women. So my question to you today is that what is PhonePe actively doing, and what are your future plans regarding to include as many women as possible in your company, and also so that the maximum women will use it? PhonePe, I mean.
Different answers. I can talk about the company part of it more easily because that's directly in our control. I'm actually pretty happy to report almost 50% of my directs in the leadership roles are women.
Okay.
So I think we're pretty well balanced at the top.
Right.
Being a tech company, I'll be honest, the balance goes down as you go further down the org just because of the number of graduates we're able to actually get from colleges. If the ratios in the engineering colleges are skewed, we are not able to maintain that balance down. But it's getting better. There's a lot of work that needs to also happen. Programs, plans, support systems for young moms, for senior members of the team who need flexibility. A lot of discussion happens. We also have a diversity council that focuses on, for example, specifically recruiting or having programs for physically handicapped people, the trans community, a lot of different things. So I think that one we've gotten decent traction on, I would say. As far as actually making PhonePe work better for women, I'm embarrassed to say our understanding of our own customers is very, very poor and has been so by design, ironically. Because it's payments data, a regular big tech would tell you is the holy grail of data. But the way we look at it, until the data privacy law just came out, we would not let people read your SMSs. We would not let anyone ask for permission to read the appography, etc. The typical mantra in the office is govern yourself like a PSU, operate like, innovate like a big tech, never flip the two, otherwise you'll be dead. So data's, unfortunately because of that, our data richness has been lesser. Now that the law is clear and prescriptive about being able to take consent and then be able to do things, one of the things we will try and do, gender is definitely a focus. Income levels, gender, age group, these three demographic details, we will try and seek proactively.
Yes, so because given the fact that your presence is a lot in the rural areas too, so the concern here a little bit is that many of the women don't have much access to technology. So, you know, like what do you think about that?
I think women adopt technology faster than men, as users.
Thank
Not as
you,
builders,
sir.
but as users, for sure.
Thank
you. We have only time for 2 questions. Please go ahead. Yeah, use the mic.
Hi, I'm Nivedita from Business Standard. My question to you is, what are your thoughts on listing of PhonePe and how is life, according to you, post-IPO?
So, I think there's an inevitability to it. So I think we will list. As I just mentioned earlier, we've already moved domicile to India. We are fully spun out and independent from Flipkart. So I think we're laying the foundation. We're also trying to bring more independence to the governance and the board. We will list in India. We will list when we are ready from 2 or 3 different angles. One is obviously business readiness. You don't want to go public and then your business is not speaking the same language in the private and public markets. Second, I think we need to have a lot of engagement with our regulators and possibly even the government in terms of the structure and makeup of how we list, who we need to have on the cap table. We're becoming increasingly regulated. So I think it'll take us a couple of years. But I'm very excited about it. If we weren't this regulated, if you're a regular tech startup like my previous ones, I'd say life would be dramatically different. I actually don't think it'll be a big delta. We just, as I said, we audited more than once a week by some financial regulator or the other, regulated up our wazoo. Our financials are audited at a LR level or a public level already. I'm excited.
Okay, excited. Last question. Just last question, yeah.
Hello, sir. I am Abhishek Gupta, co-founder of Yuvan Finances Private Limited, and I am from Jaipur. मैं बस आपसे एक टेक्निकल क्वेश्चंस है सारे यूपीआई एग्रीगेटर्स या वॉलेट वालों के लिए या एक्चुअली मैं बस ये जानना चाहता हूँ कि आप लोग सारे डेबिट कार्ड से ही अपना यूपीआई या फिर बैंक से ही यूपीआई कनेक्ट करते हैं भाई क्रेडिट कार्ड से यूपीआई क्यों नहीं कनेक्ट होता या फ़ोन पे वगैरह सब क्रेडिट कार्ड या जो भी अदर हैं गूगल पे है फ़ोन पे है वो क्रेडिट कार्ड से कनेक्ट क्यों नहीं हो पाते
फाइनेंशियल आइडेंटिटी यहाँ से डेबिट हो रहा था पैसा वो डेबिट आई कैन
प्लीज या श्योर
यूपीआई बैंक टू बैंक ट्रांसफर के लिए बना था क्रेडिट लाइंस के लिए नहीं था ओवरड्राफ्ट आ गया था अब क्रेडिट ऑन यूपीआई लिंकिंग चालू हो गई है मगर आप लिंकिंग जो इनिशियल लिंकिंग की बात कर रहे हैं वो आपके बैंक अकाउंट के साथ करनी है डेबिट कार्ड माध्यम है जिससे आपका अकाउंट लिंक होता है आइडेंटिटी डेबिट कार्ड इज लिंक टू अ बैंक अकाउंट क्रेडिट कार्ड डज नॉट नेसेसरली हैव टू बी लिंक टू द अंडरलाइंग बैंक अकाउंट आपके पास सिटी बैंक का क्रेडिट कार्ड हो सकता है और पंजाब नेशनल बैंक का डेबिट कार्ड या बैंक अकाउंट हो सकता है वो बाइंडिंग नहीं होती
आपका हो गया कनेक्ट, जस्ट लाइक एक बार आपका यूपीआई सक्सेसफुली कनेक्ट हो गया, देन क्रेडिट कार्ड्स जैसे बहुत सारे हैं, हम लोग भी क्रेडिट कार्ड यूज़ करते हैं, देन फिर भी यूपीआई जैसे लाइक फ़ोन पे वो क्रेडिट कार्ड को एक्सेप्ट नहीं करता, मतलब वो डेबिट
रुपए कार्ड्स लिंक होना चालू हो गए हैं
या
क्योंकि रुपए नेटवर्क इंटरऑपरेबल हो गया है यूपीआई के साथ, जैसे वॉलेट्स हुए हैं। आरबीआई ने भी वीज़ा एंड मास्टर कार्ड के लिए भी अप्रूवल नहीं दिया, जहाँ तक मुझे पता है।
तो क्या इसके लिए कोई रेगुलेटर बैरियर्स है या कंपनीज?
आरबीआई ने अभी तक वीज़ा मास्टर कार्ड के क्रेडिट कार्ड्स का एनपीसीआई प्रोडक्ट रेल्स पे लिंकिंग का परमिशन नहीं दिया, जहाँ तक मुझे पता है।
या और सेम थिंग ये कि फ़ोन पे वगैरह से केवल 1 लाख रुपीस इन 24 आवर्स में ट्रांसफ़र होता है, तो ये भी एक रेगुलेटर बैरियर्स है या?
ये एनपीसीआई और आरबीआई के बीच में कहीं तो लिमिट है, वो लिमिट 2 लाख हो गई थी, मगर रिस्क एंड फ्रॉड के लिए अलग अलग
बैंक थोड़ा लिमिट डाउन टू 1 लाख अगेन,
1 लाख।
Yeah,
thank you.
That's right. Oh, I know we can. There's too many questions, but we have to close this session. We started at 5:10, and we are past our time. Before we close, I want to ask you one question, which is what many people believe that the digital payment through UPI system has grown, expanded, largely on the strength of a kind of an implicit government subsidy, where the government subsidizes the payments, around 1,800 crore is shown in the budgets to show that this is the payment cost that is shared with the participants at different levels. Now, what's your take on that? Is that subsidy really a factor that helps you grow your business, or it is no factor at all?
So, if you ask your audience, when you use UPI apps, you use a PhonePe, you use a GPay, do you do money transfers more often, or do you actually do retail transactions more often? First of all, majority of the transactions, or a very large percentage of them are peer-to-peer. Peer-to-peer transactions, the government doesn't subsidize at all. In peer-to-merchant transactions, they give you a subsidy on the merchant side of it. Now, if I track the data, before zero MDR, in a span of about 4.5 years, we were already at roughly about 2 crore merchants on the acceptance side, 20 million. It's been about 3 years since the subsidy started. We are at about 35 million, 3.5 crores. I have not seen a rate of change in terms of merchant adoption.
Because of the subsidy?
No way. Because the work it takes, you have to put people on the ground, you have to educate a merchant, you have to give them a QR code, and there has to be a consumer base that wants to go and make a payment. So the same rules were true for credit cards. If people here were using credit cards, the merchant used to pay an MDR. If they were using debit cards, the merchant would pay the MDR. Now, a very large percentage of small merchants were not paying any MDR before the law came in, because as an industry, we'd reached that equilibrium where we said we'll have a program where below 2 lakhs of spending at the retail outlet per month, none of us will charge. It was just this agreed upon P2PM, as we used to call it, strategy. I think that the government picked up on that and has just said, let's just take the friction out. But 1,800 crores does not offset over 7,000 to 8,000 crores of spending by an 100% industry every single year. It simply does not. So I think it helps to have the subsidy back in after zero MDR, but I think the market principles have to play out. I think the signal helped. I'll say this. I think the signal of the government saying it's free for all the merchants helped the sentiment. But on the ground, we were not seeing merchant penetration or retail payments not take off as much.
So my final question, if the government were to withdraw that subsidy, are you suggesting that 20 million will remain 20 million? Or
no, 35. No, we'd grow faster actually. I genuinely believe we would grow faster.
Okay. Thank you. On that happy note, optimistic note, we come to the end of this session. Thank you once again, Mr. Nigam, for being so frank. Thank you. Thank you.
Check. Right. Check.
Can we give a huge round of applause for this conversation? I think immensely candid, from navigating 50 to 60 audits to actually having about 500 million users in a few days from now. I think, Mr. Nigam, your story is what India's growth story stands for. And thank you for answering all the answers with so much candor and honesty. I think one of the most memorable conversations for today, ladies and gentlemen, this was the conversation, fireside chat between Mr. Bhattacharya, Editorial Director at Business Standard, and Mr. Sameer Nigam, Founder and CEO of PhonePe, who took the questions right on and gave the answers in a very candid way, from navigating so many auditors to actually writing the growth story of India in such an aspiring and inspiring manner. Thank you so much. We have another address slated in a few moments from now by Mr. Anant Narayan, who is the whole-time member at SEBI. So I request you to please do not leave the hall and stay here. It's right after this in a few more moments from now. Ladies and gentlemen, time to continue the momentum of some supremely significant conversations going that have the promise, the potential to impact the future of BFSI in India. Up next, we have the privilege of having with us Mr. Anant Narayan, whole-time member SEBI, who's be sharing his insights with us through a very pragmatic address. And to formally introduce him on stage and set the context of his topic, I'd like to call on stage Mr. Shailesh Dobal, editor at Business Standard.
In November 2000, GIC REIT, with subsidiaries having the right synergies, was the result of judicious consolidation. The government of India holds majority ownership. Now, GIC REIT is the largest Indian reinsurer with a dominant presence in the Indian market. GIC REIT shares...
Good evening, ladies and gentlemen. On behalf of Business Standard, let me extend a very warm welcome to Mr. Anant Narayan, whole-time member of the Markets Regulator, the Securities and Exchange Board of India, to the Business Standard BFSI Insight Summit 2023. Mr. Narayan has over 2.5 decades of experience in banking and financial markets, a period during which he served as a director on boards of many banks like Deutsche, Citi, Standard Chartered, and several corporate entities. At SEBI, Mr. Narayan handled several departments like the Market Intermediaries Regulation and Supervision Department, Alternative Investment Fund and Foreign Portfolio Investor Department, Department of Economic and Policy Analysis, Integrated Surveillance Department, and the Information Technology Department. Before assuming charge at SEBI, last year, Mr. Narayan had held the position of Associate Professor at SP Jain Institute of Management and Research, Mumbai, for nearly 5 years. He also served as a member of various advisory committees constituted by SEBI and the Reserve Bank of India. Mr. Narayan has been an active member of financial markets since 1993, the time when he completed his postgraduate diploma in management from Indian Institute of Management, Lucknow. Earlier, he did his graduation in technology, electrical engineering, I learned, from the Indian Institute of Technology, Bombay. Many thanks, Mr. Narayan, for agreeing to be with us here today. May I please request you to take on the stage and address this audience and thousands who are watching this summit proceedings online and deliver your address on regulation and capital formation, recent experiences. Thank you very much. Mr. Narayan, please.
Thank you, Shailesh. And at the outset, I thank Business Standard for giving me the opportunity to address this august audience of stakeholders from the BFSI community. I have been blessed with the good fortune of having enjoyed 3 different vantage points to the BFSI ecosystem: as a banker in financial markets, as an academic and a researcher, and now as a securities market regulator. In my experience from these 3 different vantage points, stakeholders in the BFSI ecosystem are sometimes guilty of talking past rather than to each other. Summits such as these offer an excellent opportunity to build some bridges across different perspectives. In today's address, drawing from recent examples, I will argue that when it comes to framing a suitable and appropriate regulatory regime that balances trust on one side and ease of doing business on the other, both of which are key for capital formation, all stakeholders must speak to each other, listen to one another, and work constructively together. Before I go into that, I want to dwell on 2 aspects: our common mandate of fostering capital formation and the exciting developments and opportunities in this regard. You know, the 3 pillars of SEBI's mandate, as articulated in the preamble to the SEBI Act of 1992, are investor protection, market development, and market regulation. While it is not explicitly stated as such, these clearly require SEBI to foster sustained capital formation. Often SEBI is characterized as a market watchdog, somebody who prevents or detects something going wrong. But our role is not just that. It is equally to ensure that good things ensue in terms of capital formation. This is an exciting time for capital formation in our country. Leveraging technology and innovation, our securities market ecosystem is now fostering greater financialization of domestic savings. The number of unique mutual fund investors as of March 2020 was about 2.2 crores. As of September, that number has crossed 4 crores for the first time. Likewise, the number of unique DMAT account holders as of March 2020, around the time of COVID, was about 4.2 crores. Today, it has crossed 9 crores again for the first time. The amount of investments that individuals held in mutual funds as of March 2020, again, individuals, not the entire ecosystem, was about 12 lakh crores as of March 2020. Today, it's nearly 28 lakh crores. Amongst many other benefits, such financialization of domestic savings actually bodes well for financial stability as well. Since April 2020, our mutual fund equity and equity-related schemes have seen inflows of about 7.6 lakh crores. Over 3 times the FPI flows into equity markets during the same period. In fact, specifically during this period of October 2021 to about June 2022, when you had global interest rates going up, when you had the shock of the Ukraine war in February, our markets saw about 2.6 lakh crores of FPI outflows, between 2.5 and 2.6 lakh crores of FPI outflows. This was not unique to us naturally. This was a global phenomenon. Every emerging market, every developed market was seeing contraction and outflows from the portfolio investors. During that same period, our domestic investors, domestic savers, pumped in about 3.2 lakh crores into our mutual fund equity and equity-related schemes, dwarfing the amount which was going out, which is one of the reasons why in 2022, while the rest of the world was actually wobbly and very, very nervous, our markets did reasonably well and relatively well because of the rise of this domestic investor. Global uncertainties abound even today, with heightened geopolitical risks, high and volatile global interest rates, volatile commodity and energy prices, and subdued global risk appetite. India is, however, seen as a bright spot in this otherwise hazy global context, and the rising inclination of the domestic saver towards our securities market ecosystem plays a key, perhaps underappreciated, role in this regard. There is simply no room for complacency, though. Both opportunities and challenges abound as we look to continue drawing in both external and domestic savings to sustain capital formation in our country. There are clearly more opportunities to draw domestic savers into the securities ecosystem. 4 crore mutual fund investors, 9.1 crore DMAT holders, they still look small compared to the 51 crore Aadhaar PAN numbers which have been linked to Aadhaar. The 27 or 28 lakh crore of retail money which I mentioned to you is lying with mutual funds still looks small compared to the 33 lakh crores of currency in circulation and the 196 lakh crores of deposits in the banking ecosystem. We still have a long way to go in that regard. Towards this, besides continuing to spread the good word, we must constantly guard and preserve trust in the ecosystem. After all, trust is the single most important ingredient to bringing in and retaining investors. This entails continuing to build a robust market and technology infrastructure and ensuring a rules-based regime. At the same time, we must ensure ease of doing investment to channel these increased savings towards fresh capital formation. This is where we come to a bit of a dilemma, a regulator's dilemma, if you will. There are two types of errors that we as an ecosystem could commit in pursuing the twin objectives of fostering trust while maintaining ease of doing investments. When a regulatory and market architecture is seen as inadequate to prevent the circumvention of rules and regulation, that constitutes a type 1 error. Significant type 1 errors, such as technology failures or perceptions of egregious and uncorrected market wrongdoing, can severely endanger the trust of investors and other stakeholders in the ecosystem. At the same time, as we focus on addressing type 1 errors with layers of checks and balances, we could end up with a heavy-handed framework of rules and regulations that comes in the way of legitimate business and legitimate capital formation. That would constitute a type 2 error. At all times, we must strive for a regulatory regime that gives all-round confidence that failures and wrongdoing is unlikely, and if at all, will be detected and addressed in a timely manner, while at the same time ensuring ease of doing investments and business. In other words, we need a win-win set of solutions that minimize both type 1 and type 2 errors. While this may sound difficult, this is indeed possible. If all stakeholders were to work collectively and constructively, talking to each other rather than talking past each other. Some recent examples bear testimony to this. I want to talk about one set of examples relating to the FPI regulations that we have in our country. One such example is in the realm of foreign portfolio investments, or FPIs. As a country, there is little doubt that we have benefited immensely from FPI flows. As of September 2023, FPIs held 54 lakh crores of equity investments in India, about $650 billion worth of investments. As a country, we need to continue to draw in savings from the globe to fund our sustained capital formation. At the same time, for decades now, periodically, questions and doubts have been raised about the identity of investors behind some FIIs and FPIs, and as to whether their investments were in fact circumvention of SEBI regulations, such as the substantial acquisitions of shares and takeovers, SAST, or of regulatory requirements such as the maintenance of minimum public shareholding, MPS. Over the last decade, there have been consistent efforts to strengthen FPI disclosure requirements. However, given that beneficial owners of FPIs are identified based on thresholds, currently 10%, and given that some of the investors could be based in jurisdictions with strict and unique secrecy laws, the suspicion that some FPIs could be circumventing regulations continued to persist. This constituted a type 1 error that needed to be addressed. The blunt way to do so would have been to insist that every FPI should reveal the identity of every natural person investor without regard to any threshold and irrespective of the disclosure regime of their jurisdiction. Doing so, however, would have increased the possibility of type 2 errors, with even legitimate FPIs being tasked with potentially onerous and taxing disclosure requirements. Such a regulatory framework would have also stood out as tedious in comparison to our peer global regimes and possibly discouraged investments into our country. After consultations with SEBI's FPI Advisory Committee, custodians, designated depository participants or DDPs, FPIs, and the public at large, the final regulatory change that was approved by the SEBI board in June 2023 has attempted to address the core type 1 error while minimizing any possible resultant type 2 errors. To address the risk that some FPIs may be circumventing SAST and MPS requirements, the policy requirement now is that enhanced and granular disclosures around the investor identity will be sought only from those FPIs that pass through certain objective risk-based filters. First, no additional information would be sought from government-owned entities such as sovereign wealth funds. Second, only funds that have more than 50% of their investment concentrated in a single corporate group would be considered for enhanced disclosures. Even thereafter, following a trust but verify principles, funds that are pooled investment vehicles with less than 25% of their global corpus invested in a single Indian corporate group would be exempted from any additional disclosure requirements. Similarly, additional disclosures would not be sought from corporate investors that are listed on major exchanges recognized under our Prevention of Money Laundering Rules, PMLR. Each of these and other exemptions, which were designed to reduce type 2 errors, have been extensively debated with stakeholders to ensure that they do not, in turn, increase the risk of any type 1 errors. It never stops at a broad policy, though. Operationalizing any regulatory policy, especially a trust but verify regime, requires comprehensive on-the-ground implementation standards, covering FPIs from very different jurisdictions so that all stakeholders know exactly what is required of them. In keeping with the SEBI chairperson's announcement that a pilot industry standard forum in consultation with SEBI will set the standards for implementing board-approved policies, a standard operating procedure, an SOP, to operationalize this policy has been put together by this pilot industry standards forum and communicated to stakeholders. I believe this common SOP has now been put out in the public domain by the designated depository participants. This new regime comes into effect from November 1st. Using these layers and filters arrived at through extensive deliberations and constructive deliberations with multiple stakeholders, it is likely that only a fraction of the FPIs by value of their investments may be required to provide additional granular disclosures around their investors, which is probably one of the reasons that we've not heard too much of noise around this so far. It's been done very, very carefully. This is not to suggest that this intervention stops here or that we have solved for all type 1 or type 2 errors relating to this specific example. There needs to be a constant feedback and dialogue to review this and any other regulatory framework on an ongoing basis so that course corrections, if any, can be calibrated when needed. But at this stage, I do wish to compliment all stakeholders for the constructive deliberations that have allowed us to tackle a crucial type 1 error head on, hopefully with minimal spillover type 2 errors. Such a collaborative effort will go a long way towards fostering trust and hence sustained capital formation. Separately, as guided by the Honorable Finance Minister in her budget speech earlier this year, SEBI has set up a working group chaired by G. Mahalingam, the erstwhile whole-time member of SEBI, to undertake a comprehensive review of FPI regulations with a view to improving ease of doing business. This is an exciting opportunity for us to ease the process of FPI registration, review FPI investment conditions, and ensure that we set the benchmark for attracting high-quality external savings. I strongly encourage all stakeholders to put forth your suggestions in this regard. I would only ask that when we ask for any relaxations of existing regulations or for any innovative new approaches, we should consider if there is any concomitant increase in the risk of type 1 errors, and if so, how they may be mitigated. Trusted advisors to regulators and the ecosystem would consider and be upfront about both type 1 and type 2 implications of their suggestions. I now want to move on to a second area beyond FPIs, which is around alternate investment funds, AIFs. There is ongoing work here as well to reduce the possibility of both type 1 and type 2 errors. Like FPIs, AIFs are a crucial part of capital formation. AIFs bring in informed investors who are willing and able to provide high-risk capital, which in turn can fund promising new ideas, ventures, and investments of our value creators. As of June 2023, AIFs in India had raised a total of 3.75 lakh crores. And over the last 5 years, this number has grown at an attractive 30% compounded annual growth rate, a very creditable performance. Even as the rest of the world battles a funding winter, we need this ecosystem to grow in India. There are some type 1 errors, though, that have caused some concerns. Over the past few months, instances of AIFs being structured to circumvent existing regulations have come to light. As one example, some AIFs appear to have been specially structured to allow NBFCs to circumvent extant regulations around recognition and disclosure of stressed assets. In some other cases, entities that were not allowed to invest directly in others under extant regulations have done so indirectly via an AIF vehicle. In terms of numbers, these are not small numbers. They are big enough for us to be concerned about it. Note that unlike other regulated entities such as mutual funds, SEBI does not have ready access to granular operations and investments of all AIFs. The instances of structure to circumvent referred to above were therefore identified on the back of inspections and specific intelligence. I would strongly urge industry participants and associations to be forthcoming about any sharp practices within their community so that the trust in the ecosystem is preserved. Beyond this, globally, there are some concerns around the valuation of private equity assets and possible leverage building in the ecosystem on the back of private equity investments. On the other side, it must also be acknowledged that there are industry voices that represent that our AIF regulations are very onerous. While other global regulators, most recently the SEC in the United States, have significantly tightened their oversight over the PE industry in recent times, this is feedback that we have taken on board. Overall, we are very conscious that we ought not to throw the baby out with the bathwater. We are very conscious that while there is a need to prevent undesirable acts, i.e., the need to prevent type 1 errors, as with the FPI enhanced disclosure requirement, this must be achieved in a targeted fashion. We also need to obtain requisite data for a supportive trust but verify regime. Above all, we are convinced that all of this must be done in a manner that ensures that the regulatory architecture does not stifle legitimate business. And I repeat, we need AIFs to grow for our capital formation to proceed. To address the specific regulatory concerns around possible misuse of AIFs, perhaps regulations could specifically incorporate the principle that AIFs should ensure that their operations and investments do not end up circumventing any regulations administered by any financial sector regulator. This general obligation must then be translated into specific standards to set definitive responsibilities and obligations on all stakeholders. As in the case of the FPI example, the specific verifiable actions that AIFs and their key management personnel need to take to demonstrate adherence to this above general obligation can be set by the industry itself through a pilot AIF standards forum, as announced by the SEBI chairperson in consultation with SEBI. The standards should be such that those that intend to stay within the letter and the spirit of regulations should face no challenge in demonstrating adherence to them. With such a general obligation, specific standards for its implementation, and effective reporting mechanisms in place, I suggest we can comprehensively relook at the regulatory architecture of the AIF industry from an ease of doing business perspective. In this connection, an ease of doing business working group chaired by former SEBI whole-time member Shri S.K. Mohanty has been set up to comprehensively review extant AIF regulations. Once again, please do feed in your constructive suggestions in this regard. In conclusion, preserving trust while ensuring ease of doing business, that is, minimizing both type 1 and type 2 errors, is best achieved by a collective effort where all stakeholders talk to each other rather than talking past each other. My added request to the industry is, if you see something, say something. If you see a type 1 error, point it out to us. Similarly, when you propose a new innovative measure or a relaxation to improve ease of doing business, please do reflect on the possible type 1 errors that may foster and find ways to mitigate them. Industry associations have a key role to play in this regard to ensure that the voice of all players is heard and consolidated, that a constructive industry consensus is forged on key issues. One of the reasons we require industry associations is it's physically impossible for us to interact with 1,300 AIFs. We need a consolidated view to come to us at times. Industry associations must also undertake some level of self-regulation and become a trusted advisor to regulators and the entire ecosystem. On our part, on SEBI's part, I assure you that type 2 errors, where regulations come in the way of legitimate business and capital formation, are very much on SEBI's radar. We are also keen to engage with all stakeholders in a transparent and constructive manner so that we can collectively achieve a win-win regime that minimizes both type 1 and type 2 errors. Only then can we deliver on our mandate of ensuring sustained capital formation in our country. I look forward to some ongoing constructive deliberations. Once again, thank you all very much for your time and attention. And thank you for Business Standard for this opportunity. I wish this BFSI Insight Summit all success. Thank you very much.
Thank you so much, Mr. Anant Narayan. And one of the key takeaways that I'm taking from this entire discussion is trust but verify regime. Trust while doing ease of business. And if you see something, say something. Thank you so much for delivering that extremely futuristic and hopeful keynote for all of us, sir. Thank you so much. Can we give him a huge round of applause, ladies and gentlemen? Shailesh, sir, you'll be... All right. And also, can we present Mr. Narayan with a token of appreciation and memento? Thank you so much. Ladies and gentlemen, the finale address is going to be by Shri K. Rajaraman, who is the chairperson at the International Financial Services Centers Authority that promotes the ease of doing business. Just like Mr. Narayanan, I think it's going to be a very significant conversation and dialogue with some supremely pragmatic and relevant insights for BFSI and for ease of doing business overall. So I request you to please stay within this hall and we make sure that we make the most of the insights, outlook and perspective shared by all the thought leaders and influencers from the banking industry, the financial services firms, the regulators, who are actually the movers and shakers of policy building and really have an eminent say and ask in curating the future of BFSI in India. So I request you all to please make sure that we're all seated and settled in our hall. Our finale session is going to be by Mr. K. Rajaraman, Chairperson at IFSCA, International Financial Services Centers Authority. And in the finale performance, I think this one is going to be a unique one. We also have an entertaining set lined up for you. So we want to make sure that we start on time and finish on time, and we have our energy and enthusiasm going, because what we have in store for you is a very refreshing act by a very popular person. So I'm not going to reveal everything just about right now, but right now our focus is to make sure that we start on time and finish all the sessions right on time at India's biggest BFSI event called the Business Standard BFSI Insight Summit 2023.
On behalf of Business Standard, a very warm welcome to Mr. K. Rajaraman, Chairperson of International Financial Centers Authority, to the Business Standard BFSI Insight Summit 2023. Mr. Rajaraman is a 1989 batch Indian Administrative Service officer who served as the Telecom Secretary, and he took charge as the Chairperson of IFSCA earlier this year. Mr. Rajaraman is a BTech graduate in Electronics and Communication, a first-class MBA, listing of domestic companies at the IFC. He is also drafting an institutional arbitration rules and is involved with the development of a voluntary carbon market in India. Many thanks, Mr. Rajaraman, for agreeing to be with us here. May I please request you to take on the stage and address this audience and many more who are watching this summit online on Business Standard. Your address is going to be on, can India's IFC at Gift City match up with rivals in Singapore and Dubai? And by when and how? Over to you, Mr. Rajaraman.
So, good evening to all of you. I think so. I just had a 1 hour, 40 minutes drive from somewhere in Nariman Point, I mean, so I was just mentally kind of looking at what is quality of life. So this is something which I think all of us need to debate. So this is a question which somebody asked me when I was in Gift City, I think. Youngsters, have a second thought about moving from Mumbai to Gandhinagar. So I thought maybe the answer is in my own experience, If you can't decide when you will attend that meeting, so then it's a difficult call. So I therefore start from the point that Gandhinagar and Ahmedabad is a town where, or a city where you wouldn't find this kind of a complication. I think from the airport it takes just 20 minutes to Gift City. We have a metro line which is coming up shortly. I think next year it's likely to be inaugurated. And maybe in 27 you will have a high-speed line connecting Mumbai as well, I think. So Gift City is a new greenfield financial city in the making. But before that, before I get into Gift City, I thought I'll spend some time on the kind of economics and the policy that we need to look at if we are to realize our vision of 2047. As a country, I think the Honorable Prime Minister has outlined his vision for 2047, when India will turn 100. So some of the principles on which I think we need to base our growth is, I think first of all is free market economics. I think wherever there's friction in the economy, there is inefficiency in the economy, all that has to be addressed through appropriate policies, appropriate legislations, appropriate regulations. And that is a very important cornerstone of an India at 2047. So I wouldn't go into that, but I think as a regulator, this is one of our most important principles, I think on which I think we would be making policies and regulations. The other thing is the use of technology. Technology has now become kind of ubiquitous. Somebody who doesn't appreciate technology or cannot use technology is probably as dead as a dodo, I think. He or she or the products that he would sell or the institutions that he would make would certainly become obsolete. So therefore, a person who is able to ride on technology as a means of reaching the market would therefore succeed. And I'm sure that all of you here also realize that in various measures in your respective domains in the financial sector. The other thing is meritocracy. It's very important that the market regulation should enable efficiency to be rewarded, I think. It should enable cost effectiveness to be rewarded. It should enable quality of service to be rewarded. So therefore, it's very important that the best must survive in the marketplace, which therefore brings us to the point that I think regulation should be really up to standard to enable these goals to be met. The other thing for a country to actually succeed is to create a culture of peace. Because unless there is peace, I think innovation would not happen, obviously. Nobody will have time for innovation. We will be firefighting all the time. So therefore, there is a need for ensuring there is peace which is sustainable and long-lasting. And currently, I think we are living in a world where I think that is questionable, because there are many parts of the world which are living in such turmoil that it is unspeakable, So I think India is probably one of those pieces of geography where I guess we are very lucky to actually to have a period when I think when the rest of the world is passing through a lot of turmoil. Rule of law is very, very important. Unless there are institutions which inspire confidence, investors will not come forth with their investments, obviously. They will not be willing to take long-term decisions. They may take short-term decisions. So if somebody is willing to put money on the table for 10 years, for 10, 20 years, 50 years, then I think you should expect him to think that, okay, there's a lot of trust in the system. He has confidence that there are policies which are certain, there are laws which are certain, there are institutions which are reliable and trustworthy, which will deliver justice. So therefore, rule of law is very, very paramount. I think it is an unseen, intangible, but I think it's seen in every walk of life, and in the financial sector more so. Then spread of education and pragmatism are very important cornerstones. This is what Mr. Kishore Mahbubani said in his book on the new Asian hemisphere. He thought that this is something which I think we must all mull over as we work in various sectors of this BFSI pie. India is the brightest spot currently, I think everybody says so, I think, in the foreign, even for people who are kind of skeptical about India's growth story have also started believing in it. The people who normally would not make a very positive comment about India today are probably even unwillingly, are ready to praise India for its economic management and for its for the stability and the resilience that obtains. So we have 76 years of our democracy, which has provided a very stable and resilient environment. There are strong institutions, parliament, media, judiciary, which I think are very, very important. All this has resulted in strong foreign investor confidence. In the last 9 years, we have seen FDI inflows and FPI inflows which are unheard of. And all this is possible because of the very deep reforms that the government has been able to make. As a result, I think we have become the 5th largest economy, and we are on the way to become the 3rd largest economy. And the biggest opportunity that lies before us is the young and skilled population, which makes nearly about 65% of our population. If you look at the last 9 years, reforms have been very deep. I think all of you know that corporate tax has been reduced, and as a result of which, the tax collection has actually increased. I think better enforcement and better messaging has actually enabled tax collections, both corporate and personal, to grow drastically. And we also have this GST taxation, which has come in, which actually has eliminated tax on taxes and also made business very efficient, logistics very efficient. There are deep structural reforms such as insolvency and bankruptcy code, strict provisioning norms, and the recapitalization of banks, which have led to healthy banks. And finally, a very important component, which is the financial inclusion agenda of the government, which has enabled greater participation by a larger section of our population. Currently, I think participation in the financial sector or the financial markets has been the prerogative of a few. But today, I think if you look at the growth of demat accounts, the number of demat accounts has nearly touched about 10 crores nearly, I think. So it means that more and more from the middle class and from the lower middle class are joining the band of people who are willing to put their money in the marketplace. So this is also a message that probably more and more people are trusting the marketplace. This is also very important. The financial markets have become more trustworthy than before, which I think goes in favor of the kind of regulations that are put in place. A lot of ease of doing business has happened, I think, including the recent Jan Vishwas bill, which has decriminalized about 183 provisions in about 42 legislations. About 39,000 compliances have been reduced, modified, or simplified. So all this has put us on a very good path for 2047. But then, if you have to reach this $32 trillion economy, I think then it requires a lot of capital. This capital will be required by the infrastructure that needs to be put in place, which will drive growth. So this, as per the evaluation of the National Infrastructure Pipeline Task Force, is about $4 trillion by 2030. Now the government has also announced a net zero target that will require about another $10 trillion by 2070. So a lot of this, I think there is a recent Dun & Bradstreet report, which has also made a similar calculation of about $18 trillion by 2047, which is required to actually deliver this $32 trillion GDP by then. So it more or less kind of various numbers are there, but I think they are more or less kind of in the same direction. So let me then come to the GIFT City or the IFSC as one of the elements of the agenda or being a driver for India's growth. So the Prime Minister in his various statements has said that this is a very important destination to connect the global centers. We all understand that the domestic regulators, be it RBI or SEBI, have their own compulsions because they serve a very large market. So I think their focus and objective is different. So they have to ensure that whatever they do enables a very stable economy, and ensures that the financial systems are secure and resilient. Whereas this requirement is not there for an offshore platform. In an offshore platform, you are more looking at how to benchmark yourself with the best. Because essentially, I think we are looking at how to bring global capital, which is not there, into India. So as a result of which, I think the focus has been on how we'll be able to onshore what is offshore. A lot of foreign Indian capital has flown, because of various reasons, tax reasons or whatever reasons. There's an opportunity to bring that back. There's a lot of Indian companies which actually procure financial services from outside the country, be it insurance services, or it could be financial products such as derivatives, hedging services, so many other services. So I think all of them could be brought back. So therefore, there is a great opportunity which the Prime Minister has actually envisioned. Now, if you look at GIFT City, it is a greenfield city. I think it's not like Hong Kong or Singapore, which has grown over maybe 50 or 100 years. It is not even like Mumbai, which probably has grown over 300, 400 years since the British. So it's a greenfield city. Maybe we can compare itself with Dubai or maybe Labuan and maybe other centers, Astana maybe, which have started from scratch. So from that sense, I think building an ecosystem from where there was none is a very, very difficult and challenging task. So today we have about 886 acres, which currently hosts nearly 4 million square feet of built-up area. And there is another maybe a couple of million square feet of nearly about 15 million square feet of space being built up as we speak. And with another 3,300 acres be also being acquired. We have an international airport which is about 20 minutes away, and a metro railway and a high-speed line which is likely to be operational shortly. If you look at the regulatory architecture, it is a unified regulator. It combines the function of RBI, the Stock Exchange Board of India, IRDA and PFRDA all in one. So there is an opportunity to actually unify all the regulations, because essentially the more the regulators you have, the issue of regulatory fracture arises. So therefore, there is an opportunity here to actually provide a combined, unified, simplified regulation for the global marketplace. And that's what GIFT City IFSC has endeavored over the last 3 years. So we have a IFSCA Act which was passed by Parliament in 2019, and under that in the last 3 years, nearly about 30 regulations have been passed, I think. And today we have transactions in about 11 foreign currencies, and we are in the process of adding maybe another 4 or 5 more currencies. We have a very attractive tax regime which is benchmarked to the global jurisdictions. We have a full-fledged financial ecosystem with global connects to various other market infrastructure institutions in some parts of the world, including Singapore, and best-in-class regulations which are benchmarked to global jurisdictions. So our competition doesn't exist within the country. The competition for IFSCI is in the jurisdictions I mentioned, Singapore or Hong Kong or maybe Dubai or maybe London, maybe for that matter. So therefore, I think our endeavor has been to actually look at what these jurisdictions do and see how we could actually, make it equivalent or very, very similar for a global player to come in effortlessly. We also have sovereign support and carve-outs from many, many domestic laws, I think. The competitive edge that we have, which I just mentioned in the beginning, is that I think we have a very low cost of operations. Gandhinagar certainly is much more affordable than Mumbai, and not to speak of Singapore and Hong Kong. So that's an advantage in terms of, and generally India enjoys a very competitive levels in terms of HR hiring and so on and so forth. So therefore, I think GIFT City should be a natural competitor for all of this, but a lot of work has to be done. If you look at the tax regime, there is a complete corporate tax holiday for 10 out of 15 years. The minimum alternate tax is at 9%, and there is no CTT, STT, or GST, or stamp duty. The local government has also exempted stamp duty. There is a reduced withholding tax of 9% on interest paid on debt instruments, and competitive tax regime for funds is also in place. And we also have the companies such as the global in-house centers can also access the incentives under the Gujarat state government IT policy. If you look at the current ecosystem, there are banks, which both Indian and foreign. There are capital market participants, which include stock exchanges, clearing corporations, and other intermediaries. There are asset management institutions, including custodial service providers, portfolio managers, AIFs, and fund managers, distribution services, etc. And the insurance companies are just building out. I think there are at least 6 international insurance offices, which are branches of insurance companies. And we also have a lot of insurance intermediaries. We also have a number of other institutions which include ship leasing companies, aircraft leasing companies, and finance companies which include global treasury centers and so on and so forth. And we also have foreign universities which have joined the league in providing international grade education to the talent that we require. So if you look at the regulations that we have put in place over the last 3 years, we have about 30 regulations, I think, which have been put in place, which includes banking, insurance, fund management, and we also have frameworks for ship leasing and aircraft leasing. We also have frameworks for sustainable financing and so on and so forth. I think you can look up our website for all these regulations. As of now, I think the story of GIFT City is a little old. I think it started in 2007 when the Honorable Prime Minister was the CM of Gujarat. So I think a lot of work was done into building the basic infrastructure. The real work started in 2014 when all the 4 regulators, domestic regulators, got together and put in place some basic regulations. But the real thrust came in 2019 when the Act was passed by Parliament, and therefore very simple and globally benchmarked regulations were put in place starting from 2019. So as of now, we have about 550 entities registered with us, which includes a lot of what I mentioned in the previous slide. Today we have the stock exchange, which got a monthly turnover of $67 billion, which is largely on derivatives. I think basically the Nifty 50 stock derivatives. And then we have a total banking asset size of about $46 billion. Banks are just now building out the liability side as well, because recently the Department of Revenue actually put out a notification dispensing with PAN for foreigners who come in and invest in GIFT City, and also for non-resident Indians who don't have taxable income in India. So as a result, I think the layers of difficulties and delays have also been put behind us. And therefore, we believe that a lot of these NRIs and foreigners are likely to invest in the near future, and therefore that could add to the liability side of the balance sheets of the banks. Now, the employment in GIFT City has touched about 6,000, and we have a cumulative debt listing of about $52 billion, which are largely bonds, out of which about $10 billion are in sustainable linked bonds. We also have a lot of the other institutions like aviation, aircraft and ship leasing companies, which have leased out about 122 assets so far, which include wide-bodied jets, which Air India has now leased out in the last couple of weeks, and at least about 60, 70 jet engines so far. Now, if you look at the banking sector, I think it consists of a gamut of all the activities. I mean, I think even last week, I think, for instance, one of the banks started the overseas derivative instruments also. I mean, I think it's the first transaction that they did out of GIFT City. So we are also working on an acquisition finance framework. I think the amendments are expected from the government, after which I think we'll launch it. But currently, if you look at the banking ecosystem, it largely provides trade finance. I mean, external commercial borrowings for companies, and so on and so forth. So we expect that in some time from now, as the complete ecosystem builds up, I mean, especially in terms of payment settlement systems, I think there's one area where I think we need to improve the efficiency in the process of clearing, because instant payments is something which is a given for an efficient financial system. So we are in the process of notifying a payment services regulation, which will enable instant payments to happen out of GIFT City, which I believe that in the last quarter of this year, I think we should be able to enable. Similarly, I think we are also working on a payment settlement system. I think that is a little time away. I mean, I think maybe in the second quarter of next year, I think we should be able to enable a payment settlement system, which will enable us to get out of the correspondent banking system, which is currently used for settlement of payments between various financial entities. Now, if you look at the capital markets, we have two exchanges, but currently I think they are in the process of merging. So one of the biggest products that they have currently is the GIFT Nifty 50, which I think trades out of GIFT City. And there are about 69 broker dealers, 19 clearing members, 2 clearing corporations, 5 custodians, 1 depository and 9 depository participants, and 2 exchanges. And these are growing by the day. If you look at the scope of the capital markets, we have been in the process of enabling the direct listing by Indian companies on the stock exchanges. So the government is likely to notify the regulations maybe in a month from now, and that would enable us to actually therefore by early next year, enable companies to actually to do their IPOs or FPOs out of GIFT City. So working group is actually working on the regulations, which will require some tweaks to support the entire process. Now, there are a lot of other things, including DRs, I mean, debt securities, ESG debt, etc., which have been enabled. If you look at the fund ecosystem out there, I think we have about 78 fund managers who are registered in GIFT City, and they have in total so far registered about 68 alternate investment funds. And these funds, I mean, they have a targeted corpus of, as of now, about $19 billion, out of which about $5 billion of commitment has already been reported to us, and nearly about $1 billion has been invested into India by these operational funds, which are nearly about 25. So this is growing by the day. I mean, I think there's a very rapid, I think I would say that the banking ecosystem and the fund ecosystem in GIFT City is very robust, and the growth is very, very robust. In fact, at least 2 banks have hit the $4 billion mark in terms of their assets. So, and we believe that this growth is very, very robust. So these are some of the very important participants in our market as of now. We also believe that technology is very, very important component of a global financial system. So therefore, we have put in place a fintech framework which enables financial sector entities to launch fintech products out of this place. We have admitted about 45 fintech companies, out of which 5 have been authorized to actually to launch financial products. So, and these are in the process of rollout. There are at least about 10 plus who are in the innovation sandbox, and the rest of them are there in the regulatory sandbox. So the sandboxes are of 2 kinds. I mean, the innovation sandbox provides for very fundamental research in the financial products that you would want to design for the market. Whereas in the regulatory sandbox is where I think your financial product is ready, and we provide a limited live market environment for the product to actually to be tested before it goes live. So we have a very robust system, and we believe that, and we also have a interoperable regulatory sandbox, which works between all the 5 regulators. So, and IFSC has taken the lead. So any company which needs to operate, any fintech company which needs to operate its tech, both in the GIFT City as well as in the domestic area, can admit itself to the IORS, which will actually enable all the 5 regulators to work together to ensure that its products are tested and piloted and cleared before it goes live. So there are also grants that we give for fintech companies which aspire to actually to launch products out of GIFT City. We have an investor ecosystem. In fact, a few VCs there have also provided equity investments to some of the fintech companies there. We have an angel fund as well, I think. So there are a number of elements of the financing ecosystem is getting built out, which would support a fintech ecosystem. We also believe that the greatest amount of employment would come through ancillary services. While the core financial services will provide a limited amount of employment, the real employment would come through ancillary services like accounting, legal, compliance, auditing, professional management services, etc., etc. So we have a number of entities which actually operate out of GIFT City, and some of them have actually expanded their operations significantly. In fact, Bank of America has got a tech center with nearly about 2,500 freshers who work out of that place. And there are a number of other entities which are shown here, which also work on the various elements of services to the core financial sector companies, both India and abroad. We also have a fairly good bond market, which has grown rapidly, and out of which I think at least about 20% are sustainable finance products. I think basically debt securities which are either social or sustainable or green or sustainable linked bonds. So this is we have a disclosure framework, and we have a framework which supports the launch of such kind of ESG products. So the exchange also has a sustainability platform which is being used by a lot of corporates, including the public sector undertakings. Now, if you look at the opportunities which are emerging, I think we believe that IFSC has got the opportunity to become a global reinsurance hub. So currently we are in the process of, in fact, very recently the IRDA amended its regulation, pushing up IFSCA to number 2 and bringing it on par along with the foreign reinsurance branches, or FRBs. So this has enabled IFSCA to actually pitch itself in the global reinsurance market. And we believe that there is a great opportunity into growing this entire ecosystem. The aircraft leasing and financing market is also very robust now, as I already mentioned. There are about 23 lessors which are registered, about 120 plus aircraft and assets which have been leased. In fact, Air India has leased out 2 of its A350 wide-bodied aircrafts in the last several weeks out of GIFT City, and they are expected to do more. Indigo is also reportedly in the process of applying. Then we also have an international bullion exchange. I think it's a spot exchange, and the last month, for instance, they did about nearly a ton of gold. I think of a ton of bullion, and this is largely the UAE SIPA gold, and I think we believe that there is a great opportunity to actually grow this market, because essentially exchange traded spot markets are a lot more transparent than OTC markets. That is what we believe that is an opportunity for India. That brings transparency, and this will lead to the emergence of a national benchmark price for bullion. This is very important for our economy. We also believe that if you want to do a very robust growth, then I think it's very important to put in place a pipeline of talent, which includes talent from the region or from the whole of India. But I think there is an opportunity for also to provide international education to children who probably migrate abroad. Probably there's an opportunity for them to take that education here and work for India. So currently two foreign universities, Deakin and Wollongong, are setting up their campuses, and they are likely to launch courses sometime in the middle of next year. So that's in brief about IFSCA. Please look up our website. We are organizing an event focused on the new age financial services on December 9th. This is the second Infinity Forum that would happen in the GIFT City Radisson. And we welcome a lot of you to come and interact with the regulated entities there and find if that fits into any of your business agenda. We also have Vibrant Gujarat, which is happening there, probably where a larger audience would be there, and I think I'm sure that will be a great opportunity for many of you to also interact and make deals with many of them. So as far as, let me conclude by saying that IFSCA is a unified regulator, and we also believe that being a startup kind of a regulator, I think we are more like a startup. So therefore, we have an opportunity of being agile, I think, because we need not necessarily get bogged down by the vastness of our of our past and so on and so forth. So we can learn from the best in the rest of the world. And therefore, I think our ability to move our regulations to match the market is something which I think which has happened over the last few years. So that does not mean that we have lost sight of the need to maintain organization in the markets, sanity in the markets, and so on and so forth. So we have a very growing Department of Supervision, which has also started the process of on-site and off-site supervision, which enables us to keep track of compliance with our regulations. And also, we have also a very robust AML and CFT norms, because it's very, very important for a global marketplace to ensure that the rules of the game are not violated, and that we don't the ecosystem does not get a bad name because of a few operators. So therefore, our AML and CFT norms are the best of its kind, I think, and we pride ourselves in that. And I'm sure that let me also say that we would be very happy to work with any of you to actually innovate, because innovation is the name in the global marketplace. And therefore, if there is an innovative financial product which you would like to try out, I think you are welcome to our sandbox, and then and see how that works for you and for us. Thank you very much, and Jai Hind.
Thank you so much, Mr. Rajaraman, for that immensely eclectic and insightful talk. I think my greatest takeaway really is that Gift City is emerging as the next hub for all the major financial transactions, not only at India, but at a global level. Can we give a huge round of applause for Mr. Rajaraman for sparing the time and sharing your insights with us? And can I also request Mr. Dobal to present him with a memento as a token of our appreciation? Thank you so much, sir. Ladies and gentlemen, next up, like I said, we have a very interesting set which is going to get started in the next few minutes. So I would request you